Hello all. So in this revision series video, I'm gonna uploading the chapters like NR taxation and DTAA. This has been fully covered. NR taxation, you might be having so many confusions. With this video, you'll get full clarity about NR taxation and you can confidently solve an exam question also. And DTA also. These two chapters I have solved almost each and every question from my workbook also, and then this revision series is going to be there. And then I'm gonna come up with the tax planning chapter, tax audit chapter and MCQs also in coming days. Like every day you'll be getting one video from the direct tax part. Okay, immediate video you'll be getting is from the MCQs. Then I'll be releasing even the tax audit and assessment of trust videos also in this part of revision series. Thank you all. Thank you. Hello all. So we are starting with the chapter NR taxation. Okay, so in NR taxation there are like 5-6 areas, sir. We cannot do it in a single go. There are like parts wise. If you divide this chapter into certain parts and if you read according to that part, I mean once you have clarity over one segment, then you go to the next segment. Okay, if you do in such a way like in parts, then you will get this chapter. So here we are having non-resident individual related taxation. There's a separate chapter for it. Chapter na not our syllabus related. Income Tax Act, there is a separate chapter for non-resident individual taxation and for non-resident tax rates and presumptive schemes. Like from PGBP, there are certain presumptive schemes which were specifically related to non-resident that we need to discuss. Then the next point is about residential status. The basic inter-level residential status we have discussed, right? Like what are the conditions for individual, company, HUF, AOP to call as resident or non-resident, that part. Then scope of total income, like which incomes are taxable to resident, non-resident and to resident but not ordinary resident, what is called deemed to be accrued in India, that concept. Okay, in scope of total income there is a concept regarding deemed to be accrued in India. So I mean that's like in inter level there will not be much focus on deemed to be accrued in India, but here that also will be there, and there are some miscellaneous provisions also. Okay, but exam focus, sir, I have seen the past examination questions, model question papers, and then I can say like 90% of the time the question is being asking from ABC areas only. What are those ABC areas? NR individual taxation, NR tax rates and presumptive taxation schemes. From these three areas only, mostly 90% of the times. Okay, you can go beyond 90 also, but the 10% of error can be there, right? That's why 90% of the cases this only. And then the area where students feel tough in NR taxation is also the first two areas only. Okay, especially the second area, because you will not remember them. That's a problem, sir. So listen carefully. I'll repeat it number of times. Repeat it along with me. So today we're gonna get that 7 marks from the NR taxation. That's a promise we are making to ourselves. Okay. See, NR taxation. They are like special tax rates. Like two chapters are there. Chapter 12, Chapter 12A. There are like two chapters, Chapter 12 and Chapter 12A. Chapter 12 is for non-resident. Chapter 12A is for non-resident individuals. 12 is for non-resident. He could be any person. Whereas 12A is specifically for non-resident individual. Chapter 12 is mandatory. Non-resident has to follow it mandatory. Chapter 12A is like optional. He can follow it or he can leave it also. Chapter 12 like 115A, AC, AD, BBA. 115 AD, AC, BBA. So chapter 12 they can take this 115A, AC, AD, BBA. Chapter 12A like section 115C to 115I. Okay, these are the sections. Like section numbers also here we'll be remembering the section numbers, sir, but initially it feels like little heavy for you, but once it progresses it will be easy only. Okay, so first we are starting with this chapter 12A concept, sir. This chapter 12A related. Okay, this concept mandatory or optional? Optional to the non-resident individuals. See, there is a non-resident individual, and such individual should be Indian citizen or person of Indian origin. There is a non-resident individual, he could be Indian citizen or person of Indian origin. Indian citizen or person of origin. So let's say the question said like this: David Warner, a non-resident of India and Australian cricketer. David Warner, yes, he is an individual, non-resident, but is he citizen of India or person of Indian origin? No, he is an Australian citizen. So then this concept is not applicable. This concept is applicable to whom? Like Sundar Pichai, who is a non-resident of India but is an Indian citizen. Okay, so those peoples who are not residents of India, but they should be what? Citizens of India or persons of Indian origin. Who is called as person of Indian origin? His father or grandfather is from India, then he will be called as person of Indian origin. So this is a special chapter, special tax regime applicable only for NRIs, non-resident individuals who are either Indian citizens or person of Indian origin. Sir, understand the motto behind this also. So the government of India wants the NRIs to invest in India. Okay, why this? Because they are Indians now, they need to be invested in India because our people were asking like that. No. NRIs will have foreign currency. They will be earning foreign currency. So India want that foreign currency reserved. So we are asking our NRIs, non-resident individuals, being a citizen of India or person of Indian origin, to invest in India. So obviously, when they invest in India, they'll ask for some kind of benefit, right? So we'll be giving here some kind of special tax rates. We cannot clearly say like these special tax rates are always beneficial. Depending on the case, sometimes these optional rates would be beneficial, sometimes they may not be beneficial. Okay, sometimes may be beneficial, sometimes may not be. So always he has an option. It's not like mandatory he should choose this option only. Okay, he has optional. It is like if they are like beneficial, he'll choose this. Otherwise, he'll be ignoring. Non-resident individual being an Indian citizen or person of Indian origin, he will be having two incomes: Indian income or foreign income. So what is Indian income? Once you go to the residential status, okay, the residential stat determination part and scope of total income, there you will understand, or else basic inter-level knowledge, sir. If income is received in India or accrued in India, then it is called as what? Indian income. Both receipt and accrual outside India, then we call it as foreign income. And we know like what? For a non-resident to be taxed in India, either income should be accrued in India or to be received in India. Either should be accrued in India or to be received in India. So foreign income now, it's not accrued in India nor received in India. Hence foreign income is not taxable to NRI. Okay, NRI na non-resident individual, it's not taxable foreign income because it's not accrued or received in India. But whereas Indian income, the income coming from India, okay, that also on which asset? On a foreign exchange asset. I mean, to acquire that asset, you have used foreign exchange. Okay, convertible foreign exchange has been used to acquire such asset. What are those? Shares of Indian company. Okay, they could be either public limited or private limited. Okay, shares of Indian company, public limited company, or even private limited company. Debentures or deposits of Indian public company only, private limited is not there. So for shares, it could be private limited or public limited, but for debentures or deposits, it should be only from public limited company. Securities of central government. Okay, securities of central government, I mean government securities and all will be there, right? Such securities, national saving certificates, those things, or any other notified by central government. So what are called foreign exchange assets? Four things are there. First one is like shares of Indian public or private limited company, deposits or debentures of Indian public limited company, securities of central governments, any other asset notified by central government. Okay, and it should be purchased in what? Foreign exchange. Okay, from there we'll have three types of incomes. It could be investment income, other income. Sir, investment income na, sir, if you invested in share, what income you'll get regularly? Dividend. If you invest in these debentures deposits, you'll get interest. Okay, so that only. Investment income na, the interest or dividend arising on those shares, debentures or the securities. Okay, on them the tax rate is how much? 20%. The tax rate is 20%. So let me tell you the basics, sir. If you remember, sir, the PGPP, let's say if he is having any interest income as a part of his business, then such interest is taxable under that PGBP. So under PGBP he can claim various deductions, okay, like the relevant expenses and all he can claim. But if he opted this special regime, he cannot claim any of those deductions. And then if you remember, sir, IFOS chapter, usually on dividend income we can claim interest expense which is incurred to earn the dividend. Okay, on dividend income we can claim expense which is incurred to earn the dividend. How much, sir? Sir, what happened na? You took a loan and with the loan money you invested in shares. Then you got what? Dividend income. But on this loan you need to pay an interest. So this is interest, you can claim it as an expense. How much? Actual or 20% of the dividend, whichever is lower. Okay, where it is mentioned IFOS. But such kind of deduction you can't claim if it is a foreign exchange asset and if he is a non-resident. Okay, because no expense or deduction from PGBP or IFOS will be allowed. Nothing will be given. And even from this income, chapter 6A deductions also can't be claimed. So usually on interest and dividend, these are like normal incomes only, taxable under IFOS. Okay, you can claim chapter 6A. But here they are saying clearly what chapter 6A deductions can't be claimed. Okay. Sir, investment income na what? It could be either interest or dividend. What is the tax rate? 20% plus surcharges that will be there. 20%. Okay, can he claim any expenses related to such earning income? No expense incurred with respect to earning such income can be claimed. Gross income taxable at a rate of 20%. Even chapter 6 deductions also can't be claimed on them. Fine. Then if there is any long-term capital gain, long-term capital gain is taxable at a rate of 12.5%. Taxable at a rate of what? 12 point. Sir, however, if you should remember, sir, the capital gain point. Before 23rd July, it is like 10% only. Before 23rd July, sir, I didn't mention like everywhere like before 23rd and after 23rd because that's a standard point. Everybody write in December 2025 exams. That's the main point, basic point you should remember and go to exam. What? Before 23rd July, the long-term capital gain rate is like 10%. Post 23rd or an hour after 23rd July, it is like 12.5. Okay. So here the tax rate is what? 12.5%. If they opt, okay, here, if they opt this route, indexation benefit is not available. But anyhow, sir, after 23rd July, there is no indexation benefit for anyone. Okay. But this one, even before that also, there is no indexation benefit available if they come here. And section 48 proviso 1 is applicable. So what is that proviso 1? You will understand within like 5 minutes. Till then wait. Okay. So on long term capital gains, what is the tax rate, sir? 12.5%. Okay. Now the question is like, okay, I have seen, sir, even in some places where students are having so much of confusion regarding this, what is the tax rate? So let's say you have long term capital gains on, there is a non-resident is having long term capital gain on sale of shares which is purchased in foreign exchange asset. Foreign exchange asset. Then which sections are this 115 C to 115, these sections will come. So especially 115E talks about tax rates, which says like what is the tax rate, sir? The tax rate equals to 12.5% after 23rd July. After 23rd July. Now let's say, sir, in question they have given us like long term capital gain as 5 lakhs. Now many students are having confusion like, do we need to apply straight away 12.5% or first 1,25,000 has to be exempted? Sir, that 1,25,000 exemption will applicable only when it is covered under 112A. Which are covered under 112A? If it is a listed equity share, units of equity oriented fund or units of business trust, okay, transferred on which securities transaction has been paid, then the tax rate would be 12.5% in excess of 1,25,000. Okay, so if it is not covered by 112A, so it is to be covered. Sir, 112A is applicable to resident as well as non-resident, because there they didn't said like it is not applicable to non-resident. Okay, so even for non-resident, if he sells a listed equity share or units of equity oriented fund or units of business trust, then the tax rate 12.5% in excess of 1,25,000. Sir, how do we identify? Sir, here they said like what? Long term capital gain on transfer of foreign exchange asset. They said like shares of Indian company. Shares of Indian company, that could be even a listed share also, right? Okay, if it is a listed share, sir, then we will not come to this section. Why listed equity share? Because then we can go to 112A, which is more beneficial, where we can claim first 1,25,000 as exemption. So, okay, so usually, sir, that much point is not being asked. You should remember like what, if they didn't mention as like listed equity share and all, you don't assume. If they said like it's a foreign exchange asset and all, then what you will take? You will take it under 115E only, and the tax rate would be 12.5% on gross amount. Okay, first 1,25,000 you need not to exempt. Then other income could be including short term capital gain. Okay, from those securities, sir, any other income other than this investment income, long term capital gain, if they are having any other income including short term capital gains, then they are taxable at normal rates. Normal rates now what? Slab rates. Taxable at normal rates. Normal rates mean slab rates. Okay. See, sir, again, a non-resident, what is this section, sir? He should be non-resident individual. Individual, citizen of India or person of Indian origin. He should be having what incomes? Investment income, like interest or dividend. What is the tax rate? 20% flat. Okay. Chapter 68 deductions can't be claimed. Any other expense also can't be claimed. Then if it is long-term capital gain, okay, long-term capital gain also, sir, okay, we need to do what? Indexation. Sir, here for long-term capital gain, I didn't said like no deduction can be made. So what? Expense related can be adjusted. So such transfer related expenses will be there now, that can be adjusted, no problem. Transfer related expenses, if any are there for arriving long term capital gain, they could be adjusted, but indexation can't be done. Tax rate is like 12.5% on gross amount, not in excess of 1,25,000. Then other incomes including short term capital gain, taxable at what rates? Normal rates. Taxable at normal rates. Okay. Then see, sir, 115H. What 115H says, like there is a non-resident individual. Okay, sir, this non-resident individual, what he did? He purchased certain shares when he is non-resident. Okay, on that shares or debentures he has purchased. I mean, the foreign exchange assets we have discussed, right? Out of those foreign exchange assets, non-resident of India has purchased. Okay, then since he is a non-resident, this particular 115E tax rates are only applicable. But later on, what he became? He became resident. Later on, he became resident. But even after becoming resident also, such investment is made at the time he is non-resident. So now even though he is resident, the same non-resident tax rates could be applied, taxable at special rates. Okay, sir, understand, these are not mandatory. These are always what? Optional only. If he like, he'll follow. Otherwise, he can opt out. Okay, long-term capital gain special rate. However, such special rates are not applicable to long-term. Sir, non-resident individual. See, year 1 he purchased a particular share or debenture. On that, what he is getting? Investment income. Investment income when he is non-resident, taxable at what rate? 20%. If he is having long-term capital gain, 12.5%. Year 2, the same securities continued. Okay, investment income is there, 20%. If he sold, long-term capital gain 12.5%. Year 3, he converted, he has become resident of India. Then also, with respect to investment income, special rates only applicable. What rates are? 20%. But the long-term capital gains, special rates will not be applicable because he transferred the shares when he is what? Resident. So special rates are not applicable. On them, normal provisions only applicable. Then 115G. What does 115G says? Like return of income need not to be filed where total income is only investment income, and on that long-term capital gain and TDS has been, on such investment income and long-term capital gain, TDS has been deducted. So understand, when you are a non-resident of India, NRI, but Indian citizen or person of Indian origin, you have only 2 incomes from India. What are those? Either such investment income on foreign exchange asset or long-term capital gain on foreign exchange asset. No other income you are having from India. And on them TDS also deducted. Which sections are? Section 195. 195. Okay, the general section TDS for non-resident is 195. If there is no specific section for TDS with respect to non-resident, then the general section will come non-resident like 195. What does 195 says? TDS has to be deducted as per the rate applicable. As per the rate applicable, now here what are the rates? 20% on investment income, long-term capital gain 12.5%. Such tax rate, such amount has to be deducted as TDS. Once they deducted it as TDS, then this person, which person? This individual need not to file the return of income. Okay, then. Sir, understood?
Yes, sir.
How many type of incomes could be there? Investment income, long-term capital gain. Others. Investment income. What is the tax rate? 20%. Can he claim any expenses? No. Can he claim Chapter 6A deductions? No. Then long-term capital gain. What is the tax rate? 12.5%. Slab rate. First gross amount or else like on net amount of gross long-term capital gain into tax we need to do. But transfer related expenses, if any is there, transfer related expenses under long-term capital gain, that could be adjusted. Okay, and proviso 2 to 48 is not applicable. Proviso 1 to section 48 is what applicable. So what is section 48 proviso? Sir, see in the next page you could see proviso 1 to section 48. What does it say? Capital gain in case of a non-resident asset transferred is being share or debenture of Indian company. What he has transferred, sir? Share or debenture of foreign currency of Indian company. If he is a non-resident and he has transferred shares or debenture of an Indian company, then his capital gain shall be computed in foreign currency and then converted into Indian currency. Sir, share in which company? Indian company. So the share usually be denominated in which currency? Indian currency. But still the capital gains has to be converted in what currency? Foreign currency. Sir, Indian currency, sale consideration will be in Indian currency, expenses will be in Indian currency, but still it has to be converted in what? It has to be calculated in what? Foreign currency. That means you need to convert the sale consideration, transfer related expenses, cost of acquisition, all these into foreign currency and then compute the capital gains. Sir, how to convert, sir? Which rates we need to take for conversion? So those conversion rates are given in Rule 115A. Rule 115A. Okay, sir, there is a section 115A also, don't confuse. This is rule. This is not section. This is what? Rule 115A. Okay, what does it say? If it is cost of acquisition, you need to convert Indian currency into foreign currency. Okay, on the date of acquisition, take the average of TTBR and TTLSR. Okay, TTBR, TTSR average rate. That will be given in the question only. Cost of acquisition has to be converted into foreign currency by using average of buying rate and selling rate. Okay, on which day? Date of acquisition. Then sale consideration, that also average rate only. Take the rate as on the date of transfer. Expenses on transfer, that also take average rate only as on the date of transfer. But now you have capital gain rate. Such capital gain again has to be converted. Such capital gain has to be again converted into Indian currency. Such capital gain has to be again converted into foreign Indian currency rate. Sir, you converted foreign currency and computed capital gain, but you can't calculate tax based on foreign currency. You cannot calculate tax based on foreign currency. That's why what you should have to again reconvert them into Indian currency. What currency? What rate you should use? TTBR. Sir, if you see, the ultimate capital gain has to be converted using what rate? TTBR rate as on the date of transfer. Okay. Then this point, sir. Here for this individual there is an exemption also given. 115F. What does it say? Sir, this person transferred a foreign exchange asset. Which person? Non-resident individual being citizen of India or person of Indian origin transferred a foreign exchange asset. Okay, then what he has to do? Out of the transfer, whatever is the net sale consideration he has, the whole net sale consideration he has to use to acquire another foreign exchange asset, or even it could be a savings certificate, national savings certificate under 10 subsection 4B. Sir, what he has to transfer, sir? Foreign exchange asset. The resulting net sale consideration has to be used to invest in what? Another foreign exchange asset or savings certificate under section 10B within how many months? 6 months. 6 months from when? Within 6 months from date of transfer. Within 6 months from date of transfer. Okay. Sir, if he invested, sir, let's say, sir, the capital, the net sale consideration he has is like 90 lakhs, whereas the long term capital gain is 30 lakhs. Long term capital gain is 90 lakhs, net sale consideration is 90, long term capital gain is 30. So how much he should invest? If he invested total 90 lakhs, then the total long term capital gain 30 lakhs is exempted. Let's say he invested only 60 lakhs. Then proportionate exemption. That means long term capital gain 30 lakhs into 60 divided by 90. So it is like how much? 2 by 3. So which is nothing but how much exemption will be given, sir? 20 lakhs is the exemption they will get. Understand, sir? So if they invest fully net sale consideration, then full exemption. Otherwise, proportionate to the sale amount invested to that of sale consideration. Understand? However, the new asset purchased shouldn't be transferred or disposed within a period of 3 years. If it is violated, then the long term exempted previously shall be taxable as long term capital gain in the year of violation. So the new asset you purchase should be what? Shouldn't be transferred until the expiry of how many years? 3 years. If violated in the year in which violation is made, that year the previously exempted long term capital gain is taxable. Okay. So now, okay, a part is completed, sir. So we have like how many segments here? 5, right? Out of them first segment is completed. So let me quickly, sir, once again let me revise. What is the points you need to tell me? Sir, this NR non-resident individual taxation, this is like, okay, first who should be the SSC? Non-resident individual being Indian citizen or person of Indian origin. Okay, he is having some income. Such income should be from what? Foreign exchange asset. I mean, he has invested in foreign exchange assets. What are called foreign exchange assets? Shares of Indian company, either public or private. Debentures, deposits of Indian public companies. Then third one, securities of government. And the next one is like what? Any other asset notified by government. These things. Okay. Then from this, what kind of incomes could be there? There could be investment income like interest and dividend, long term capital gain, other incomes. If it is like investment income, if it is like what? Investment income, then it is taxable at what rate? 20%. No chapter 6 deductions, no expense can be claimed. If it is like interest, if it is like long term capital gain, taxable at what rate? 12.5%. How much? 12.5%. You can adjust the capital gain related expenses and all. On the capital gain, you should apply 12.5, no 1,25,000 exemption and all. Okay, Proviso 1 of section 48 is applicable. What is Proviso 1? Proviso 1 says like if SSC is a non-resident and the asset he has transferred, capital asset transferred is like shares of Indian company or debenture of Indian company. Okay, then the capital gains has to be computed in foreign currency only. Sir, but how do we convert Indian asset na Indian currency only it will be there. How do we compute in foreign currency? By converting the values into foreign currency. What rates? Cost of acquisition, average TTBR as on the date of acquisition. Sale proceeds, average of TTBR as on the date of transfer. Transfer related expenses, average of TTBR and TDS as on the date of transfer. Then the last one, sir, the computed capital gains has to be again converted into Indian rupees using the buying TTBR buying. Okay, TTBR na buying rate. Okay, telegraphic transfer buying rate. TDSR na telegraphic transfer selling rate. Okay, so that TTBR rate has to be used. Okay, done. This we have did. Then whether this person has to file return of income mandatorily? No. When such option, if he has only those two incomes, which two incomes? Investment income and then long term capital gains, and on that TDS has been deducted under section 195, then no return of income has to be filed. Then, sir, at the time of investment he is NRI, but then he converted, but then in the succeeding years he has changed it to resident. Then the investment income will be taxed at the special rate only. He has that option. But long term capital gain, post becoming resident, long term capital gain is taxable at the normal rates only. Okay, but then normal rate also 12.5% only post 23rd July. Okay, then exemption. Sir, 115F exemption is there. To get exemption, what he has to do? He has transferred a foreign exchange asset, and then the net sale proceeds also again he should invest in another foreign exchange asset or securities mentioned under 10 subsection 43D. That section will be there, right? 10 subsection 44B. Okay, within 6 months from date of transfer. Sir, if a part of sale consideration only invested, then the capital gain also exempted proportionately, same as like 54F. 54F capital gain exemption also will be the same way. Okay, lock-in period for those assets is like 3 years. Within 3 years, he cannot either violated long-term exempted previously shall be taxed. Okay, the asset newly purchased shall not be transferred until the expiry of how many years? 3 years. Understand, sir? If violated, the long-term exempted, long-term capital gain exempted will be taxed again in the year of violation. So now let me show you a question from NR taxation, sir. Okay, NRI taxation. Sir, this is not, look at this question, we will check. Anthony is a non-resident Indian, acquired 1000 shares in A Limited, an Indian company, for rupees 20,000 by using foreign currency on 18th August 2024. Anthony, a non-resident individual. Sir, he is a non-resident or what? Yes, he is a non-resident Indian, they said Anthony. For him what? This chapter 12A can be applied or not? Yes, chapter 12A can be applied. And then, did he invest it in foreign exchange asset? Yes, he purchased shares using foreign currency only. On 16 September, Anthony sold such shares for 45,000 and utilized the proceeds in acquisition of 500 shares of B Limited after paying expenditure on transfer 5,000. Compute the capital gain liability in the previous year. Okay. Compute the capital gain liability in the previous year. So, first. Sir, how long the shares has been held, sir? When he has purchased it, sir? 18th August 2024. When he has sold? 16th September 2024. What is the period of holding, sir? Okay, it's less than 2 months. It is less than 2 months period of holding. Long term or short term? Short term. Okay, but if you okay, this is short term only. The resulting capital gain will be what? Short term capital gain only. But sir, you will be thinking like what means? Understand the point, sir. Proviso 48, proviso 1, if you remember, what it has said, proviso 1, it doesn't mention about for long term capital gain only you should apply rule 150. What does it said? Like where a non-resident transfers a capital asset being shares of Indian company or debentures of Indian concern which was purchased or acquired in foreign currency. Okay, they didn't even mention foreign currency also. Look at the point, sir. I'll be showing. Capital gain in case of non-resident asset transferred being share or debenture of Indian company shall be computed in foreign currency. Okay, so however they have purchased. Okay, as per method, this method we should do. Okay, so here if you solve this question, sir, what is the point here? First, short term capital gain. So short term capital gain, a special rate applicable. Investment income 20%, long term capital gain 12.5%, other incomes no normal rates only. So normal rates only. There is an exemption there. 115F exemption is there. If he has invested the sale consideration in another asset, sir, what he has did and utilized the proceeds in acquisition of 500 shares of B Limited in Indian company. So again what? He has incurred, he has used them to purchase again in Indian company share. But the problem is long term capital gain alone is allowed for exemption. Okay, look at here 115F. What does we have said? Foreign exchange asset transferred and the resulting long term capital gain alone is exemption. But here what, sir, it is short term capital gain. So exemption available or not available? Not available. Okay, so we'll just need to calculate what? Capital gain. Short term capital gain. See, first what do we want, sir? Sale consideration. Sold shares for 45,000, sir. Sir, 45,000 now will not take 45,000. We need to convert them into what? Foreign currency. So how do we do? On the date of transfer 16th September, what is the average rate, sir? On 16th September 47 is the average rate. So 45,000 by 45,000 divided by 47, $957.4 is the sale consideration minus expenditure on transfer. Yes, expenditure also there. How much, sir? 5,000. Expenditure on transfer on 13th September 24 is like how much? 5,000. Okay, 5,000 also has to be converted using the average rate as on the date of transfer only. How much? 5000 by 47, sir? 106.4. If you subtract, then the net sale consideration is 851. 851. Okay. Then is he eligible for, sir, he has invested, sir, how much? Utilize the proceeds to purchase 500 shares of B Limited after paying expenditure on transfer 5000. So he has paid the total net sale consideration for purchasing B Limited shares. But the problem is what? That can't be claimed as exemption because it is a short term capital gain. So the whole short term capital gain. Is there any cost of improvement, sir?
Cost of acquisition, sir.
It's like cost of acquisition. How much is the cost of acquisition, sir? Already they given it in what? Foreign currency only. Okay, no. Rupees 20,000. So 20,000 also we need to convert into foreign currency on the date of what? Acquisition. On the date of acquisition it is how much? 45.5 average rate. So 20,000 by 45.5, it is like how much? 439.6. Then the short term capital gain is $411.4. There is no exemption because the resulting gain is not long term. If it is long term, then there is an exemption to it. The next one, sir, we need to convert this short term capital gain again into what? Indian currency. So, okay, what is the Indian currency rates how, sir? On the date of transfer, buying rate you should take. Okay, data 46. So if you convert this into by using 46, you will get 18,924 as the short term capital gain. Short term capital gain. So this one also a simple question only, sir. Smart, a non-resident has computed tax liability as under: income from business A 2,80,000, long term capital gain 10,000, business loss 10,000, income from other sources 30, total income 3,10,000, and rebate he has claimed on 520. Okay, now first thing, sir. Sir, if you remember the rebate concept, sir, the basics, sir. Sir, any question which involves tax computation is always linked with the basics. You should have crystal clear clarity about the basics. You cannot survive with the income tax paper if and all you are not clear with the basics. Clear na, they should be at your fingertips. When somebody talks about your rebate, every point, every corner point of rebate you could recall, surcharge points, those things you should remember so much, sir. So now see, rebate is applicable only to a resident individual or HUF. But this fellow already claimed in the question what? Rebate. So that is wrong na? Yes. Then what he has did, sir, this fellow is having business income 2,80,000. Then he has long term capital gain 10,000. From that long term capital gain he has set off the loss from business B how much? 10,000. Sir, understand, first we should do intra-head set off. Then only we should go for inter-head set off. But this fellow what he did? First he did inter-head set off, which is wrong. So here 10,000 can't be adjusted first. Okay, those are the corrections we need to do. Okay, so now if you see profit and gains, how much? 2,80,000. From there loss, adjust the 10,000. What is that amount? 2,70,000. Then long term capital gain, there is no loss to set up, so it will remain how much, sir? 10,000. Then income from other sources 30,000. Gross total income is how much? 3,10,000. Sir, here non-resident age is not given, but remember even age is given also. If he has opted for old rates, there won't be any difference, sir, because for non-resident the basic exemption limit will be 2,50,000 only in old resident. Then what is the tax, sir? Long term capital gain is taxable at special rate 12.5. Sir, this 12.5 is not because of chapter 12A. Usually also long term capital gain under 112 taxable at what rate? 12.5 only. So that's why 10,000 into 12.5. Then other income. Sir, why other income? Okay, why capital gain we have taxed separately, special incomes we need to tax separately. Then balance 3 lakhs is the normal income. What is that? Business income and income from IFOs 3 lakhs. From there basic exemption limit 2,50,000. The balance 50,000 into 5% na 2,500. Then the total tax is how much, sir? 3,750. On that HEC at a rate of 150. So total it will come 3,900. Since he is a non-resident individual, rebate is not available. Available or not available? Not available. I hope everybody got these questions, sir.
Yes, sir.
Question number 1 and question number 2. Now we are moving over to our next section, sir. Very important one. Okay, from here we are going into the second segment. What is the second segment, sir? NR tax rates. So NR tax rates, these are not specific for individuals. The part we are going to discuss now. These are applicable for all. It could be a company. It depends. Okay, somewhere like they will tell clearly a specific person. If specifically, if general they said non-resident, it could be individual, HUF, company, anyone. So out of this first one, sir, this 115A, very important, sir. 115A is very important. Okay, see, 115A talks about two incomes, sir. 115A talks about two incomes. Sir, actually, while working on this, like I have seen like some other CA final faculties videos also, like how they have been injecting it in a easy way. So I have referred like somewhere like some 7-8 faculty revision videos I have watched for NR taxation. Not like how easily they can, like I am just observing like anybody can tell easily these provisions and all, but there one point I like there is like, so like in Hindi only they said like what 115A will be having two incomes. One is like this person, this foreign company or non-resident. Sir, understand 115A is applicable only to a foreign company or non-resident. So foreign company also non-resident only na? No. When you go to the residential status, you will understand foreign company could be resident or even could be non-resident also. Sir, foreign company outside India, can it be resident? Yes. There are tests like place of effective management. We'll check POEM. If the POEM is in India, even though it's a foreign company, it could be resident. Domestic company no always resident only, but foreign company sometimes it could be resident, sometimes it could be non-resident. Okay, so this provision 115A is applicable to a foreign company even though it is resident. Understand? So it's not just for non-residents, it is applicable to a foreign company if it is resident only. So 115A provisions are applicable to foreign company and even to a non-resident. Okay. Now this foreign company or non-resident invested in India. I mean they brought what? Money in India. Okay, the invested money, okay, they have given debt, they have given some kind of money in India. From there they are getting investment income like interest or dividend. They are getting what? Interest or dividend. Are you able to understand, sir? Next thing, okay, they said is like they are investing intelligence, not the money. First case they invested straight away money. Now second case, this non-resident foreign company is investing in India, not the money, the intelligence. That's what the point I liked and I am saying it. So why? Because for earning royalty income and fee for technical service income, you need not to invest in money. Sir, I already had some kind of technology, sir. I am a scientist, I developed a technology. Then what? I'll have a patent on it. Now you want to use it. Then what I am giving? I am giving my patent and nothing but my intelligence. I am providing fee for technical services. What? So I am a chartered accountant, sir. You want some technical service, some audit related service, some kind of accounting service, some kind of tax advice. I am doing it one. So then it is what? Fee for technical service. Again for intelligence only. Okay, understand? So 115A, you will be getting two incomes. One is what? So on one point is about you getting interest and dividend income. Sir, in our BCCA material also it will be shown like two parts actually, two subsections. But no need to worry about subsections. Remember, you will be having a non-resident and foreign company invested in India. Okay, invested in India and they are earning interest dividend kind of incomes is one segment. They are earning royalty fee for technical services another segment. Okay, sir, easy one, royalty fee for technical service, sir. So first we will finish off that one. Royalty fee for technical. So 115A, this foreign company or non-resident is getting what? Royalty or fee for technical service. The tax rate is what? 20%. Okay, tax rate is 20%. Then we need to even link it to a section called 44DA. Sir, 44DA is a presumptive taxation section. Okay, so now let me tell you the 44DA. So if you scroll 2 pages, then you will get 44DA. What is 44DA? Government of India, either government of India or an Indian concern under an agreement. which has an agreement. Who are those, sir? Either government of India or an Indian concern with which there is an agreement is paying royalty and fee for technical service to a non-resident or foreign company. That's what only they are said, right? So in 115A, what we said tax rate would be 20. So now we'll see what 44DA says. Again, so they are earning, this non-resident and foreign company is getting what income? Royalty, fee for technical service. But who is paying? Government of India or an Indian concern with which they are having an agreement. Okay. But to earn this royalty fee for technical service, such royalty fee for technical service is connected to a permanent establishment in India. So what is called PE, sir? Let's say, sir, there is Google Inc., which is a foreign company. Okay. It has a branch in India. It has a branch in India, let's say Hyderabad. Now, the Google branch in India, now it's a permanent establishment because they are having a branch here, it's a permanent establishment. Now, they had a registered patent which is from Google India. Okay, from the branch Google India. Then what? That patent they are renting, or that patent they are allowing it to use to someone else, and they are getting royalty or fee for technical service. So the patent is registered for whom? The branch office in India. That means which is connected to the permanent establishment in India. If the royalty, sir, understand, royalty fee for technical service is earning by a non-resident or foreign company. What we should check? Whether it is linked to the permanent establishment of such non-resident or foreign company in India or not. Understand, sir? Google is a foreign company. It has a branch in India. Now Google is getting royalty income. We should check whether because of this Indian branch it is getting royalty or fee for technical service, or not related to this branch they are earning. If it is related to such branch, then it is connected to PE, that means a fixed place. Okay. Then see, sir, non-resident carrying business or profession in India or profession through a fixed place in India. That non-resident what he is doing? He is carrying business through a PE in India or profession through fixed place in India. Then understand, sir, non-resident or foreign company is having which income? Royalty, FTS. And that royalty, why they are earning? It is connected to the permanent establishment of such foreign company, India. And the fee for technical service is related to the profession which was started or set up in India from a fixed place in India. If these two are there, then you need not to apply special rate. You can compute it what rate? As per the normal Indian PGBP, how you calculate, like that only you can calculate. Sir, special rate and normal rate, what is the difference, sir? Sir, if you go for special rate, flat 20, no expense can be taken as deduction. But if you take under the PGBP route, the relevant expenses incurred to earn that income can be claimed as deduction from section 28 to section 37. All those expenses like depreciation can be claimed, rent can be claimed as expense. If any other expenses are there, all those can be claimed as expense, right? So that benefit is not available. Understand, sir? 44DA says what? A non-resident or a foreign company having royalty or fee for technical service. Such royalty is related to PE in India, and such fee FTS is related to profession which is carried out a fixed place in India. Okay. Then that income, that business income will be assessed as the normal business income only, not with the special rate. Okay. Now disallowed expense. What is disallowed? Expense exclusively not related to PE or such fixed place. Understand, sir? We can claim expenses under the PGBP, but which expenses? Such expenses which were related to the PE and fixed place only. If those are payments to head office and other offices, so this branch is paying some expenses to their head office, that can't be claimed unless they are related to PE but incurred by head office and this PE is reimbursing. Sir, now Google has a branch office in India, na? For this branch office they have to pay 5 lakhs per month rent. This is related to PE only, can be claimed as expense. But what happened? This 5 lakhs rent was paid by head office directly. Okay, and then such 5 lakhs is reimbursed by branch. So that is a PE related expense now you can take. Other than this, if any other amount is paid to head office, that can't be claimed as deduction. And then 44BB, sir, this we will discuss afterwards. Again, we need not to link it. If 44B is not applicable, it is covered by 44DA. Okay, now coming back to the 115A, sir. What is 115A saying? If a non-resident or a foreign company is earning what income, sir? Royalty or fee for technical service. You should check too whether it is related to PE, not related to PE in India. Related to PE in India, 44 BB. Not related to PE in India, 115A. Special taxable at what? Special rate. Sir, again clearly see, non-resident or foreign company is having what income? Royalty or fee for technical service. This you need to check like what? Whether it is related to PE in India, permanent establishment in India, not related to permanent establishment in India. Related to PE, 44 BB is applicable. These are taxable at what? Sorry, 44 DA is applicable and normal PGBP provisions only applicable. But only expenses related to such PE can be allowed as deduction. Next one, sir, not connected to PE, sir. Then not connected to PE, then special rate is applicable 20%. No other expense can be claimed as deduction. This is like a flat rate, 20%. Okay, and the corresponding section, sir. Sir, again remember, for a non-resident, any amount paid, TDS has to be deducted. Now for this payment, where TDS will be deducted? 195. What does 195 says? For a non-resident, if a payment is being made and it was not mentioned specifically elsewhere, then TDS has to be deducted under 195 as per the rate applicable. What is the rate applicable? 20%. Okay, so this part clear na?
Yes, sir.
Then second part, 115A only. Again, who is this person? Foreign company or non-resident having interest income, dividend income or income from UTAA mutual funds. Okay. So now see, where he is having interest which is paid by infrastructure debt fund. Okay, if that interest is paid by what, sir? By a infrastructure debt fund to a foreign company or non-resident. Infrastructure debt fund, sir, this is also a normal fund only where you will be investing, where this non-resident will be investing money, but that money, such debt fund will invest only in infrastructure facilities like laying roads, projects, that kind. So such infrastructure debt fund, if it is paying any interest to whom? Non-resident or foreign company, then the tax has to be applicable is like how much? 5%. The linked TDS section is what? 194 LB. Let me take to 194 LB also quickly. See, next page only. TDS on interest from infrastructure debt fund. See, any person paying interest on infrastructure debt fund to non-resident or foreign company, what is the TDS rate, sir? 5% plus surcharge HUC if any is applicable, payment at the time of payment or paid whichever is earlier. Okay, so now what is the point you should understand, sir? Who is paying infrastructure debt fund? To whom it is paying? Non-resident or foreign company. Okay, infrastructure debt fund. Then what is the tax rate? 5%. What is the relevant TDS section? 194 LB. 194 LB. TDS rate is also how much? 5%. Sir, NR taxation, sir. TDS, you need not to by heart. Just link the section number because the tax rate, TDS rate will remain same. Okay, then second one, sir. The interest is being paid by Indian company or business trust. Indian company or business trust. Sir, interest is being paid by whom? Indian company or a business trust. And such loan is also which loan? Foreign currency loan. I mean, sir, I am a non-resident, sir, assume. I have so much money. I am from Japan. I am having so much money. So you are from India, came to me. Who you should be? Either you should be a business trust or should be an Indian company. Okay, sir, they said only company. They didn't mention like public company or private limited company. Okay, and then you took a loan. That loan also in what? I will be giving in foreign currency. Okay, so now it's not a normal loan, sir. For loan you will be issuing me what? A long term bond or rupee denominated bond. Which bond? Long term bond or rupee denominated bond. Then on them the TDA, the tax rate is like 5% up to 30th June 2023. Then this concessional benefit is withdrawn, sir. So currently it is like what? 20% only. I mean normal rate, sir. Sorry, 115A 20 is like normal. Okay, na? If it is less than 20, na, special in 115A. Okay, so if infrastructure debt fund is paying 5%. Okay, then if at all the non-resident or foreign company has given a loan in foreign currency for what? Long term bond or rupee denominated bond before 23rd July, the bonds has been issued. Then the interest rate is like what? 5%. Interest tax rate is like about 5%. But from 23rd June, okay, this benefit is not there. Sorry, from 30th June, sir, not 23rd July. From 30th June, I mean, this made in the year 23-24 only. So from 30th June, the tax rate is like how much? 20%. If it is listed in IFSC, what is IFSC, sir? Sir, IFSC na, for a layman example I am giving, sir. Sir, for normal manufacturing concerns, service sector and all, there are SEZs and all. Why special economic zones? There these industries will be set up with certain incentives and then they will be exporting. Now banking is also a major sector in India. Now banks are majorly depending on Indian loans only. But IFSC na, these banks can provide loans to foreign companies or offshore outside India also. They can give loans and all, and they can accept deposits from there. So that is called IFSC. Okay, that area. If such particular long term bond or rupee denominated bond is listed in IFSC, then before 30th June the interest rate is like, the tax rate is like 4%. Post 30th June the tax rate is like 9%. Post 30th June the tax rate is like what? 9%. Sir, important, sir. I understand. Here only you will be losing focus. See here only. Who is paying, sir? A foreign company or non-resident. Okay, paid by Indian company or business trust. What? Foreign currency loan in long-term bonds or rupee denominated bonds. And the rate, what is the tax rate, sir? Before 30th June, 5%, but now 20 only. Now the loan is issued. Sir, now understand. It doesn't mean for our attempt straight away 20%. If loan is taken before 30th June 2023, now interest paid 5% only. So understand. Otherwise, why I tell this dates and all for you to confuse? Loan taken before 30th June 2023. Now they are paying interest 5% only tax rate. Loan taken after, I mean loan given after 30th June, then the tax rate is like what? 20%. And then if they are listed in IFSC, 4% before 30th June, post 30th June, 9%. Okay. Any other interest is there? Any other interest, but that also should be in what, sir? Foreign currency loan only. Okay. Any interest or income from UTI or mutual fund, anything you find, then what is the rate, sir? 20%. So you should remember, sir, simply 115A. 115A, what are covering, sir? We are having interest income. Within interest also, if it is paid by what? Infra debt fund.
5%.
Infra debt fund, then the tax rate is like what? 5%. If it is paid by
Indian company or business trust.
Indian company or business trust, and the borrowing and the loan is in for what? Long term borrowings or rupee denominated bond, that also two dates, sir. Indian company, business trust in long term borrowing or rupee denominated bond before or up to 30th June. Up to 30th June 2023, how much, sir? 5%. If at all that is listed in IFSC, then 1% much more reduction is there. It is only 4%. Same thing. After 30th June 2023, then it has become what? 20%. But the IFSC related one, 9%. Okay. So this is about the loan when it is taken, sir. It's not like when the interest is being earned. Then any other interest except this, any other interest, dividend, investment income. Any other investment income, it could be interest, it could be dividend, etc. What is the rate, sir? 20%. Okay, here the debts should be in what? The loan given should be in, simply you can remember, loan given in what? Foreign currency. Loan given in what? Foreign currency. 115A. Then we have another income also, sir, under 115A, royalty and FTS. Royalty and FTS, what we should check? Whether it is covered by 44BA or not. 44BA, if it is covered, then normal rates. Normal rates. If it is not covered by 44BA, then 20% is the rate. Everybody, remember this now, 115A. Clear, right?
Yes.
Okay. Now, if you see, sir, on these expenses, either interest income or dividend income, other income, royalty, fee for technical service, be clear, sir. On interest income, dividend income and other incomes, business expenses and IFOS expenses can't be claimed. And even royalty, FTS also, any PGBP related expenses or IFOS related expenses can't be claimed as deduction. I mean, for earning that interest, dividend, royalty, you incurred some expense. Such expense can't be claimed as deduction. Chapter 60 deductions, sir, be clear, see. On interest dividend, you can't claim Chapter 60 deductions except ADLA. But whereas on royalty, fee for technical service, you can claim Chapter 60 deduction. Hello, clearer? On royalty FTS, you can claim Chapter 60 deductions, but on interest dividend, you can't claim Chapter 60 deductions. Basic exemption limit is also not available. These are taxable at what? Flat rates. Flat rates. Then SSC is not required to furnish return of income also. Where the total income consists of interest, dividend, royalty, fee for technical service which are referred above, and TDS has been deducted. Now the relevant TDS sections are LB already discussed, 194 LB. Now LC, TDS on interest to non-resident. Who is paying? An Indian company or business trust. You already know. What are the tax rates? Indian company or business trust na? 5%, but then change it to 20. But if they are listed in IFSC, 4% or 9%. See, foreign currency loan or rupee denominated bonds, 5% till 1st July 2023. Sir, why it's not mentioned after 20th July? Sir, after 20th July, that income is not covered here. It drops to 195, normal rate, okay, 20%. If bonds listed on IFSC from 1st April 22, 1st July, 4%. Bonds listed in IFSC on or after 1st July, 9%. You already know the tax rate, right? So once you remember the tax rate, TDS is nothing, the same. Section number alone you should remember. Then 194 LD. 194 LD. What? Income by way of interest on certain bonds. So okay, the paying interest is on rupee denominated bonds by Indian company, government securities or municipal debt securities. Okay. So that also from 1st June 2013 to 1st July 2023, municipal debt securities 1st April 2022, 1st July 2023. What is the TDS rate? 5. Sorry, here MGR na municipal debt securities, G na government securities, third one R na rupee denominated bonds. Sorry, it will come afterwards also. Remember MGR 194 LD. What is MGR? Municipal debt securities, G for government securities, R for rupee denominated bonds. Okay, who is paying interest, sir? Any person. To whom? This is also important. Foreign institutional investor, not to non-resident here. MGR, the interest on MGR is paying by any person to foreign institutional investors or qualified foreign investors, then the TDS rate is 5%. 5%. If you remember, if you understand, we have covered till now all the points. Okay, so now quickly, once again, sum up everything. 115A, what incomes are covered? Two ways. Okay, close your eyes and try to recall, sir. 115A. One side royalty fee for technical service is there. The other side interest, dividend, other investment kind of incomes are there. Okay. Royalty fee for technical service. What is the tax rate, sir? Earned by whom? Non-resident foreign company. We should check whether covered under 44DA or not. What is 44DA? 44DA is what? Okay, the business PGBP related provision only. What does it says? Where a non-resident or foreign company is earning royalty or fee for technical service, we should check whether that royalty fee for technical service is linked to the PE in India, permanent establishment, nothing but a branch in India, or to a fixed place in India. Then on such royalty FTS, you could calculate the income by applying normal PGBP provisions. Okay, I mean you can claim expenses and all as deduction. Which expense you can't claim as deduction? Which were not related to PE. Okay, but you can claim if it is paid to HO as a reimbursement of expense which is related to PE. Understand? Then the tax would be normal rate. If it is not covered under 44DA, not covered under 20% flat for that royalty. So what you should do? Royalty FTS into 20%. You can't adjust any expenses, but if you remember, Chapter 60 deduction can be claimed. At last we have discussed the summary. There I said chapter 6A deduction can be claimed, but PGBP or IFOS relevant, royalty relevant expenses can't be claimed as deduction. Okay, then whether such person has to file return of income? No, he need not to file return of income if TDS is already deducted. Sir, which section? 195, 20% na 195. If under 195, if TDS is deducted as per applicable rate, then no other income he is having, then he need not to file return of income also. Then interest part. Interest paid by infrastructure debt fund, 5%. If interest is paid by Indian company or business trust before 30th June 2023, 5%. After 20% only. Okay. But if it is at IFSC na, before na 4%, after na 9%. Okay. The relevant TDS section is what? 194 LC. LC, 194 LC it is like, not LB. 194 LC. C. 194 LC. LB is related to infrastructure debt fund. Okay, then next one, sir. Others. On other incomes, na, the tax rate is what? 20%. Okay, with respect to interest, dividend, and other incomes, can you claim any business or IFOS relevant expenses as deduction? Nothing. Chapter 6A deductions also? No, you can't claim. And basic exemption limit also not available. Flat rates only, these are like. Okay. So with this we completed what? 115A. One of the important sections, sir. In NR taxation, that individual part, 115A part, most important. Then only the other part. Okay. If at all you started NR taxation, first study this part. Okay. If you didn't complete this and you go into the other part, that is like completely useless only. Now, 115AB. 115AB. 115AB is what? Special provision for computing tax on income from units. Sir, what are called units? What are called shares? Sir, if you invest in a company, you will get shares. If you invest in a mutual fund and all, you will get units. So here, computing tax on income from units, which are purchased in what? Foreign currency or capital gains arising from there, in case of what? Offshore fund. In case of what? Offshore fund. Okay, in case of a offshore fund. Sir, you will be having doubt. What is called an offshore fund? What are these names and all? See, I have written here. Sir, offshore fund, nothing but it's a mutual fund which is there outside India. Offshore fund is not, okay, overseas financial organization. Okay, that could be a bank, that could be an insurance company, that could be a mutual fund which is there outside India. Okay, so what they are doing, their money, they are again investing it in Indian mutual funds. Now they are getting what? These incomes taxable at these rates. See, income from units to an offshore fund. So to whom, sir? 115AB. To whom? Offshore fund. Okay, offshore fund, overseas financial organization to offshore fund, this is applicable. From what the income should be receiving? Not from shares, from units. The income could be income from units, long-term capital gain, short-term capital gain, other incomes. Okay, sir, income from units, what is the tax rate? 10%. Income from units, 10%. Income now what? It could be dividend, interest, those things, 10%. Long-term capital gain, 12.5. But whenever long-term capital gain comes, you should remember, before 23rd July, 10% only. Post 23rd July, 12.5. And they should have purchased this in what? Foreign currency. Okay, short-term capital gain. Sir, on short-term capital gain, what are the tax rates, sir, usually also? 20% only, na? Okay, why? It's a unit. Okay, on units. Okay, what is the short-term capital gain, sir? Usually 111A. Okay, before 23rd July 15%, after 23rd July 20%. That's why 20%. Other all incomes taxable at normal rates. So here you should remember mainly two. 115AB. Who is getting the income? Offshore fund. On what they are getting income? Units. If the income is like investment income, 10%. Long-term capital gain, 12.5%. But remember, the investment should be in foreign currency. Sir, why everywhere they are saying foreign currency? Because India, this special tax they are giving only to encourage them investing in India, so that India will have more foreign currency deposits or reserves. Here, sir, while computing here, no indexation benefit is available and no deductions under 28. I mean what? 28 to 44 C means PGBP relevant, IFOS relevant, chapter 6A deductions are not available, whereas they are having other incomes. On the other income they can claim chapter 6A. Okay, so overseas fund organization, if they are having income from units or long term capital gain, which are taxable at special rates. Sir, nothing but on special rate chargeable income, you can't claim chapter 6A deductions. On others, you can claim chapter 6A deductions. See the relevant TDS section 196B. TDS on income of units of non-resident. Any person paying income from units referred in 115 BAB 10% plus surcharge plus HEC. If it is long term capital gain 10% or 12.5%. So what is 115 AB, sir? Offshore fund having what incomes? Income, investment income 10%, long term capital gain 12.5%. Understand? No expense can be claimed as deduction, no deductions are allowed.
Only other income deduction.
Then only 2 sections more, sir. The rest all are like easy only. 2 sections more. Okay, don't feel heavy here itself. 115 AC. Tax on income from bonds or GDRs purchased in foreign currency or capital gains arising from their transfer. Okay, sir, what here? GDRs, income from bonds. GDR na global depository receipts. So nothing but GDR is nothing but an Indian share which is purchased in foreign currency. Okay, let's say a foreigner wants to invest in Indian share, sir. He cannot actually come and invest, right? So our Indian companies will issue GDRs. GDR is a Xerox copy of Indian share which will be there in foreign country. Okay, so now the foreigner can't buy the share directly in India, so he will be buying the Xerox copy, but that one also equivalent of the Indian share. Okay, income from bonds, GDRs purchased in foreign currency or capital gains arising from their transfer. So he is having, sir, non-resident only here. Non-resident, from what he is having income? GDRs, bonds which are purchased in foreign currency. Okay, non-resident is having interest on bonds of Indian company which are notified by a scheme of government. So the bonds purchased, non-resident has purchased bonds from whom? An Indian company. Now Indian company allotted bonds in, so it has to pay what? Interest. Okay. Dividend on GDS. GDS, what I said, they are like Xerox copies of shares. So shares will not pay any interest. Shares will pay dividend. That's why dividend will be there on GDS which is purchased in foreign currency. On them the tax rate is what? 10%. On sale of these GDRs or these bonds, if any long term capital gain is there, taxable at what rate? 12.5%. Sir, everywhere here they are like flat 12.5 only. There is no 1,25,000 exemption. Understand? And other incomes they are taxable at what? Normal rates. Other incomes they are taxable at normal rates. Okay. Now once again, 115 AC. To whom?
To bonds and GDRs.
NR. To a non-resident. He is having income from what? On investment in bonds of certain Indian companies notified or GDRs. From this notified company bonds, he will get interest. From GDRs, he will get dividend. Both tax. But the investment should be made in foreign currency. Then the tax rate is only 10%. How much? 10%. Whereas long term capital gain, tax rate is how much? 12.5%. Other incomes are taxable at normal rates. Indexation benefit is not available on long term capital gains for computing. Interest, dividend, GDS on bonds is the, okay, on them, simple things are, you cannot claim any expense as deduction, either PGBP or even IFOS, and even chapter 6A deductions are also not allowed. If they are having any other incomes on them, chapter 6A can be claimed. Okay, only interest, dividend on bond, GDS, only these two are there, sir, interest, dividend or long term capital gain, and TDS has been deducted, then you need not to file even written off income. Okay, in the course of amalgamation, when the bonds or GDRs are transferred to new entity, then even with the new entity also same concessional rates are applicable. So 196C, the relevant TDS section. Any person paying interest, what is the TDS rate? 10%. Long term capital gain 12.5% on what? GDRs or bonds. Okay, bonds issued by whom, sir? Notified companies. Then 115 AD. Sir, with this, sir, most of our sections are being completed, sir. Special tax rates. 115A. What are our special tax rate sections, sir? 115 AD. These are the 4, right? Okay, so now we are into what? 115 AD. Now here the income is received by what? Foreign institutional investor or specified fund. Sir, if you see 115A is for non-resident. 115 AC is also for non-resident. AB is for offshore fund. OFF, offshore fund. AD is for foreign institutional investors or specified funds. Foreign institutional investors. Sir, this offshore fund, this is a foreign bank or insurance company or some kind of mutual fund which is there in foreign. Foreign institutional investors also, they'll invest in a group like those only, institutional investors, so banks and all only. And specified fund, a mutual fund in the foreign country. Okay, those people earning what again?
Dividend or
interest or dividend from what? MGR. Sir, MGR, if you remember previously, municipal debt funds, government securities, and even rupee denominated bonds, then the tax rate is like
5%.
194 LD. Okay, if it are like foreign institutional investors, okay, if they are earning interest and dividend by a foreign institutional investors, 20%. If they are getting interest dividend from specified fund, 10%. Sir, understand? The one who is receiving interest, okay, is what? Foreign institutional investor, specified fund. They are earning interest on MGR. MGR means what? Municipal debt funds, government securities, rupee denominated bonds. Then the tax rate is 5 only. They are not MGR, others. Then for foreign institutional investors, tax rate is 20%. For specified funds, tax rate is 10%. Then they are having long term capital gain, 12.5%. Then they are having other short term capital gain also. If it is referred under 111A, 20%, others now the tax rate is like 30%. So they are not saying slab rates, they are saying what? 30%. Okay. Expenses of PGBP not allowed. Chapter 6 deductions not allowed. Indexation not allowed. Return filing has to be made. Even TDS has been deducted. Understand, sir? So what is 115 AD? Income received by a foreign institutional investor or specified fund from MGR, municipal debt funds, government municipal debt securities, government securities, rupee denominated bonds, 5%. From others, FI on interest dividend incomes, it is like 20%, specific fund 10%, long term capital gain 12.5. Here, sir, for a short term capital gain also there is there. Covered under 111A. 111A what? Listed equity shares, units of equity oriented fund, units of business trust, 20%. Others 30%. They can't claim any expense as deduction. Chapter 6A not allowed, indexation not allowed, return filing is required here. Then 195, sir, the normal general TDS section. Any person paying any sum chargeable to tax except a salary to a non-resident, TDS at a rate in force during financial year has to be deducted. Okay, it's not general rates now, that whatever the relevant section applicable, that rates. Then TDS has to be deducted. However, if recipient wants to get a tax at lower rate, then he has to apply or submit in form 13. Then 196A. What is 196A? TDS on income in respects of units to non-resident. Where any person is paying income on units to a non-resident foreign company or non-corporate non-resident, either from mutual fund or UTA, TDS is at a rate of 20% or DTAA, whichever is lower. See, sir, any person paying income from units to whom foreign company or non-corporate non-resident. Non-corporate non-resident, other than companies, nothing but. Okay. On what they are paying, mutual fund or UTS, then the TDS rate is 20%. However, there is an exemption also, sir. No TDS on income from UTI paid to non-resident Indian or non-resident HUF, where the units acquired from NRE account. Okay, that's not much important for us. Next, the last one, sir. 115 BBA. Okay. TDS related, I am explaining, sir. The same tax rate will be there in the 115 BBA also. Any person paying to a non-resident, this non-resident is what? So paying for what? Participation in a game, advertisement or contribution to a game, sport or newspaper or magazine. Either he directly participated in games or he got some fees or prize money. He acted in an advertisement, he is getting money. He is explaining about him, he is giving some content to the magazines and all, there he is getting money. He is a sportsman plus non-resident and what? Foreign citizen. Okay. Then second one, An entertainer na, he's a foreign singer sir, foreign dancer. He is getting through advertisement, contribution in newspaper, or for participation in an event. No, participation in an event. Okay, then he will be getting some income. That is here. Or a non-resident sports association. Sir, understand? Now India South Africa series is going on and the matches are organized in India. Sir, why South Africa board has to agree, sir? If the matches are conducted in South Africa, then South African board will get the revenue, right? The streaming revenue, or even the stadium related match fees and all, they'll get, right? Why they are allowing, why they are accepting to be the match to be conducted even in India? Because whatever the revenue BCCA will earn, not BCCA sir, BCCI will earn, from there they'll share certain percentage to the South African board also. If World Cup organized na, then a share will be given even to the ICC also. So like that, for any organizing any game sport organized in India, if any share is given to sports association on all these, the rate of TDS is what? 20%. That's what even said in the 115 BBA also. Tax rate is what? 20%. On this also, PGBP IFOS related expenses not to be claimed. Chapter 6A not to be claimed. Return also not required if TDS is deducted under 194E. On lottery, puzzles, etc. If they are having incomes like lottery, puzzles, casual income, then tax rate is like 30%. There also no expense can be claimed as deduction. Okay, sir. I hope we got all the points, sir. Clear, huh? Sir, unless you could recall the tax rates, don't go to the sums and just test your patience. You should remember, sir. There is nothing hard to understand, because I hope I have explained it well only. Now you need to revise it 1 or 2 times, write on your own, close your eyes, recall it number of times. Okay, so in this last moment also spend 1 hour time, efficient 1 hour time. Try to recall, write a summary on your own. Okay, write multiple times the summary on your own, then you will remember. Okay, then you will remember. With this only, most of the times a 7 marks question we can answer. Okay, let me show you, solve some questions, sir, because there is a mistake in June 2025 exam solution given by institute, even BCCA answer also. Okay, so let me show you questions on this, sir. Question number 3. Roger, a foreign national, furnishes the following data for the previous year ended 31st March 2025. Royalty from an Indian concern. Sir, Roger is a foreign national. Okay, foreign national. Sir, we have discussed 2 chapters, chapter 12A, chapter 12. First we discussed this chapter 12A. We solved sums. That points also will come now. You cannot simply ignore that. Chapter 12A, what we said? Non-resident individual, citizen of India or person of Indian origin. He is not citizen of India, so that is not applicable. Furnishes the following data for the previous year ended 31st March. Royalty from an Indian concern under an agreement approved by the central government. So royalty 115A or 44DA. Anything will come. 115A or 44DA. We need to check PE is there or not. Expenses there. Okay. Interest from Indian company on money lent in foreign currency. Expenditure on collection of above interest, gross sale of business in India, expenditure. Sir, they didn't said like, sir, whether he is having PE in India or not. Sir, again, one more point, sir. We'll check PE concept to a company and all. Here he is an individual. So, the straight away, which section is applicable here? 115A. Any expense can be claimed, sir, 115A? No. What is the tax rate under 115A? 20%. Then, interest from an Indian company on money lent in foreign currency. Sir, again 115 only. One side royalty, the other side what we have discussed, interest, dividend and all. Infrastructure debt fund 5%. Indian company or business trust. Okay, if they are giving that also, when sir rupee denominated long term borrowings or rupee denominated bonds, then the concessional rates applicable. Now that also if it is listed in IFSC only 9%, otherwise 20 only. So it is not a business trust or given by Indian concern also. So it comes under what? Others category. Others category, it is again what? 20%. Expenses allowed or no? Expenses can't be allowed. Then 5th one, sir, he is having a gross sale of business in India. Sir, normal business in India. For that he is having income expense of 28. Sir, for normal business and all, we'll calculate normally only. So 30 minus 28, na here 2 lakh, which is taxable at what rate? Slab rates. See, profits and gains 30, from there 28 lakhs, not 2 lakhs. Royalty income 3 lakhs, no expense. Interest income 11 lakhs. So total 16 lakhs. But I am saying, sir, tax rates also. For 2 lakhs, what is the, for 2 lakhs, we'll apply what rate? Slab rates. Okay, on this 3 lakhs, what we will do, sir? We'll apply 20%. On this 11 lakhs also, we'll apply 20% as the tax rates. Then question number 4, sir. Total income of a non-resident Indian includes investment income 50,000, long-term capital gain 25,000 of a non-resident Indian, sir. Who is he?
Non-resident.
Non-resident Indian. Covered under what? First one. Chapter. Okay, 115E will come into picture, tax rates. 115E. Investment income taxable at what rate, sir? Long-term capital gain 12.5%. Investment income 20%. Other income taxable at normal rates only. What will be the tax payable considering chapter 12A? Investment income 50,000, 20%. Long-term capital gain 12.5. Okay, sir, you could see here there is no first 1,25,000 exemption, and other income 3,15,000, 3 lakh into nil, because slab rates na first 3 lakhs nil, balance 15,000 into 5%. Okay, sir, why 3 lakhs, sir? It is only 2 lakhs, sir. They are following default regime, nothing mentioned na default regime. Default regime, what is the basic exemption limit? 3 lakhs. Question 5. Compute the income tax in the following cases. Royalty of rupees 10 lakhs received by a foreign company from an Indian concern in pursuance of an agreement approved by the central government in the previous year. So did they mention about PE? No, then obviously it is what? 115A. 115A na what rate? 20%. Then 10 lakh rupees long-term capital gain received by an overseas financial organization on transfer of unit. 115 AB. Offshore fund na 115 AB. What is the rate? 12.5%. Okay. Sir, if you remember the sections, straight away applying only. There is nothing like you missing here. Okay. So there is no much kind of analytical skills to be used. It's more of memory skills only. Sir, but I'll say, if you are a serious preparation student and if you don't want to take any chance in the exam, then this memorizing only you should do, because this is, if you put more effort, obviously you will remember everything. Then in exam, you could straight away answer the question. So in exam, your common sense or other extra things not required here. Pure understanding the concept, memorizing the tax rates. Which section will come, which section not come. A non-resident foreign company, look at this one, sir. A non-resident foreign company has a PE in India in respect of which royalty 101 lakhs was earned from an Indian company in pursuance of an agreement dated 10th June 2016. Sir, it has a PE. PE related royalty income is there, 101 lakhs. Sir, if the royalty income is related to PE, which section will come into picture? 44DA. What will say? Normally PGBP wise only will calculate. I mean expenses can be allowed. From 101 lakhs, subtract this expense 12,37,600. Okay, on that calculate the tax. Which, sir, it is a company. Normal rates. For company, what are the normal tax rates of foreign company? 35%. Okay, so 35% plus 4%, it is like 32,25,910. Sir, somebody might be thinking of, sir, why surcharge is not calculated? Sir, income 88 lakhs only. For foreign company, surcharge will come only when the total income is more than 1 crore, 2%. About 10 crores, 5%. See, question number 7. The net result of the business carried out by a branch of a foreign company in India was 30 lakhs. After debiting head office expenses. Okay, sir, this point, this concept is not yet discussed, sir. We'll discuss it afterwards. Question number 8. That also not yet discussed. Presumptive scheme. Question number 9 we can solve. John Smith, a non-resident football player and non-citizen of India, participated in an exhibition match and received the following. Sir, prize money for participating in a game. What is the tax rate? 20%. For contribution in a column in sports magazine, 20%. For appearing in a commercial brand, 20%. Expenses can be adjusted, nothing. So straight away all of them have to accept at what rate? 20% plus cess, 4,78,400. Question number 10. Ramesh, a non-resident Indian. So what chapter?
Chapter
12A will come into picture. Okay. Has the following incomes during the previous year 24-25. Income from house property, normal rates only. Dividend from Indian companies. Dividend from what? Indian companies. So did they mention like they invested in foreign exchange assets and all? Nothing. Sir, for one point if they mentioned like subscribed clearly in foreign exchange assets, for others they didn't mention. This is also what? Normal rates only under which had IFOS. Interest on debentures of an Indian company subscribed in convertible foreign exchange. What is the tax rate we can take, sir? 20%. Then long-term capital gain on sale of debentures. Sale of debentures also covered, sir. Okay. Sale of debentures, so it should be what? Indian Public Limited Company. So what is the sale consideration? 7 lakhs. From there we should subtract what? Commission to broker. How much?
8,000.
6,92,000. From there cost of acquisition 4,50,000. If you subtract, how much? 2,42,000, which is taxable at what rate? 12.5%. So now see 3 lakhs, 2,42,000, and then dividend 80,000, and interest on debenture not allowed. Total how much, sir? 3,80,000. Okay.
3,20,500.
So this is an expense. Correct only. 1,20,000 and then 2,42,000. 7,42,000. So what is the tax they did? Long-term capital gain 12.5. Tax on interest on debentures like 20%. Super. Then on the balance 3,80,000 house property and this other 80,000 taxed at normal slab rates. Sir, I hope you are getting the points now quickly only. Techno, a German company, received 4.5 crores as fee from technical services from Krishna Limited, an Indian company, under an agreement approved by the central government. Expenses incurred are 35. They are giving two options. Have PE, does not have PE. Sir, what is the point? If it is having PE, not having PE, straight away 4.5 crores into 20%. Okay, if it is having PE, 4.5 crores minus 35%, and it even taxable at a normal rates. Normal rates, it's a company rate 35%. See, we'll look at the answer also. Okay, so they give another option points also. Fee from technical services 4.5, 35, and even having fee from technical services from other Indian companies under approved agreements 2.8, expenses 30, expenses not related to PA 15, amounts paid to HEI not reimbursement also. So both these expenses got to be claimed as deduction. 4 crore 50 lakhs, fees from 2 crore 80, total 7 crore 30, expenses not deductible on 7 crore 30, 20% now 1 crore 46 lakhs, surcharge because the total income is more than 1 crore, so percentage, tax plus surcharge plus cess, done. Then if you see here 44 DA, then what? From the total income they can claim expenses. What are the expenses are they having? 30 lakhs is relevant to the foreign one, 30 lakhs is related to the Indian one. So total they claimed as expense, then 6 crore 65 lakhs on the 35% plus surcharge plus cess, then 2 crore 49. Which is better, sir? In first option only better, 1 crore 54 lakhs. Then December 23 exam, sir. Sir, please be focused only. Wesley, a non-resident. Wesley, a non-resident. Did they said like non-resident Indian? Okay, fine. Furnish the following information related to. So chapter 12 we need not to focus. Only chapter 12. Okay. Interest on deposits with limited companies in India. Interest on deposits with limited companies in India. Sir, did they said like foreign exchange asset? Did they said like foreign exchange asset or in foreign currency? Sir, when 115A will come? When the amount is loan is given in foreign currency and the interest they are getting, then 115A. Here they didn't mention like the loan is given in foreign currency. So what we should take? We should usually take what? Normal rates. Okay. Short-term capital gains from sale of shares in listed companies, securities transaction tax paid. It is also normal rate. So short-term capital gain from sale of listed equity shares na 20%. 112A. Sorry, 111A. Normal capital gain provision. Then long-term capital gain from transfer of a specified foreign exchange asset sold on 1st June 2024. The long-term capital gain is computed figure. Note, expenditure incurred wholly in connection with transfer 17,000 but has not been deducted while computing the capital gain. So what you should do, sir? First you will take again what? 6,67,000 from their expenses. Long-term you can, capital gain related subtract
17,000.
6,50,000.
Interest on deposits.
Sir, but actually the question is like, they are not specifying whether he is an individual or not. But he is a non-resident individual only, but the point didn't specify is like he is an Indian citizen or person of Indian origin or not. But if you look at the question, he has a foreign exchange asset purchased, on that long-term capital gain is there, and again he invested in another foreign exchange asset, public limited company India share. 115F there is an exemption. That exemption related, okay, but for claiming that exemption the investment has to be made within how many months? 6 months from date of transfer. So what is the 6 months date, sir? 1st June 2024. From there 6 months now, June, July, August, September, October, November. But this fellow invested with by 22nd November only, so he can claim what? 2,10,000 as what? Exemption. Sir, here in this question the first thing is like, the question, exam question also, but it missed clarity about whether he is an Indian citizen or person or not. They claimed an exemption actually, but as a student it's absolutely fine. But examiner whether they give marks or not, fine, but I am giving you the confidence that usually happens. Don't think like, see, after practicing so many times also, why I am doing this thing. See, here the question lacks certain clarity. What? He is a non-resident individual only, but there is no clarity about whether he is an Indian citizen or person of Indian origin. So since that is missing, the problem is what? We may ignore here this 2,10,000 exemption. But they solved under an assumption like he is an Indian citizen or person of Indian origin. Okay. Sir, again one more thing also. Sir, if that is the case, I can assume like this is in foreign currency also, na? Yes, that could be that, but usually don't take, if nothing is mentioned, don't assume yourself as like he is invested in foreign exchange asset or the loan is in foreign currency loan. Okay. So 2,10,000 normal rate. Sir, able to understand now? I am again explaining here. So look at this point, sir. Wesley is a non-resident, age 56 years, furnishes the following information relating to the previous year 24-25. The question misses clarity about whether he is a non-resident individual being a citizen of India or person of Indian origin. Okay. So we are not sure about 12A, chapter 12A can be applied here or not. Chapter 12A now what? 115C to 115F, those sections. But still, sir, since we already know the answer, okay. Sir, there is a clarity, sir. I missed this point. As per chapter 12, they asked. Okay, chapter 12 we should apply. So we should assume him as what? Indian citizen and person of Indian origin. Okay, fine. Sorry, I didn't read that point. Then interest on deposits with limited companies in India. They didn't mention it as foreign currency loan. So normal rate. Short-term capital gain on sale of shares in listed companies, STD paid. Okay, this is comes under 111A because short-term capital gain is not addressed by 115A or there. So these are all taxable at what? Normal rate 20%. Then they are having a long-term capital gain 6,70,16 from their expenses. If you subtract 6 lakh from there, again this investment is made within a foreign exchange asset is transferred and the investment is made within 6 months. Then the long-term capital gain. Sir, actually here there is a mistake, sir. The point, okay, in the answer itself there is a mistake. The point is under 115F, the exemption is in proportionate to the investment made. Not how much ever they invested, that will be given as exemption. Understand, sir? So it should be in proportionate. Actually, correctly, if you solve now, you will not get 2,10,000 as exemption. Why?
Proportionate to
Long-term capital gain, but we don't. The problem is, sir, in the question we don't know what is the net sale consideration. He invested only 2,10,000. Fine, but long-term capital gain is 6,50,000.
50,000.
The amount of exemption is in proportionate to the net sale consideration invested. In the question, net sale consideration is missing. Okay, so in framing question itself, here there is a mistake. What they should have given net sale consideration at least. Then proportionate exemption we might have claimed. But since that is not there, this fellow claimed 2,10,000 as exemption. Okay, 4,40,000. So if you look at 11,10,000, first one, sir, first 2,10,000 normal rate, so claimed under basic exemption. On 4,60,000, 15%. Why 15, sir? So 20 I said na, why it is 15 na? The question here assumed like before 23rd July. If it is before 23rd July na, so here 15% is there na. This is like assuming before 23rd July. If it is after 23rd July na, what rate you should take? 20%. Same again on long-term capital gain also they taken 10%. Why? Before 23rd July. If it is after 23rd July na, we should take what? 12.5%. Okay. Do those corrections accordingly, sir, and then solve the answer. 12. Then 13. Dravid is a non-resident but an Indian citizen. He bought 10,000 equity shares, a listed Indian company for 5 shares. Dravid sold all the shares. Sir, Dravid, non-resident but an Indian citizen. 12A applicable or not applicable? Chapter 12A only. Bought 10,000 shares, a listed Indian company for 5 per share. Okay. Dravid sold all the shares for 770 per share. So what is the sale consideration, sir? 10,000 into 770, 7,70,000. But sir, he is an NR. Okay, he is a non-resident having foreign listed having a Indian share or Indian debenture. So proviso 1 of 48 is applicable. Has to be computed in foreign currency only. So what foreign currency rate we need to take to convert into dollars? As on the date of transfer, 12th June, what is the average rate? 76 and 78. 77 is the average rate. So 7,70,000 by 77, it is like 10,000 is the sale consideration. Any expenses given in the question, sir? No expense is given. So we should subtract what? Cost of acquisition. What is the cost of acquisition? He purchased 10,000 shares for US dollar 5 per share. Straight away given. We need not to convert it again. Subtract 5,000. So what is the capital gain, sir? Long term or short term? He purchased on 11th April 2022, sold on 12th June. More than 12 months. So long term only 5,000 long term capital gain. Okay. Now this long term capital gain again has to be converted into what? Indian currency. Okay, how much, sir? Indian currency again we need to buying rate on the date of transfer into 76. 5,000 into 76, how much? 3,80,000. From there exemption also, sir, 115F exemption will come because he sold a foreign exchange asset and then he is investing, bought 11,550 equity shares of another listed Indian on 13th June. 13th July. So 13th July na about how many days, sir? It is 12th June to 13th July, within 6 months only. How much? 11,550 into 500. How much?
57,75,000
11,550
into 500.
Ah. Then why we got capital gain here? Sir, 7,70,000 divided by 77 if you do. Here we did mistake. 10,000 into 770 is not 7,70,000. It is like 77 lakhs. 77 lakhs divided by 77 if you do, $1 lakh is the sale consideration. Okay. From there if you subtract cost of acquisition, how much? 10,000 into $5. 10,000 into 5 na, it is like 50,000. You subtract, it is like 50,000 is the long term capital gain into 76. Then what is the long term capital gain in Indian? 38 lakhs. So 38 lakhs. And the amount they invested is what? 38 lakhs is the long term capital gain. What is the sale considerations are? 77 lakhs. Did they invested whole 77 lakhs? No. They invested only 11,550 into 500.
57 lakhs.
So proportionate exemption only will come. So how much? 38 lakhs into, what is the amount of investment, sir?
57 lakhs 75,000.
57.75 divided by 77. How much? Okay, so here they calculated 28 lakh 50,000 they will get. Sir, then this fellow even invested in REC bonds. Sir, REC bonds investment, na, this is covered under section 54 EC. But 54 EC exemption will come where an asset transferred is a long term capital asset being immovable property including depreciable assets. But here it is a share, it's not immovable property. So 54 EC exemption is not available. So if you leave that, you will get long term capital gain 9,50,000. Okay, question number 14, sir, December 24 exam. This is related to presumptive. We will discuss afterwards. Then question number 15, sir, June 2025 question. Many are having problem with the June 2025 question, sir. They are not able to find out the correct answer. Suggested answer is wrong, sir. For sure, suggested answer is having mistake. So what? First, Jahir, an Indian citizen, resident of Germany. Jahir, Indian citizen. So 12A. Chapter 12A comes into picture. Long term capital gain is having 5,67,000 on transfer of foreign exchange asset on 12th August. Compute as per relevant provisions of Income Tax Act. As per relevant provisions of Income Tax Act. Long term capital gain. Long term capital gain is how much? 5,67,000. On this, any transfer related expenses is there, sir? No. But if you see straight away long term capital gain they have given. Then interest from notified government bonds. Interest from notified government bonds. Sir, the only point missing here is again, see, if you see non-resident individual, if he is having investment income from notified government bonds, nothing but securities of central government, investment income, interest, dividend, taxability rate of 20%. Okay, investment income. But provided, sir, that should have been invested in what? Foreign currency. Okay, they didn't mention, sir, whether it is invested in foreign currency or not. Okay, but still in answer they took 20%. Okay, we'll also, sir, previous question in December 23 question, they took it as what? Not in foreign currency. But here, even though they didn't mention, in answer they'll mention, they'll take it as like what? 20%. I mean, assuming it as like what? Foreign currency. This is the problem with December 23 question and June 2025 question. Okay. So, but I am giving, sir, it is an assumption that foreign currency. Okay. Then expense can't be adjusted. Then dividend from shares in Indian companies gross. Dividend from shares in Indian companies are taxable at normal rate. Normal rates. Then he has made an investment in shares of Indian companies also. What is the date of investment? 31st March. Sir, here for 115 F exemption we need to check what? He has made a sale on 12th August and invested on 12th March. August, September, October, November, December, Jan, Feb. After 6 months. So exemption is not available. See, then headwise if you go. First we will take what? Long term capital gain. How much is the long term capital gain?
5,67,000.
Taxable at what rate? 12.5. Okay. So many ask like again 12.5% on slab or else we need to gross. Need not to gross. It has to be on gross, sir. First 1,25,000 exemption is not available. In answer they have taken actually. In the suggested answer they have adjusted 1,25,000. Sir, in BCCA material the answer is wrong. Even in suggested answer material also answer wrong. So that's why 5,67,000, 12.5%. Then we are having what? Capital gain is done. Then we are having IFOS. In IFOS also we are having income from what? Bonds, government bonds. Assuming foreign currency loan. How much, sir? 46,000. Taxable at what rate?
20%.
20%. No expense is allowed.
Amount spent.
That can't be adjusted. No expense
Dividend
allowed.
from the shares of Indian companies.
Then dividend. How much is the dividend, sir?
80,000.
80,000. This is taxable at what rate?
Normal
Normal rates. Normal rates. Then TDS will adjust afterwards, sir.
Investment in shares not available.
Not available. Then any other point? Nothing, right? So if you see what is the total income of this person, sir? 5,67,000, 46 plus 80.
6,93,000.
6,93,000. Okay. Then long term capital gain 5,67,000 into
12.5%.
how much?
70,875.
On government bonds. Sir, 1 second, let me show you the suggested answer. I think they have taken 10%, sir, not even 20 also.
10%. And then they take 10%.
For B, right? 4B, sir, if you see, they have taken at a tax rate of 10%. Sir, if he is a non-resident individual, okay, let me show you the non-resident individual tax rate. Being an Indian citizen or person of Indian origin, he is having 20%, 12.5% and normal rates. Okay, see, just because he is a non-resident, you can check any other things also, either under 115A or 194 LCC. If you look at like interest, there is no 10% rate at all.
Yes, sir.
Okay, first of all, if you check where anywhere any 10% is there to interpret also. 194 LD, I mean 144 DA, then 115 AB. Here if you see income from units, but that is only to offshore funds. 115 AB. 115 A there is no 10%. 115 AB there is no 10%. 115 AC if you see tax on, okay, then 115 AC tax on income from bonds or GDS. What is the question point mentioned, sir? Oh, notified government. Okay, sorry, sir. Then we can invoke, it's a correct one only. Which section we can invoke here, sir? 115 AC. Okay. So this is not 20%, this is what? 10%.
10%.
Under which section? 115
150.
AC. And that also on assumption that it is what? It's a foreign currency loan. Okay, let me show you. Interest on bonds of Indian company. Oh, that also Indian company, sir. That's what I am getting. Okay, here what? No. This is not applicable. 20 only. Okay. Why 20 only? Because they said like government bonds. Here under 115 AC, government bonds are not covered. Those are only bonds of Indian company. So they took like 10%, but I don't had any point to connect it to 20%, sir. Okay, but subject to correction, sir, because I have referred wherever it is possible. There is nothing like 10% here. Government bonds is how much? 46,000 into 20%. How much?
9,200.
9,200. And then dividend 80,000 will be adjusted in basic exemption limit. Nothing. So the tax will come how much, sir? 70, sorry, not 79, 80,000. $175 is the tax.
80,000 75, sir.
Okay, plus cess at a rate of 4%.
3203.
So total it is like 83,000,
78.
rounded off to 83,280. This is what the correct answer, sir. But institute, okay, they already paid tax, sir, already. How much TDS is there for them? TDS already is there, minus TDS.
20,000, sir.
How much? 1,20,000. 720 is the refundable. Okay, refundable amount. Okay, but whereas the institute answer is like how much? 41,120, but I am not accepting the institute answer, sir. Okay. So, okay, so now we'll march into the next segment, presumptive taxation part. Okay, sir. Some people might be covering this with the PGBP part only, but for us, they are asking a separate question including this now, so we'll be discussing here as presumptive taxation part only. I mean, this is actually PGBP related part, but here NR related now we are discussing here separately. So how many sections are there with respect to PGBP? We have 5 sections, are 5 simple sections, 3, 4, 5, very simple sections. Out of them 3 are like similar only, another 2 are like similar. Okay, first we'll be discussing what 44B, 44 BBC, 44 BBA, B BBC, BBA, B BBC, BBA. And then here 49 BB and BB and B, triple B. Okay, this 2 belongs to one group, the rest like the blue color B, BBA, BBC is will belongs to one group. So now see, sir, all these are related to like transportation, sir. Transportation, like outside India or outside India to India, transportation, either using a ship or aircraft, either using a ship or aircraft. Out of them 44 BBC is like a newly introduced one, sir. Assessment year 25-26 related only, and not even tested in the last attempt also, I mean in June 2025. So there could be a chance of asking it also, so be sure. 44B, what does it says? Where an SSE is engaged in the business of operation of ships. He is a non-resident. Sir, SSE already we kept here, what, he is a non-resident and is into the business of what? Operating ships other than cruise ships. So what is cruise ships? Sir, these days like the cruise ships are being famous, right? So like there's like a vacation and all, 4 days, 5 days, the people will go there as a part of some kind of vacation, and as a part of vacation the cruise will be moving from one place to another. The main intention of cruise is not to transport from one place to another. The main intention of cruise is to provide that recreational facilities and all. Okay, so business of operation of ships other than cruise. The deemed PGBP income, okay, for a shipping business, non-resident shipping business, what is the deemed PGBP income, sir? 7.5%. Sir, I think you remember the presumptive tax under PGBP, 44 AD, ADA, AE, okay. Similarly, this one, 44B, SSE, non-resident, engaged into the business of what? Ships other than cruise. Sir, cruise is covered under what? 44 BBC, okay. What is the PGBP income? 7.5% of turnover, sir. Okay, now what we should take it as turnover? Sir, first see, we should check like whether the goods or passengers shipped from India na outside India. If the passenger, understand sir, if the passenger or goods are shipped from India, wherever the freight is received, in India or outside India, take it in the turnover. Passenger onboarded or goods onboarded from India, Delhi airport, ship na Chennai port or from Mumbai port, okay, any Indian port, goods are shipped or passengers shipped, then 7.5% has to be treated as deemed income. Sir, what if they were like loaded or onboarded from outside India, then only the freight which is received in India you should consider. Understand, sir? Hello, are you able to understand? We should check what the ship where, I mean the goods or passengers where they have been onboarded. If they are onboarded or loaded from Indian port, the freight may be received in India or outside India, consider it. If the goods are loaded outside India or passengers onboarded outside India, consider such income only if it is received in India. If it is received in India. So from that particular amount, I mean for that particular freight, okay, if goods are shipped from Indiana or passengers onboarded from Indiana, take wherever it is received. Onboarded outside Indiana, take only when it is received in India. This total into 7.5% will be treated as what? Deemed income. Okay, so it includes carriage of what? Passengers, goods, stock, mail, all these. Okay, then 44 BBA, sir. We'll go to BBA, then we'll come to BBC. BBA is for what? Business of operation of aircraft. Okay, same aircraft also almost similar. Deemed PGBB income is like how much? 5% on what? Same. From any place in India, they have onboarded goods or the passenger onboarded from any place in India. So amount paid either in India or outside India, that amount into 5%. If it is from any place, if the passenger or goods onboarded from outside India, then only amount received in India you should consider. Sir, able to understand, na? Able to understand, like the simple points, sir. We should check where they were onboarded. If they are onboarded from India, then the freight may be received in India or outside India. Take it. If they are onboarded from outside India, take the freight only when it is received in India into 5% for whom? Aircraft. For ships, na, is 1.5% carriage of passengers, goods, livestock, mail. Okay, all this. Then 44 BBC. 44 BBC is about what? Business of operating cruise ships. I already said cruise ships are what? They will be providing recreational activities also, not just mere transportation. Okay, so deemed PGBP income is like how much? 20% of amount paid by such passengers in India or even outside India if it is related to India. Sir, they didn't framed it properly. Okay, just like as 44 BBA and B. So, okay, it was kept like that only. Amount paid by such passenger, whether it is paid in India or outside India, if such cruise is related to India. If such cruise is related to India, okay, so then wherever it is received, you will take what? 20% as the deemed profit. Okay, sir, if you remember, sir, 44 AD and 44 ADA, 44 AE, there SSC has an option to declare lower profits. I mean, if a person declares lower profits than that of the minimum profits to be declared under presumptive taxation scheme, audit is applicable. Audit is applicable there. Okay, but here there is no such option. If you opt for these sections 44B, BBC, BBA, you cannot show lower incomes even if you wanted to get your books of accounts audited also. Okay, so if you are under these schemes, you should pay minimum this percentage as, this percentage will be considered as minimum profit of you. Okay, even with audit or books of accountants maintenance also, you cannot show lesser profits than this. How much are here? Option to declare lower profits not available. However, sir, he is having 2 or 3 businesses. From the shipping business, which is computed as per 7.5%, if he has some other business loss, can he adjust? Yes. Sir, everybody will have a common question, this understand. Sir, I have 2 businesses. One business I opted for presumptive scheme, other one is a normal business. In normal business I have loss. Can I adjust that loss with presumptive profit? Yes, we can adjust. Even under 44B, BBC and even BBA is also it is applicable. Okay, so completed, sir, that section. 3 sections completed in no time. 44B, BBC, BBA. 44B is about what, sir? Ships. And even BBA is about what? Aircraft. Whereas BBC is about what? Cruise ships. Okay, first 44B. 7.5% will be treated as like deemed profit. Okay, if they are onboarded from India or shipped from India, wherever it is received. If it is shipped from outside India, only if it is received in India, such particular freight into 7.5% for goods, passengers, all those transportation. Okay. 44 BBA, aircraft. Aircraft related also 5% is the deemed profit on what? Freight. Like we need to again check from where they are like onboarded. From India, wherever the freight is received, 5%. Outside India, only if it is received in India, take 5%. Then 44 BBC, cruise ships. 20% where the cruise or the travel is related to India, irrespective of where it is received. Now we are moving on to the next 2 sections, sir. 44 BB and 44 BBB. What? We need to check whether service is in connection to supplying plant and machinery in hire to exploration of minerals, oils. 44BB is about what, sir? Service in connection to,
Supplying plant and
okay, or supplying plant and machinery, sir, in hire. Sir, exploration of minerals and oils. First understand, exploration of minerals and oils is their business. For that business, what you are doing, either you are providing services. Service night, that could be any kind of technical service. Sir, if you remember, sir, 44DA, there I said, if SSE opts for 44DA, then he cannot choose to be under 44BB. Here, service they are providing with respect to exploration of minerals and oils. That could be a fee for technical service. Understand? But still, they cannot opt for 44BB, sir. Okay, if it is connected to a PE in India, then we need to follow what? 44DA only. 44BB, what the services are provided in connection to exploration of minerals and oils. Okay, sir, I am a geologist. Okay, like who can survey or who can do extreme research over the land and can find out where the oil reserves are there and all. Now I will be coming to India. Let's say I am a Japan citizen. I came to India to provide those kind of services. Then I am providing services to a person who is into exploration of minerals and oils. Okay, and supplying plant and machinery in hire to a person who is into the business of exploration of minerals and oils. So understand, sir, what is my business being a non-resident? I will provide technical services to a person in India maybe. Okay, for what he is doing, he is into exploration of minerals and oils. For that person, I am providing technical service or providing machinery on hire. This business I am doing. Okay, so my business is like renting machinery or providing technical services to a person who is, sir, my business is not exploration of oil and gas. The one who is taking my service, the one who is taking my machinery on rent is into the business of exploration of oils and minerals. Then the deemed profit is like how much, sir? 10%. Okay, where we need to check whether extraction is in India na extraction outside India. Sir, I am non-resident. The recipient is resident. But we need to check where extraction is happened. If extraction is in India, irrespective of amount received in India or outside India, I mean my service fee, my plant and machinery related rent, whether it is paid in India or outside India, on that we need to take 10%. If extraction is outside India, you should take only if it is received in India. Understand, sir? We need to check where extraction. Extraction India na, outside India na. In India na, you will take what? Wherever it is received, take on that 10%. If it is extraction outside India, only if it is received in India, on that apply 10%. Understand, sir, this one?
Yes, sir.
Then 44BB. What is the business like? Construction, erection of plant and machinery with respect to turnkey projects
Provided by central government.
approved by central government. Certain turnkey projects which are approved by central government. For those projects, what I am doing? I am doing construction or erection of plant and machinery. What I am doing? Construction or erection of plant and machinery. Then what is the deemed PGBP income, sir? 10%. Amount paid or payable in India or outside India. On the total amount paid with respect to that project, 10% is the deemed profit. Sir, under these two sections, there is an option to declare lower profits. Whereas in the previous three sections, I said like what? Even with audit, books of accounts, maintenance also, they don't have option to declare lesser profits than that. That 7.5, 25%. But here in these two sections, these people, if they want to declare lower profits than this 10%, they can declare. But further, they need to maintain books of accounts and audit also has to get done. Then SSE opted 44BB. This is also important. No set off of unabsorbed depreciation. With this presumptive profits calculated, they can't set off any unabsorbed depreciation and even brought forward business losses. Understand, sir?
Yes, sir.
With this we completed presumptive taxation part 5 section, sir. Then 44C. This is with respect to deduction of HO expenditure, head office expenditure in case of non-resident. Deduction of head office expenditure in case of non-resident. So a non-resident can claim head office expenditure. Why, sir? Sir, here a non-resident is having a branch in India, or else like here non-resident income is getting taxed, business income. But the problem is what? Here whatever the income accrued that we are taxing. but the relevant expense is happening outside India. To earn business income in India, head office is collaborating with various people and all. So a share of head office expenditure is even related to the Indian income also. That's why head office expense is allowed up to this limit. How much is the limit given, sir? Here 5% of adjusted total income or actual expenditure of head office expenditure related to Indian business, whichever is lower. How much is allowed, sir, with respect to head office expenditure? 5% of adjusted total income or actual head office expenditure attributable to Indian business, whichever is lower. See, how to calculate adjusted total income? Total income before giving effect to. Sir, if they given net total income, we should add back all these items if adjusted. If already adjusted, we should add back. What we should add back? Head office expenditure add back, unabsorbed depreciation add back, unabsorbed family planning expenditure add back, capital expenditure on family planning, sir. Brought forward losses, if any, add back, sir, except house. Okay, brought forward losses, sir, which has to be added back now, related to PGBP and capital gains losses, we need to add back. If any other loss, no problem. If they are PGBP and capital gains related losses, add back. Chapter 6A deductions already adjusted, add back. Understand, sir? These losses you need to add back. Then you will get to the net total income. You should add back all this. Okay, then you will get what? Adjusted total income. What are those points, sir? Again,
Head office expenditure.
the head office expenditure, actual, whichever is there, add back. Unabsorbed depreciation, brought forward losses like business and capital gain related, unabsorbed family planning expenditure, and chapter 6A deductions. What is HO expense? The actual rent rate tax which they paid outside India, salaries, wages they paid outside India, traveling expenses of employees managing foreign office, all these will come under what? Head office expenditure. How much is allowed, sir? Head office expenditure? 5% of adjusted total income or actual head office expenditure attributable to Indian business, whichever is lower. So we'll be solving question on this, sir, so that if you have any questions also, any problem with understanding also will understand. So if you look at the NR taxation, we have discussed from the beginning. First question we discussed, second question discussed, third done, fourth done, fifth, sixth done, seventh one. See, the net result of the business carried on by a branch of a foreign company in India for the year ended 31st March was a loss of 30 lakhs after debiting head office expense of 60 lakhs. Sir, here it is about what? Head office expenditure. Already they debited how much? 60 lakhs. But so first we should calculate what? Adjusted total income. For calculating adjusted total income, they already debited head office expenditure. So we should do what? Add back. So to the negative 30 lakhs, if you add 60 lakhs, so what is the adjusted total income, sir? Sir, the question is like the net results of the business carried on by a branch of a foreign company in India for the year ended 31st March 2025 was 30 lakhs loss after debiting head office expenditure. That means already head office expenditure is adjusted. But we want adjusted total income like what? Without adjusting. If already adjusted, add back. So add back what? 30 lakhs loss. You add 60 lakhs profit. You will get how much? 30 lakhs net profit. 30 lakhs profit. So how much is the head office expenditure allowed? 30 lakhs into 5%, which equals to 1,50,000 or actual 60 lakhs, whichever is lower. Lower now how much? 1.5 lakhs is only allowed. So what is the total income, sir? Now after reversing this 30 lakhs is not total income, because head office expenditure 60 lakhs is not allowed, only 1,50,000 is allowed. Okay, so if you reverse the actually charge 60 lakhs because actually is disallowed. So when it is disallowed, now what you will do? Add back. So 60 lakhs added back. How much is allowed? Only 1,50,000. That if you subtract, you will have how much? 28,50,000 as the total income. Then question number 8. Mr. Z, a non-resident, operates an aircraft being Dubai. Sir, aircraft related now what? 44 BBA. 44 BBA. See, this is what? 44 BBA aircraft. Aircraft related, how much will take it as the deemed profit, sir? 5% on. So we should check from where the passenger is on board. He received the following amounts during the previous year: 3 crores received in India. Sir, blindly we can say what? If it is received in India, always taxable in India.
Okay.
So this 3 crores, 1.5 crores received in India, 2.5 crores received in India. So this is taxable, this is taxable, this is taxable. Okay. 0.5 crores received in outside India. But even though received outside India, if the passengers or the goods are onboarded or shipped from India, then it is taxable. Here what goods are garage of goods from where? Delhi. That means this is also taxable. So total 4.5 7.5. So 7.5 crores into 5%. No expense is allowed as deduction.
3,000.
Okay, sir, this expense is not allowed as deduction under presumptive taxation scheme. No expense is allowed. So 7.5 crores into 5%. What is the taxable income, sir? 37 lakh 50,000. 37 lakh 50,000. Okay, then question number 9 we already discussed. 10 discussed. 11 discussed. 12 done. 13 done. 14. Yeah, 14 I think we can do now. Paul, a foreign company is engaged in the activity of civil construction at various construction locations in West Bengal in connection with turn power projects. That means if you see here, sir, 44 BBB. Okay, sir, one more point here also add turnkey power projects. Power projects. Okay, see that is related to that one. And so that means here it is what 44 triple B. 44 triple B. He is also engaged in the provision of consultancy services which is done through a branch office located in Chennai. So it has turnkey power project and even another. There is no administrative or finance nexus between branch office at Chennai and civil. That is different. This is different. Which was managed from outside India. From the financial year, it furnishes the following information. Gross amount received in India from civil construction. How much, sir? 60 lakhs. Outside India, sir. Received in India or outside India, both are taxable. Okay, so
30 lakhs.
no expense is allowed. So 90 lakhs into 10%. How much it is like 9 lakhs.
9 lakhs.
Amount spent in relation to civil construction projects in India referred above not allowed. Gross amount in received in India as fee for technical service in relation to providing consultancy to Indian company. Sir, this fellow is what? He is a non-resident. He received royalty or fee for technical service from Indian companies. 115A. 115A. Taxable at what rate? 20%. Okay, amount spent in related to providing technical consultancy, no expense is allowed. So 90 lakhs is taxable at
Technical service, technical consultancy.
okay, sir, here let me, okay, one more point, sir, let me check you here. Why it is not covered under 115A? Let me show you. It comes under 44DA also. See, the point we need to royalty fee for technical service means we need to check 2 points. Whether it is related to PE in India or not. Here, if you see, he is also engaged in provision of consultancy service which is done through a branch office located at Chennai. Branch office there in Chennai, na, then they are having what? PE, permanent establishment. Sir, able to understand, na?
Yes, sir.
So this, whatever the 2 lakhs they have incurred as royalty fee for technical service, either it should be taxed under 115A,
Or else
44DA. If there is no PE, then 115A. But here there is PE, na? So 44DA. What does 44DA says? Normal rules only. So that means for 2 lakhs you can allow expense. How much is the expense incurred? 70. So under 1,30,000 is taxable at normal rates. And even this presumptive profit 9 lakhs is also taxable at normal rates. So what is the total income? 9 lakhs and 1,30,000. Total it is like 10,30,000. Okay, it is a foreign company now. What is the tax rate? 35% is the tax rate. No surcharge rate. Set at a rate of 4%. Okay, then 15 is not related to this. 16, sir. Question number 16. 15 also we already solved, right? June 25. Yes, 16. Question number 16. A non-resident is having a branch office in India, submits the following information relating to the branch. Net total income 30 lakhs. Chapter 6A. Sir, net total income now already adjusted all this. Chapter 6A deductions. Then brought forward business loss from house property, unabsorbed depreciation, expenses reimbursed by branch to head office. Sir, first we need to calculate what? Adjusted total income. So for what and all we need to add first head office expenditure we need to add back 3 lakhs. Then chapter 6A deductions we need to add back 2 lakhs added. Brought forward business loss add. Sir, brought forward losses PGBP or capital gains related only we need to add back. House property loss we need not to add back. And then unabsorbed depreciation 1,50,000 also we have added back. And how much? 33, 35, 36, 37 lakh 50,000 is the adjusted total income. So what? How much is allowed? 37 lakh 50,000 into 5% or actual 3 lakhs whichever is lower. Sir, which is lower, sir? 1,500. So that is lower. That is only allowed. Okay, so amount disallowed is how much? 3 lakhs minus 1,87,500. So which is 1,12,500 is disallowed. So the disallowed amount we are adding back to the original 30 lakhs. Original 30 lakhs. So how much is the total income? 31,12,500. Okay, done. Question number 16. Question number 17. USA Airlines Incorporated as a company in USA operate its flights to India and vice versa and collected 150 lakhs for carriage of how much it collected, sir? Overall 150 lakhs. Okay, out of which 90 was received in US dollars for the passengers fare booked from New York to Mumbai. Okay, 90 lakhs was received in US dollars, sir. Okay, so but sir, even though it is received in dollars, sir, even in India also it could be paid in dollars. So here for this 90 lakhs we are not sure, sir, if it is received in Indian rupees now, obviously it is from India only, no problem. If it is received in dollars now, then we are having two questions, whether it is received in India or outside India. And if you look at there, for carriage of passengers and cargo 90 lakhs, for fare booked from New York to Mumbai. Sir, New York to Mumbai na, where the passengers boarded outside India. This 90 is taxable only when it is received in India. Whereas the balance 60 passengers onboarded from India, so that is already taxable. So that's why 60 lakhs into 5%, 3 lakhs. This 90 lakhs are two options we have taken. If received in India na, into 5%, 4 lakh 50. If received outside India na, nothing is taxable. Okay. Then question number 18. This also we can solve, sir. Mr. Crone, a non-resident, gives you the following information for the year ended 31st March 2025. Interest from government securities. Sir, interest from government securities. Taxable under what? 115A only. See, let me show you once again. 115A, where a foreign company or non-resident receiving. Okay, let me show you clearly. Not 115A, sir. Government securities, na, it's like 115A only, provided they should have invested that in what? On 15AD. 115A only, sir. It doesn't come under chapter 12 because they didn't mention here whether he is Indian citizen or not. But let me show here. Compute total income of Crone assuming that he has opted for old regime. Okay, they didn't mention like him. So only 115A is covered, sir. That also assuming he has invested in foreign currency. So 21,000. Taxable under which section? 115A, 20%. Dividend on share of foreign company received abroad. Sir, share of foreign, he is a non-resident. Share also outside India, received also outside India. So income accrued, received both outside India, not taxable at all. Then interest from deposits in Indian companies. Sir, here by looking at this point, sir, it seems like what? Like NR taxation, non-resident individual related taxation only. So this is also under 115E only. This is also under 115E only. Interest from deposits in Indian companies taxable at what? 20%. This also taxable at 20%. Income from horse races in India 115BB. Taxable at what rate? 30%. Okay, he has donated a sum of, sir, they said like what? Opted to old regime only. He has donated a sum of 10,000 to Municipal Corporation of Delhi for promotion of family planning. Sir, 80G deduction. Under 80G there are 4 categories of deductions. This comes under category 3 of 80G. Category 3 of 80G, what does it say? total adjusted total income into 10% is the qualifying limit. Okay, actual amount contributed or 10% of qualifying limit, whichever is lower. So first we need to calculate total income for. Okay, then he has paid 2000 by check to New India Assurance for Mediclaim for himself. Sir, medical insurance premium paid allowed, sir, under 80D 2000. He also spent 16,000 on medical treatment of his minor son who is physically handicapped. 80DD. 80DD is not available to non-residents. Okay, so if you look at here, sir, what is his gross total income? 21 on government securities, company deposits 30, winning lotteries 20, total 71,000. From there, if you subtract the 80D alone first, you will get what is the gross total, adjusted gross total income, sir? 69,000. Into 10% na 6,900. So even though he contributed 10,000, the deduction with respect to municipal corporation is allowed only up to 6,900. So subtract that 6,900 also. How much, sir? The total income is like 62,100. 62,100. Right. Then I think question number 19 we can't solve now. Question number 20. Yes, we can solve. Ian Morgan, a foreign national and cricketer, came to India as a member of England cricket team in the year ended 31st March. He received 6 lakhs for participation of matches in India. Sir, 6 lakhs for participation of matches in India. 115 BBA. 115 BBA. What is the tax rate? 20%. For advertisement also, same 20%. For contributing in a journal, how much? 15,000. How much? This is also 20%. He also won a lottery 10,000. 115 BB. 30%. 30%. So 20%, 20%, 20%, and then the other one is like 30%. He has no other income in India. Compute tax liability. First we'll add all of them, sir. 8,25,000 on this tax rate, which are covered under BBA 20%, BBB 30%. Total tax is 1,66,000. Plus cess total 1,78,640. No complication at all. But that alone is not the question. Compute tax liability is only one part. Second part, are the income specified above subject to TDS? Yes. Okay, section 194E is the TDS section applicable to non-resident sports person entertainments or sports associations. What are the TDS rates? The same tax rates are only the TDS rates also has to be deducted. That is done. Third one, if is he liable to file return of income? Sir, if all the incomes, if a non-resident sports person is only having incomes under 115 BBA, 115 BBA, na, what are the incomes? For participation in a game, for participating, for acting in any commercials, advertisements and all, or for contributing to any magazines. That alone income is there and TDS is deducted, then he need not to file return of income. But here he is having lottery income also additionally, which is covered by 115 BB. That's why he doesn't have the exemption from filing return of income. He has to file the return of income. Okay. Next, what would have been his tax liability if he has been a match referee? Okay, this is also important point. The Calcutta High Court in Indicom held that match referees will not fall under the meaning of sportsman. Since they does not fall under the meaning of sports person, therefore although the payments made to non-resident are income, which income accrues the same or not taxable under the provisions of 115 BBA. So if they are not taxable under 115 BBA, then under the normal rates only. Okay, so on lottery income alone special rate 3,000, the rest on slab rates only. It comes under 81,640. Then question number 21 also I think we can solve, sir. Yes. McFern, a non-resident and German citizen, is employed in what? German company. So is a non-resident. The German company has PE in India and accordingly the income of the PE is chargeable to tax in India. Okay. This fellow visited India on official work and stayed in India for how many days? 83 days. For these 83 days he earned salary of 23 lakhs. That means his salary, where sir, where he earned this salary? India. So salary accrued in India. So taxable in India. Even though he is non-resident, this is accrued in India. This 23 lakhs taxable in India. From there, we should avail what? Standard deduction 50,000. So the taxable salary is how much? 22.5 lakhs. Standard deduction 50,000, sir. Salaries, if you remember.
Yes, sir. 75,000.
75,000 if he has opted for
115 BS.
Yes. Then next point, sir. See, McPhone held 1500 shares of Brunda Bonax Private Limited, an Indian company, since 29th November 2017. When he acquired for 12 per share, for acquiring the shares, he remitted US dollar 50,000 to India. He sold these shares at 45 per share. Sir, this is what?
TDPR.
Okay, the point is what? Proviso 1 is applicable here, sir. Proviso 1.
For section 48.
Why proviso 1 is applicable, sir? Because what does proviso 1 of section 48 says? Like, where a non-resident sells an Indian company share or Indian debenture, then it has to be computed in foreign currency only. He sold for 45 per share. How many shares? 1500. So 1500 into 45, how much?
67,500.
67,500. But on the date of sale, 25th June, what is the average rate? 89 by plus 91 divided by 2, 90. So 67,500 divided by 90, if you do, you will get the, are you able to understand, sir? 67,500 is the Indian value sale consideration. Okay, that we need to convert into foreign currency. Okay, by using what? The average rate as on the date of transfer. On the date of transfer, what is the rate? 89 plus 91 divided by 2, 90. So if you divide this 67,500 divided by 90, how much?
750.
750 is the sale consideration. There is no transfer related expenditure. Okay, then when he acquired, sir, he acquired those shares at 12 rupees per share. So 1500 into 12. On the date of transfer, what is the date of acquisition? What is the average rate, sir? Acquisition is made on 29th November. On 29th November, the average rate is 80. So divided by 1500 into 12 divided by 80. 1500 into 12. 30,000 divided by 80. 225. So if you subtract, how much is the long term capital gains, or long term or short term a year? 29th December. Long term only. 750 minus 225. $525 is the long term capital gain. This again we need to convert into Indian currency. Using what rate? Buying rate. Buying rate is what? On the date of transfer, 89. So $525 into 89, if you do, wasn't 725. So salary 22,50,000. Long term capital gain 46,725. Next, third one. McPhone also held 2000 equity shares of Telecom or DT, a German company which he has acquired. Sir, it's what? A German company, and he is a non-resident. Has acquired 145 per share and follows April to March financial year. He sold all these shares. Sir, he has a capital gain arising on sale of which company share? German company share, and he is a non-resident. So, sir, share is German company. That means accrued outside India, he is a non-resident. So since he is a non-resident and that is accrued outside India, it is not even taxable. This is not even taxable. Why? That is a share from German company and is a non-resident. So it is not taxable in India. So we need not to calculate anything regarding it. Then they have given other details also. Total value of assets 15 crores. Total value of immovable property relevant. Immovable property held in India relevant. Then dividend from that German company, dividend from German company, usually not taxable in India, accrued in India only. But see, it was received in India. So read the point. Dividend from German company received in India. If it is received in India, it is taxable in where? India. So consider it under IFOS 1,15,000. So then the total income is 24,11,730. Okay. So now, sir, we have completed most of the parts, sir. In exams, mostly this part only being asked. Now we are going into our third area. Third area, residential status. In residential status also, sir, from here, like the basic conditions and all, it will not take for you much time also. Like inter level, that conditions only. Two areas where they could ask a question is like, one is relevant to active business outside India, company related. Active business outside India is relevant to determine place of effective management for a foreign company to decide whether it is resident or non-resident. So okay, so this is one area. Second one is about interest royalty fee for technical service will be considered as deemed to be accrued in India. So that point, interest royalty fee for technical service, when they will be considered as deemed to be accrued in India. So this part is also having significant. Okay, there are some chances of asking it in the exam. So now sir, individuals sir, I will not spend much time regarding individual non-resident status because that everybody know. Okay, again I don't want to stretch there and waste our time. Residential status of individual. Sir, an individual sir will be called as resident if he satisfies any of the one of the two basic conditions. If one basic condition is satisfied, then again we'll go and check the additional conditions. If both the additional conditions are satisfied, then he is ROR, otherwise NOR. If both the basic conditions itself not satisfied, then he is called NR. Okay. What are the basic conditions? His total period of stay in India should be 182 days or more in the relevant previous year, or 60 days in the previous year and 365 days in the 4 relevant previous years. Two conditions need not to be satisfied. If any one condition satisfied also is called as resident. Okay. For this, even if he stayed in territorial waters, that also considered as stay in India. Stay in India need not to be continuous. That means what? He may came for 10 days and again go back to outside India and again some 30 days and again he left India and again he is coming back, like that. In a period of intervals it could be there. All that you should count. If it is more than 180 days or more than 60 days, like that you need to count. Okay. Then both date of leaving India and date of arriving into India has to be considered as stay in India.
Yeah.
Exceptions. Exceptions now. What is the exception, sir? If he is a Indian citizen who leaves India during relevant previous year for the purpose of employment outside India or as a crew member. Okay, he is an Indian citizen leaving India as a crew member of Indian ship or for employment outside India. For them, we shall not check both the basic conditions. You should check only first basic condition. If he satisfies first basic condition, then only is called as resident. Okay, then. If he is an Indian citizen or person of Indian origin who came to India for a visit during the relevant previous year, he is an Indian citizen or person of Indian origin. He came to India for what? For a visit during the relevant previous year. Okay, sir, here there is like modified B2. If basic condition 1 satisfied, he is resident only. Okay, if basic condition 2 also, we need to check B2. If total income other than income from foreign sources, total income other than income from foreign sources. Sir, other than income from foreign sources, nothing but Indian source. If his Indian source income is more than, okay, within 15 lakhs only, then you just check the basic condition 1. If he satisfies, he is resident. Indian income, sir. Nothing but this table we are saying about what? Indian income. If Indian income is less than 15 lakhs, you should check only basic condition 1. If that satisfied, he is resident. If his Indian income is more than 15 lakhs, then what you should check? Check basic condition 1. If that satisfied, resident. Or else check the modified B2. What is modified? Usually basic condition 2 is what, sir? 60 days in previous year plus 365 days in 4 preceding previous year. Modified B2 is like 120 days in the previous year plus 365 days in the preceding 4 previous years. If this is satisfied also is called as resident. But understand, sir, if any Indian citizen or person of Indian origin who became resident because of modified B2, then irrespective of satisfying additional conditions, he is always treated as what? Non-resident. Sorry, RNOR, resident but not ordinary resident. Then additional conditions. What are the additional conditions, sir? He should be resident in India for 2 years out of 10 years. So let's say for previous year 24-25. For previous year 24-25, we need to check what? 10 preceding previous years. 10 preceding previous years, not 23-24, 22-23, 21-22, 20-21, like that 10 years. Or for all those 10 years, you should check the basic conditions.
At least 2 years.
At least 2 years if any of the basic conditions satisfied. Additional condition 1 satisfied. Then additional condition 2. Again, take 7 preceding previous years. out of 7 preceding previous years together, his total stay in India should be more than or equal to 730 days. Okay, then also, okay, that is the additional condition too. Here understand sir, it's not like basic conditions. Additional conditions both has to be satisfied. Then only is called as what? Resident and ordinary resident. Otherwise resident but not ordinary resident. Okay. Then there is a concept of deemed resident. What is about deemed resident? If the following conditions are satisfied, then the individual will be treated as deemed resident. What are those? He is an Indian citizen. He has total income from Indian sources is more than 15 lakhs. From Indian sources more than 15 lakhs. He does not satisfy any basic conditions and he is not even paying tax in any country because of resident rule. I mean, he is not a resident in any country. In any he stays in like 15 countries. In every country he'll stay for some 20 days like that only. Never he'll be resident of any country. Like that he is planning. So that he is not paying tax in any country. But he is an Indian citizen. Okay, since he is an Indian citizen and not paying tax elsewhere under the residential status category, okay, being a resident and his Indian source of income is more than 15 lakhs, then he is called as what? Deemed resident. Okay, no conditions or no number of days point here. He didn't stay in India for not even a single day also. But he is having Indian income more than 15 lakhs. He is citizen of India. He is not resident elsewhere. Okay, not even resident in India and not even paying tax elsewhere also being a resident. So his income is taxable in India being a deemed resident. But sir, even though he is deemed resident, he need not to be checked for additional conditions. He will always be treated as what? Resident but not ordinary resident. Okay, this is about individual. Then HUF sir. For HUF, you should check where the management and control of HUF is located. If it is either wholly or partly in India, then it is resident. Then for additional conditions, we will check Karta also. If Karta is a resident and ordinary resident, then HUF also ROR. Otherwise, HUF will remain RNOR. Then for firm AOP BOS sir, or any other person except companies. If the management is wholly or partly situated in India, resident. Otherwise, non-resident. There is no RNOR concept. For companies, sir, okay, so for companies, we should check whether it is a domestic company or foreign company. If it is a domestic company, it is always an Indian company. Always a resident. If it is a foreign company, domestic company, always resident. If it is a foreign company, also still it could be resident, provided if POEM is in India. Indian company, always resident. Other company, if POEM is in India, then it can be called as what? Resident. What is POEM? Place of effective management. Sir, out of this residential status, if any concept having the weightage or the having that worth of asking in question exam is like place of effective management. We'll solve an example also. I have borrowed it from the CA final material that will solve. Okay. See, place of effective management means a place where key management and commercial decisions that are necessary for the conduct of business of an entity as a whole are taken. Okay, sorry, in simple, here, let me write down. Place of effective management means where key management and commercial decisions, okay, where that effective management, okay, where that management, that decision making is happening, we need to check effective management and decision making as a whole, and that also sir not on record, in substance. Sir, actually I am the decision maker of a company sir, but I am not listed as a director. So usually directors will take decision, but they are for name sake only. I am the one who actually take decisions. Then over substance we should see, not which is there on form. Okay, so effective management in substance we should check where it is there. Okay, for deciding this, there is a test called active business outside India or not, we need to check. If active business is outside India plus key decisions also outside India, key decision making people, active business outside India plus key decision making people and decisions are also taken outside India, then it is what? Non-resident. If active business, not active business outside India plus Key decisions taken in India only. Then it is what? Resident only. Active business, no active business outside India. No active business outside India. Sir, we cannot call like active business inside India. Okay, we just call it as like active business outside India or no active business outside India. If there is no active business outside India plus key decisions are also taken in India, then it is called as what? Resident. So we should check what is called active business outside India. So look at this point, sir. A company shall be said to be engaged in active business outside India if all the following conditions are satisfied. What are those? Their passive income is less than 50% of their total income. What is the point, sir?
Their
Passive income.
less than 50% of its.
You need to remember this point, sir. Passive income less than or equal to 50% of passive income less than or equal. We should check what passive income is like less than or equal to 50% of total income. Passive income. Then passive income, sir, first point is what? Passive income should be less than or equal to 50% of total income. Sir, active income, passive income. Passive na, you are not doing much things like interest. You just deposit money there, you will get income. For that, you will not carry out any operations, except for banks, for normal people. Royalty, FTS also. You have developed some patent, then you are getting money. Now further earning patent and all, you are not doing any much activities and all. So active income, passive income. So how to calculate this passive income? See, passive income means the total of income from income by way of royalty, dividend, capital gains, interest, okay, or rental income. What are called passive incomes, sir? The passive incomes are nothing but the total of royalty. Sir, royalty, don't take fee for technical service, because fee for technical service na professional service and all. For that actively we should participate. Royalty na need not to participate actively. Royalty income, interest income, dividend income, rental income, rent, and then even capital gains. These are the passive incomes. Okay, sir, interest need not to be considered for banks, because banks are actively working to earn interest. Plus, what else can be called as passive income? Where both buying plus selling is both to associate enterprise. Okay, you are selling both goods and services. You are buying from associate enterprise and selling to associate enterprise. That also has to be treated as what? Passive income. Income from buying and selling to associate enterprise also has to be treated as passive income. So this passive income should be what? Less than 50% of total income. First condition to decide active business is outside India. What is the first condition, sir? Everybody, important. Less than or equal to 50% of total income. What is passive income? If at all, that is because of transactions. Okay, the income is because of transactions, both buying and selling from associate enterprise. Passive income only. Then royalty, interest, capital gain, rental income, then dividend. All these are passive incomes only. Then second point, sir. What is the second point? They are saying like less than 50% of total assets are situated in India.
Less than 50% of its total assets are
situated in India. Sir, they will be giving in question depreciable assets, non-depreciable assets separately. We should take what? Total assets. 50% we should take on what? Total assets, not only on depreciable assets, on total assets 50%. Then third one, what is the third condition, sir? Less than 50% of total number of employees are situated in India, resident India. Less than 50% of total employees
situated in India or resident in India.
Situated or resident of
India.
Okay, so sir, here we wanted to prove active business outside India. So in India the people should be less. So the out of total employees, less than 50% only should be in India.
Yeah.
Then active business outside India. If more than 50%, then obviously more business is carrying out here only. So that's why less than 50% of employees should be in India. Less than 50% of total assets should be in India. Passive income should be less than or equal to 50% in India. So our passive income, these incomes need not to be in India. We are just finding out passive incomes. Passive incomes is like the income from both buying and selling to associate enterprises, royalty, interest, dividend, rent, capital gains. Then the fourth one, sir.
Payroll expenses.
Okay, the payroll expenses on such employees in India is less than 50% of total expenditure.
Payroll expenditure.
Payroll expense is less than 50% of total payroll expense. So they will not check only because of number of employees. The salaries paid in India also should be less than 50% of the total salaries paid. Total payroll expense. Okay, if these four conditions are satisfied, then active business outside India. If active business outside India and the key management people also outside India, the non-resident. Active business outside India, but key management people are again in India only, then resident only. Active business not outside India and key management decisions are also in India, then also again it is what? Resident. Okay, see for this, sir, there is an example, sir, which I brought from CA on this side, CA final material. Single Limited, a company incorporated in Singapore, and 55% of its shares are held by Godavari Private Limited, an Indian company. Singtel Limited has its presence in India also. The details are like fixed assets in India 120, Singapore they are having 80. Intangible assets 50, 200. Other assets 40, 120. Okay, sir, what is the total of assets, sir? We'll see. 120 plus 50 plus 40, 210 in India. Singapore, how much, sir? 400. 400. Okay, so assets point we will check. Anyhow, that we need to check, do assets point if you remember. Out of total assets, less than 50% should be in India. So total assets, how much, sir? 610. Okay, out of them 210 only there. So 210 by 610 now how much percentage, sir? $210 by 610 into 100. 34.4 only. That means it is not, it is within 50 only. So no problem. Then condition satisfied. Which condition? This is like second condition. Okay, condition 2 satisfied. Income from trading operations. Okay, the above figure includes income from transactions where purchases are from associate enterprises and sales are to unrelated persons. Then no problem. Active income only. Income from transactions where sales are to associate enterprises and purchase, this also. Income from transactions where both purchases and sales are from associate enterprise, passive income 5, here 10. Interest and dividend 20, 15, passive income. Then number of, okay, that part not required. So total passive income is how much, sir?
25 seems.
Okay, here it's like 25, here also 25. So total passive income is how much? 50. What is the total income, sir? If you see above, they said like the income from trading in operations is like 25 and 50. Okay, 75 plus this interest dividend part also we should include. Interest dividend, if you add 35, what is the total income they are having? 75. Sir, let me explain you, sir. Sir, first from business how much they are having, sir? Trading operations 25 in India, 50 in Singapore. So total how much? 75 they are having. Okay. Sir, do we need to add this to like this 2, 4, 3, 5? No. Why?
In India also 25. In Singapore also 25.
50 and 25. If you add 75, 25 and 50. Income from trading operations.
Okay.
Then the above figure includes what? Okay, already included these 3 points are 1, 2, 3. So no problem. Don't need to include again. Then interest and dividend. How much are interest and dividend? 20, 15. Sir, we are first finding out total income. So for that we need to add 35. What is the dividend income? 35. So total how much? Total income is how much? 110. For condition 1, total income is how much? 110. Now we need to find out passive income. How much is the passive income, sir? Passive income is like 25 plus 25.
50.
Okay, these two are passive incomes and these two are passive incomes. 50. Passive income is like 50. So total income is 110, passive income is 50. So if you do 50 by 110 into 100, what is the percentage?
45.5.
So which is less than or equal to 50 only. So that means condition 1 also satisfied. Less than or equal to 50 na, so condition 1 also satisfied.
Then of the number of employees paid expenses.
How much is the percentage? 40,
5.45%.
which is less than 50%. So condition 1 also satisfied. Condition 2 already satisfied. Then condition 3, sir. Number of employees. Total how many, sir? 70 and 90. So total how many, sir?
160.
160. Out of them, how many in India? 70. So 70 by 160 into 100.
43.7.
So condition 3 also satisfied. Then payroll expenses. Total how much payroll expenditure? 20. 8 plus 12, 20. Whereas in India it is only 8. 8 by 20 into 100 now 40%. That is also within 50. So all the 4 conditions are satisfied. That means what? The active business is outside India. Active business outside India. Determine the residential status of Singtel Limited if during the financial year 24-25 3 board meetings are in India, 5 in Singapore. So majority meetings are where? Outside India. So the key managerial is also outside India. Active business also outside India. So it is what? Non-resident. Non-resident. That's what the answer also, sir. Okay, so you could see the conclusion straight away. Since thus Singtel has satisfied all the 4 conditions, the company would be said to be engaged in active business outside India. Poem of a company engaged in active business outside India shall be presumed to be outside India if the majority of board meetings are also held outside India. Since poem is outside India, it is what? Non-resident. Non-resident. Then scope of total income, sir. Sir, scope of total income, sir. First section 5, scope of total income we are discussing now. We should check where we are having 3 categories, sir. Resident, RNOR, NR. We will be checking like income accrued or deemed to be accrued in India. Income accrued or deemed to be accrued in India. First one. If income is accrued in India or deemed to be accrued in India, then that is taxable to all the 3. Resident but not. Sorry, if the income is accrued in India or deemed to be accrued in India, it is taxable to resident but not ordinary resident, and even to non-resident. The next one. If income is received in India or deemed to be received in India. Income received in India or deemed to be received in India. Then also it is taxable to all the 3. Taxable, taxable, taxable. Then if both received outside India and accrual also outside India. Accrual also outside India except for business controlled from India. Sir, business income received outside India, accrued outside India only. But business controlled from India except, because that we will discuss separately. Business controlled from India and profession set up in India. Business controlled in India and the profession is what? Set up in India. Profession set up in India. Okay, then it is taxable to resident and ordinary resident, whereas it is not taxable to RNOR and non-resident. Okay, so what is the point, sir? Accrual received both outside India only, but it is not a business income which is controlled from India or a professional income which is set up in India. Correct only. If at all that is received outside India plus accrued also outside India, and such income is business income control from India
On profession set up in
or profession which is set up in India. Profession which is set up in India. Then if that is the case, sir, it is taxable to resident anyhow. Even taxable to RNOR, but not taxable to non-resident. Okay, so business controlled in India, profession set up in India. Okay, this is also inter-level only, not much important. The point is about deemed to be accrued. Okay, the much focus is now on deemed to be accrued. Most of the points are like the balance chapter is also about what deemed to be accrued concept only. Deemed to be accrued in India. See, income will be, sir, understand, if any past untaxed incomes brought to India that are not taxable in the current previous year. Income deemed to or accrue or arise in India. When we can say like deemed to accrue or arise in India? So very important, first one. Any income arising outside India, directly or indirectly through business connection in India. So business connection is another one-page discussion. Okay. So if at all the income is arising from business connection, then what we'll see? We will consider it as like deemed to be accrued in India. What is business connection? We'll discuss afterwards. Okay. Then any income accruing from a property, asset or source of income in India. Sir, if share is in India. If share is in India, then obviously the dividend will be considered as what? Accrued in India. I'm a non-resident, sir. Share in India. But obviously share is in India and it is accrued in India. House property in India, accrued in India. Okay, na? Then transfer of a capital asset in India. Where a capital asset is transferred in India, so the share, the property is located in India. And the resulting simple thing, sir, to find out deemed to be accrued in India, the source where it is there. Where is the source? We need to check. The source whether it is in India or outside India. If the source is in India, then it is taxable in India. Okay. It could be capital gain or interest, dividend, whatever it is. If it is source is in India, source na, such share, such debenture, such bond, such kind of property. Okay. If it is located in India, then the resulting incomes from such asset will be considered as deemed to be accrued in India. Then salary earned for services rendered in India. Salary earned for services rendered in India. Sir, he worked in India, but now settled outside India and getting pension outside India. But the pension is paid for what? The services rendered in India. Na? So that would be, even though received outside India, no work he is carrying out currently, but that is for the services which he has did in India, which is taxable in, which is deemed to be accrued in India. Salary payable by government of India for an Indian citizen, services rendered outside India. So a person is acting as a raw agent. Okay, raw agent, secret agent in foreign countries. Or he is acting as an Indian ambassador outside India. For him, he is an Indian citizen and the salary is paid by whom? Indian government. He is working outside India, receiving outside India, but it is paid by Indian government and he is an Indian citizen. That also will be considered as what? Deemed to be accrued in India. Dividend paid by an Indian company outside India. Indian company, na Indian share. Obviously, the dividend will be considered as what? Accrued in India. Then this point, sir, this interest royalty fee for technical service point. Please be very clear, sir. There is a question on it also. This question only, like from CA final material, they have added in the June 2025 mock test paper. So, see, income deemed to be accrued or arisen in India with regarding what? Interest royalty fee for technical service. We have three kind of incomes are here. Interest
royalty fee for technical services.
If such interest or royalty for paid by government of India. Sir, this interest royalty fee for technical service point, sir, very important. Be here. I mean, after active business outside India, if at all there is a chance of asking question, then this is the point. Okay, so you should be clear about active business outside India and then about interest royalty fee for technical service. Okay, see here. Sir, if interest royalty fee for technical service, sir, you could write down this also somewhere. Interest royalty fee for technical service. You are a non-resident. You are getting interest royalty fee for technical service. Okay, you are a non-resident. The point is whether it is tax, whether it has to be considered as deemed to be accrued in India for you or not. If it is deemed to be accrued in India for you, it is taxable in India. Okay, the point. Now, whether it is deemed to be accrued in India or not decides based on who is paying and for what it is used. Whether for you the interest royalty fee for technical service is accrued in India or not is decided based on who is paying, or along with that where it is used. Okay, these are the points. Now first point, sir. Government is paying you royalty fee for technical service. You are a non-resident. Sir, what about if it is paid to resident? Sir, if it is to resident, why we need to check global income taxable? Straight away we will take it as taxable only. For non-resident only these points. You are a non-resident. You are getting interest, royalty, fee for technical service from whom? Government. Indian government, central government. Blindly take it as deemed to be accrued in India. Don't think about where it is used. Wherever such loan money has been used by government of India, wherever such service, patent has been used, if at all you are being a non-resident, so let's say our Indian government is paying royalty to Russia. Why? Russia has given as a patent regarding some kind of missile manufacturing. They given a patent to India. For that Indian government is paying royalty. Russia is non-resident only now, but who is paying? India. Indian government. So if it is paid by Indian government, don't think of where it is used. It is taxable. It is considered as deemed to be accrued in India to the Russian government. Second one, resident. Sir, understand. I am a resident only now. I am resident of India. You are non-resident. For you, you are getting interest from me, royalty from me resident, FTS from me resident. So when it will be considered as deemed to be accrued in India? Just because I am resident, it will not be considered as deemed to be accrued in India. It depends on where I used. Sir, if I am paying interest now, you have given what? Loan to me. If I am paying royalty now, you might have given some patent. If I am paying FTS now, you might have given some kind of service to me. If that service, if that patent, if that loan is used for business or profession or for earning any source of income in India, then deemed to be accrued in India. Understand? I am paying interest to you, non-resident. Sir, it's not about my perspective, it's about your perspective. You are non-resident. For you, whether it is deemed to be accrued in India or not. When it will be considered as deemed to be accrued in India? If it is paid by government, blindly it is deemed to be accrued in India. Second one, if it is paid by a resident me, then again has to be checked where I have used that loan money, where I had, the resident who is paying interest royalty. He has used that in India for source of income or for business or profession, then it is deemed to be accrued in India, non-resident, to a non-resident. Third one, a non-resident paying to non-resident. David Warner paying to, okay, David Warner is paying certain income to Steve Smith. Both are Australians only. Sir, when they both are paying interest royalty fee for technical service, what is our problem? No problem. But we will be checking where such ultimately such loan money, royalty, patent service is used. If they are used for business or profession, sir, see, there is a difference between second and third point. In second point, that have been used for business or profession for any source of income in India. Whereas third person point, sir, it should be used only for business or profession in India. Where a non-resident paying to another non-resident interest royalty fee for technical service to the recipient non-resident, it is considered as deemed to be accrued in India when such underlying loan, patent or service is used for business or profession in India. Sir, able to understand now? Okay, let me show you a question on it in our workbook only. Question number 19, sir. This is given in December 14 mock test paper. Okay, sorry. Examine with reasons whether the following transactions attract income tax in India in the hands of recipient. Okay. There is a non-resident USA company. Non-resident USA company which do not have a PE in India. It entered into agreement for execution of electrical work in India. Sir, what work, sir? Electrical work. So now tell me, electrical work they are executing now, is it interest?
No.
Is it for royalty?
No.
But it's a technical service. So this is what? FTS. FTS received by what? Non-resident. So now we need to check what, who is paying. Separate payments were made towards drawing and designs. That also will come under what, FTS, which was described as engineering fee, nothing but fee for technical service. The SSC contended that such business profit should be taxable in USA as there is no business connection with the meaning of section 9(1). Sir, from where they received, see, India, here they mentioned in India. Okay, now whether it is taxable or not, sir, he is a non-resident. He is receiving fee for technical service from India. From where? India. And assuming that is even used in India only, then it is what, deemed to be accrued in India. If it is deemed to be accrued in India, it is what, taxable in India. Second one, a firm of solicitors in Delhi engaged in barrister in UK. Okay, these are like what, lawyers. Okay, for arguing a case before Supreme Court of India. A payment of 5,000 pounds was made as per terms of professional engagement. Sir, where they received outside India. Okay, but that is because of setup of a barrister in UK. When they are having a barrister in UK, they are having business connection in UK. So because of business connection in UK, it is also deemed to be accrued in India. Amount paid by Government of India for usage of patent developed by Mr. X, who is a non-resident. Sir, patent, royalty paid by whom? Third point, read. Amount paid by Government of India.
For use of patent development by Mr. X, who is a non-resident.
For patent, if you are paying fees, then what is called? What it is called? For using patent, if any amount is paid, that payment is named as what? For using patent, if some amount is paid, nothing, nowhere in the material. If royalty is being paid by government, then what? Royalty paid to non-resident.
Okay.
By whom?
Government.
Then deemed to be accrued in India or not?
Deemed to be accrued.
Always it is what, deemed to be accrued in India. Then Home Engineering, a non-resident foreign company, entered into a collaboration agreement with an Indian company, and in receipt of interest of, okay, collaboration agreement with was in receipt of interest on 8% debentures for 20 lakhs issued by Indian company. In consideration for what, sir? Why they are giving debentures? For providing technical service. That means it is not interest, it is fee for technical service only. For consideration to the fee for technical service, they are not paying money. Consideration to the fee for technical service, they are not paying money, they are issuing what? Debentures. But understand, sir, that fee for technical service is used by an Indian company resident for Indian purpose only. Now business in Pune, so obviously it is also what? Deemed to be accrued in India. So all the 4 points are what? Deemed to be accrued in India. So this is a straight away CA final study material questions are brought into our module. Okay, so we have completed 20 we covered, 21 we have covered. Okay, but concept is there, sir, still one page concept. Okay, the next concept is about gift, where any money given without consideration by a resident to non-corporate non-resident or a foreign company or an RNOR. Any gift, sir, without consideration, if you are giving any money, then that is called as what? Gift only. To whom you are giving? By a resident to a non-corporate non-resident, foreign company resident but not ordinary resident, and the amount is more than 50,000, it will be taxable in India. I mean, that will also be considered as deemed to be accrued in India. So gift tax concept is applicable even to non-residents. Then business connection. Sir, business connection. When can we say like business connection in India? Business connection in India includes any business activity carried out in India. They are carrying a business activity. Sorry, a foreign company is carrying business in India. How? Through a person acting on behalf of NR. There is a person in India who is acting on behalf of that foreign company. Then we can say like what? There is a business connection in India. Nothing but there is an agent in India. Through that agent they are running business in India. So now through agent, if they are carrying out business in India, then there is a business connection in India. Through business connection, whatever the income they earn, that is considered as deemed to be accrued in India. So okay, but see, when can we say like just because there is an agent, we cannot blindly say like there is business connection. That agent should have certain things. What? A person in India, nothing but we are referring him as agent, habitually concludes contract. He finalizes the contracts on behalf of non-resident. He habitually plays the principal role. Habitually, routinely, he plays a principal role in leading to conclusion of contracts. Then also, he maintains stock. Okay, he maintains stock. He secures orders wholly or mainly. Sir, this agent in India finalizes the orders on behalf of non-resident. He procures the orders, secures the orders. He maintains stock. Okay, which has to be delivered. He plays even though he didn't finalize the contract, he plays a crucial role in finalizing the contract. Then this agent under non-resident, we can say like they are having business connection. If there is business connection through this agent, whatever the income is earned, that will be considered as what? Deemed to be accrued in India. Okay. Sir, agent, if they are acting as independent agents, then they are not to be included in the concept of business connection. However, sir, the following shall not be treated as business connection. If you are from India just purchasing goods, not selling, you are just purchasing goods and taking outside India, or purchasing goods and directly sending to outside India, then that is not business connection. In India, you are just collecting news. He is a news agent. He collects news and give it to BBC. BBC telecasts outside India, then that is not a business connection. In the case of a business in respect of which all operations are not carried out in India, they are doing business, but only a part is done in India, then to that extent operations only is deemed to be accrued in India, not the whole income. So let's say tour operator, sir, he is carrying out tour in 5 countries. Okay, a part is even in India also. I mean 3 days in India, other 15 days outside India. So now the whole income is not accrued in India because partly only related to India. So that 3 days relevant to tour related amount is only deemed to be accrued in. Just because a film is shooted in India, sorry, a Hollywood movie came to India and they shooted for India. They shooted the film in India. So then we cannot say like there is business connection in India. Then any activity is conforming to just displaying diamonds in a specified notified zone. Sorry, in an exhibition, they displayed diamonds. Through that exhibition, they got orders, but it doesn't mean it is a business connection. Okay, then business connection can be established with sometimes, sir, even though there is no agent, business connection can be established with significant economic presence. These are for this modern tech companies, this point is applicable. Business connection can be established, one route is through agent. Without agent also through significant economic presence also business connection can be established. What? They are entering into transaction related to goods and services or property carried out by a non-resident with any person in India, including what? They provide downloading of software, data, these kind of services they can do. Where the aggregate of payments is greater than 2 crores in previous year in India. So for downloading Play Store, sir, owned by Google, non-resident. But in India, we are downloading Play Store. Through Play Store, we'll be buying certain apps and all. Okay. So now through this Play Store, if the total turnover made is like more than 2 crores in India, then that Google is what? Having business connection in India. Okay. But not through agent because it's everything online, not required of physical presence of any person. So it is through significant economic presence. Or else, there is a transactions where systematic and continuous soliciting of business. Sir, in Instagram, sir, you can boost a post in Instagram. Okay, you can promote your businesses through Instagram. So now how can Instagram we can say like that is having significant economic presence in India because of the number of users. If they have more than 3 lakhs, then we can say that they are having active business outside India. Okay, then the miscellaneous section, sir. When an Indian branch of a foreign company, for a foreign company there is an Indian branch. Let's say for Google there is a branch here. Later on, this Indian branch, they wanted to float it as a company, Indian company, which will be a subsidiary of foreign company. In that case, foreign branch, that also applicable only to banking business, sir. See, foreign company engaged in banking business through branch, converted its branch into a subsidiary as per the scheme approved by RBI. Sir, but when they are converting a branch into a company also, there is transfer of assets from one company to another, right? Previously, all those assets are owned by non-resident. But now when they are floating it as a company, the assets from non-resident company are transferring to subsidiary company. Whether such transfer attracts capital gains. Any capital arising from conversion are not taxable in the year of conversion. Application of tax provisions related to unabsorbed depreciation, losses, tax rates, everything will be carried forward to the subsidiary, successor company. Okay, consequence of non-compliance. If they doesn't follow any conditions, then benefits exemptions will be withdrawn. Normal tax provisions will only apply. Okay, after claiming benefit, if they fails any condition, then the benefit exemption will be considered as wrongly availed, and assessing officer will recompute the income of that year and recompute the tax. Okay, with this we have completed NR taxation. Okay. So what are the important areas from NR taxation, sir? The first two segments, sir, chapter 12A, chapter 12, the special tax rates, but very important. 90% the question can be from there only. Then another 5% is from presumptive taxation. How many? 5 sections only, sir. One is transported related, 44B, 44 BBC, 44 BBA. Then two sections. 44 BB and 44 triple B are related to that oil exploration or mineral exploration companies. You are providing any service or renting plant and machinery, or to turnkey power projects. That one, 5 sections only. Then head office expenditure related one. How much is allowed for head office expenditures, are 5% of adjusted total income or actual, whichever is lower. That one. That segment done. Presumptive taxation and that one. Okay, 95. Another 5% chance is from residential status, that also company related. Active business is from outside India. And the next concept is like deemed to be accrued in India, this interest, royalty, fee for technical service. Okay, with this 100% we have covered the NR taxation. So I have did my part, it's your part whether you will get that 7 marks fully from this NR taxation chapter or not. Okay, you need not to solve any other extra questions also. These questions are enough if you have clear conceptual understanding from these topics. Okay, thank you all. Hi all. So now we are into the topic DTAA, double taxation avoidance. We already finished the NR taxation part. So there we have discussed the basic conditions for residential status, additional conditions, okay, scope of total income, all that part, and additionally that special rates also. That residential status part is somehow connected to the DTA. Okay. The double taxation avoidance agreements, these are applicable to any type of person, but understand mostly the problem 60 which is asking is from individual perspective only. So DTA chapter, the question will be asked mostly from whose perspective, sir? Individual perspective only. Okay, individual taxation perspective only, the question will be there. So there will be one MCQ, there can be one MCQ 2 marks, and there can be a problem for 7 marks and theory 7 marks. Okay, there is a resident and ordinary resident who is from USA. Okay, there is a resident and ordinary resident from India, and he is having some income from USA. Let's say from USA is having a rental income. Sir, from USA if he is having rental income, the source is in USA. Because the source is in USA, it is taxable in USA. But since he is a resident or ordinary resident, global incomes are taxable. That means that rental income, even though received, accrued in USA, still it is taxable to this resident and ordinary resident. So the same income, it is being taxed in USA as well as in India. In USA because of source rule, in India because of resident rule. If the same income is getting taxed more than once, because of source rule and because of resident rule another country, then that is called as what? Double taxation. Okay, see, Mr. Sai has received 5 lakh rupees as rent from a house property located in USA, and Sai is also resident of India. 5 lakhs taxable in India because source is in USA, and it is even taxable in India because of resident rule. Okay, so there is double taxation on it. And there is another way of classifying double taxation: economic double taxation, jurisdictional double taxation, judicial double taxation. For the same income taxed in 2 or more countries but in the hands of different taxpayers, not in single taxpayers, they are taxed in the hands of different taxpayers. Like let's say for Exim Corporation USA, the profits are taxable in USA. The profit again when it is declared to the shareholder X is in India, and to him it is taxable as dividend. The amount is same, but in one country it is taxable as like what? Profit. In another country to the shareholder it is taxed as dividend. So okay, then the same income, okay, in two different persons, with two different persons, not to a single person, with two different persons it is getting taxed, then that is what? Economic double taxation. Jurisdictional double taxation is The double taxation, which I already said. In one country because of source rule, in another country because of resident rule, if it is being taxed to a same person, then that is what jurisdictional double taxation. Then double taxation. Okay, so to avoid or to remove the negative impacts of double taxation, there is a relief is being provided. Okay, so the relief can be provided under section 90 and 90A or under section 91. When 90 and 90A, when 91, sir, with that country. Okay, let's say Mr. X is an individual, he is a resident of India and is having income in USA and is having income even in Japan. Now with these countries, if India is having DTAA, double taxation avoidance agreements, if directly Indian government entered with that other foreign country government, then it is covered under section 90, where some body which is authorized by central government entered into an agreement with a body in the foreign country which is authorized there. So then if there is DTA between both the countries, then the relief will be under 90 and 90A. If there is no DTAA between those two countries, then the relief will be under section 91, which is even called as unilateral relief. Where there is no DTAA, unilateral relief. Where there is a DTAA, then the relief will be under 90 or 90A, which is called as bilateral relief. So under bilateral relief, sir, there are different methods: exemption method, tax credit method. Under bilateral relief, there are two methods: exemption method, tax credit method. Under exemption method, there will be full exemption and exemption with the tax progression. So there are two types of exemption method: full exemption method and exemption with tax progression. Full exemption method, exemption with tax progression. Under tax credit method, under tax credit methods, there are three methods. Okay. First, direct credit. Under direct credit, again two methods: full credit, ordinary credit. Indirect method na underlying credit and special credit tax paying. Okay, so for the purpose of exam perspective or problems perspective, sir, this underlying credit and tax paying doesn't have much questions also, not even a question also. So we are having full exemption method, exemption with tax progression, full credit, ordinary credit. For each method, there will be one question. But most of the questions are based on unilateral relief when there is no DTAA, when there is no DTAA. Full exemption method. So first we will go with what? Full exemption method. Under this method, what happens? Income earned in the state of source is fully exempt in the state of residence. Income earned in the state of source is fully exempted in the state of residence. So if it is already taxed in foreign country, that won't be again taxed in India. So that is only called as what? Full exemption method. Okay. Let me show you in the workbook also, sir. Okay. So look at this question. Mr. Prabhas is a resident, has earned the following incomes for the year 2024-25. Income from house property in India but received in UK 7 lakhs. Royalty, sir, income from house property in India. That means what? It is an Indian income only. This is Indian income only. Royalty on patent outside India. This is a foreign income. Past untaxed income brought to India. So past untaxed incomes can't be taxed in the current year. So you simply ignore this. Whereas tax paid in respect of income 1, 2 and 3 are like 90, 75, 20. Sir, with respect to foreign income, already 75,000 tax paid in the foreign country. So if already tax paid in the foreign country, under tax exemption method, what happens, sir? That income will be fully exempted in India. Only the other income 7 lakhs is taxable. Okay, that is also income from house property in India but received in UK 7 lakhs. Sir, we are not taking standard deductions, sir. We are assuming it as what? Net of all those deductions, 7 lakhs. Okay, so if it is 7 lakhs, sir, for a resident, since they didn't mention anything, we will take what? Default rates. So on default rates up to 3 lakhs, it is nil. On 3 to 7 lakhs, it is taxable at what rate, sir? 5%. 4 lakhs into 5% na 20,000. Okay, plus cess at a rate of 4%. But here, sir, in the answer, they might have did it in the slab rates, I think. Okay, I mean, old regime if they did. If they did it under the old regime, what is the point, sir, then? Up to 2,50,000. Nil, 2,50,000 to 5 lakhs. 5%, which is like 12,500. Above 5 lakhs, 20%. So, 2 lakhs into 20% now 40, then it is like 52,500. On that cess if you add, it will come to 54,600. This is which method? Full exemption method. Very easy method, sir. Whichever the income taxed in foreign country, you completely exempt it while calculating tax in India. You completely exempt it while calculating tax in India. Full exemption method. Exemption with the tax progression. What happens here? Under this method, income from the state of source is considered by state of residence only for the tax rate purpose. Okay, that means, see, look at these steps. First, calculate tax including cess on total income, including that foreign source income. Yes, that foreign source income is taxed, but still include it under the respective head and tax it. Okay, if any deductions available, provide all of them and tax as if that has to be taxed in India. Forget about double taxation. How you will be taxing? Tax the same way. Find out the tax payable. Then find out average tax rate. How do we find out average tax rate, sir? Average tax rate, not tax payable including cess divided by total income into 100. Average tax rate, how to calculate, sir? Tax payable divided by total income into 100. Then relief. How much is the relief given? That foreign source income into Indian average tax rate. How much you will get? That will be given as what? The relief. So how to calculate, sir? First to calculate the tax payable including that foreign source income under the respective head and provide the available deductions, everything. Calculate the tax payable. Then step 2, find out the average tax rate. How to find out the average tax rate? The total tax payable including cess divided by net total income into 100 will get average tax rate. How much is the relief? Such foreign source income into average tax rate you do, you will get the relief. Such would be given as relief. Okay, so now we'll look at a question on this. Question number 3, sir. Sri Ramesh is an ordinary resident individual, has the following income for the previous year 24-25. Income from India 16 lakhs, income from country by 10 lakhs, investment in PPF 1,50,000. India has a DTAA with country by under which income is taxable only in the source country. However, such income is included for rate purpose under Indian law. Income in country Y has been already taxed at 25%. See, how do we solve, sir? First, we'll take income from India 16 lakhs. Then income from country Y 10 lakhs. So, total how much, sir? 26 lakhs. Okay, did they mention default regime or anything, sir? They didn't mention. Okay, if they didn't mention, we'll assume as what? Default regime only. So under default regime, ATC deductions are not available. Okay, if at all old regime, this investment in PPF is eligible for ATC deduction. So nothing. 26 lakhs is the net total income. And what is the tax payable, sir, under default regime? Under default regime, first 15 lakhs, 1,40,000. Subsequent 11 lakhs into 30%. So 3 lakh 30 plus 1 lakh 40, tax equals to 4 lakh 70,000. Plus cess at a rate of 4%. How much? 18,000. So total it is how much? 4,88,800. Okay, 4,88,800. So what is the tax payable? Okay, average tax. What is the average tax rate, sir? The average tax rate equals to 4,88,800 divided by 26 lakhs. How much? 18.8%. So what you should do to calculate relief? Apply this 18.8% on foreign source income. 10 lakhs into 18% now 1,88,000. So such 1,88,000 is the relief. 88,800. This is 18.88%. Okay, fourth one also same model. We'll see. Sri Anuj, sir, find out, sir, the point here, sir, in question, in material we have mentioned here exemption with progression. If that is not mentioned there, how do you find out in a question that it is related to exemption with progression method? See, sir, if it includes a point like such income is included for rate purpose, then it is exemption with progression method. Question number 4. Anuj, an ordinary resident in India, provides the following details of his income for the previous year relevant to assessment year 25-26. Income from India 13,40,000. Income from countries at 12 lakhs, investment in PPF 1 lakh. Further, it is to be noted that India has DTAA. According to the set, income is taxable in country which is earned and not in. However, such income to be included for the purpose of tax rate. That means what? Exemption with progression method. Foreign income already taxed at 20%. Compute Indian tax payable. Here also they didn't mention, sir, old rate, default regime or old regime. So we'll take it as what? Default regime only. So what is the total income, sir? The total income is 25 lakh, 22 lakh 40,000. 25 lakh 40,000. Okay. Then this deduction can't be claimed, sir. Why? ATC deduction is not available under deduction default regime. So we need to find out the tax payable. First the 15 lakhs, 1 lakh 40,000 plus 10 lakh 40,000 into 30%. So together if you do, how much is the tax payable, sir? 4 lakh 52,000 plus cess. How much? 18,080 rupees. So together it is how much tax? 4,70,080. So we need to find out what now? Average tax rate. So 4,70,080 divided by 25,40,000. If you do, how much, sir? 18.50 percentage. Okay, 51 percentage is the average tax rate. So you multiply this 18.51 with 12 lakhs. Okay, how much, sir? That is like 2,22,120 is the relief. From the 4,70,800, this 2,20,120, if you take it as relief, 2,47,960 is the ultimate tax pay. Okay, we have finished this method also, exemption with tax program. Okay, the same question, sir. Fourth question only. If you see, income from India, they have total 25 lakh 40, then tax payable 4 lakh 52, then cess 18,820, overall 4 lakh 70,080, relief 12 lakhs into 18.5%, 2 lakh 22,120, final tax payable is 2 lakh 47,960. Average tax. Full credit method. What is full credit method? Tax paid in the state of source is allowed as credit against the tax payable in the state of residence. What does it mean, sir? First you will compute tax including foreign source income also. Then out of the tax, whatever you paid in the foreign country, adjust as relief. Whatever the tax you paid, fully that can be taken as what? Credit. Oh, that can be taken as relief under section 1990A. Then the balance is only tax payable under step 1, step 2. Okay. The final balance only tax payable. For understand, sir, how do we calculate full credit method, sir? First we will calculate the tax assuming considering the foreign source income also, whatever the deductions, exemptions available, claim everything, find out the tax rate, tax, and even just find out the tax. No need of finding out average tax rate. Then whatever the tax paid in foreign country, such tax, claim it as a relief. If you adjust that, then you will get the final tax payable, ordinary full credit method. So if you go to the workbook, sir, first question, there is an option to do even DTA under tax credit method. Okay, so what is the question, sir? Again, income from house property is like 7 lakhs, royalty on payment of outside India 5 lakhs, so total 12 lakhs. Past untaxed income will not consider. Okay, on 12 lakhs we are solving it under what rates, sir? Old rates. Okay, it could be solved under old rates or new rates. So if you take 7 lakhs income from house property, royalty income from outside India 5 lakhs, so total gross total income, not total income, is 12 lakhs. Tax 1,72,500. How? First 10 lakhs under the old regime, 1,12,500 plus 2 lakhs into 30 percentage na 60,000. So 1,72,500 plus 6,900. So overall it comes to 1,79,400. Okay. From there, with respect to this royalty income, how much is the tax paid outside India? 75,000. Such 75,000 claim it as relief. Then the final tax payable is 1,04,400. 1,04,400. This is what? Full credit method. So how many methods are as of now? Full exemption method, exemption with progression, full credit method. In full exemption method, what we'll do, if already such income is taxed outside India, okay, then completely exempt it. Don't even include for tax purpose also. Exemption with progression. What you have to do? First include that income also and calculate tax. Find out the average tax rate. Then after multiply that foreign source income into average tax rate, whatever the amount it comes, that can be claimed as relief. Adjust from the tax payable, you will get the final tax payable. Then this is what full credit method. In full credit method, what you will do, take the foreign source income also include and calculate tax. Okay, from the tax, whatever is the tax paid in the foreign country, that could be claimed as what, relief. Then next question, sir, ordinary credit method. What happens in ordinary credit method, sir? The state of resident allows credit for tax paid in the state of source. Whatever the tax paid in the state of resident, that can be claimed as, okay, some relief will be given in the state of resident with respect to the state of source, tax paid in state of source. Restricted to that part of income tax which is attributable to the Indian income, which is attributable to the foreign income taxable in the state of residence. Okay, sir, it's not like how much ever is paid in the foreign country is given as relief. Okay, it is restricted to the tax that is attributable to the foreign source income. Sir, how to do, sir? Not understanding. See, first compute tax normally including foreign source income. Compute average tax rate. Now, you apply average tax rate into foreign source income, one thing, and the tax paid in foreign country, both compare. Whichever is lower will be given as relief. Whichever is lower. So what is the thing, sir? Tax paid in foreign country or foreign source income into average tax rate, whichever is lower will be given as credit. Okay, step 4 is nothing but out of the tax payable in step 1, you adjust the relief, you will get the final tax payable. Okay, so now we will be solving question number 2, sir. Mr. Ramesh is a resident of India, has derived the following incomes for the previous year relevant to the assessment year 25-26. He is having what? Income from profession in India 12,44,000. Income from profession in country A, tax paid in country at 5%, 4,50,000. Compute Indian tax liability of SSE, assuming that as per treaty between them, 4,50,000 is taxable in India. However, foreign tax can be set off against Indian tax liability. Okay. First, what is the total income, sir? 12,44,000 plus 4,50,000, 16,94,000. On 16,94,000 is the net total income. On this tax, how much is the tax? Default residence, sir. First 15 lakh, 1,40,000. Sir, how do we calculate? First 15 lakhs, the tax is 1,40,000. On balance 1,94,000, apply 30%. How much? Plus cess. Okay, if you total all this, it is like 2,06,128 is the total tax. Okay, this is step 1. You remember. Then we should find out what average tax rates. How to find out average tax rate? 2,06,128 divided by 16,94,000. How much, sir? 2,06,128 by 16,94,000. How much? So 12.17% is the average tax rate. 12.17% is what? It's the average tax rate. Now we need to find out what relief. How much is the relief, sir? Foreign source income 4,50,000 into 5%, the foreign tax, or 4,50,000 into average tax rate 12.17. Which is lower, sir? 5%. So 4,50,000 into 5%, now how much? 22,500. So that would be given as relief. 22,500 will be given as relief. If you adjust that one, the final tax payable is 1,83,630. 1,83,630. Okay. Then we are moving on to tax sparing. What is tax sparing, sir? Sir, it's an interesting concept, sir. Usually in DTAA, what we are doing, like in the other methods, if already tax paid in foreign country, such tax they are giving it as relief. In tax sparing, because of some exemption, let's say, sir, understand the tax sparing country. There are two countries, A, B. Okay. Now, in country A, because of some incentive measure or such income is exempted. In country A, such income is exempted. Now in country B, actually, sorry, if income is exempted in country A and the same income if it is taxed in country B, actually there is only single taxation because the other country it's not being taxed. But what does tax pairing says? The tax pairing says like even though it's not taxed in the other country, if at all taxed, how much ever would have been taxed will be taken as credit. Sir, in country A, this income is not even taxed. That means there is no double taxation, there is no relief at all actually. But if at all such income is taxed, how much ever will be the tax payable, such a tax payable, they will be taking it as what? Relief in country B. That itself is called as a tax sparing. See, look at this point, sir. State of residence allows credit for deemed tax paid because in the other country they are not paying tax. But if at all they paid tax, I mean, sir, why they are not paying tax, sir? There that might have been exempted there. But if there is no such exemption, how much ever would be the tax paid? You need to find out. That would be given. So, state of residence allows credit for deemed tax paid, which is otherwise exempted from tax in state of source. Which is otherwise exempted for tax in state of source. C. A limited located in country X. Tax rate 30%. Country X and Y has DTAA that they're with the tax pairing clause. Sir, understand, sir? There's a located in country X, tax rate 30%. And the A limited has branch in country Y, and in country Y there is an income of 10 lakhs, tax rate 25%. But since the branch is located in SEZ, it is exempted from tax. So now country Y, sir, there is no tax 10 lakhs. Okay, now the same income, branch income has to be includable in the head office, main company also. So in country X also the same income included. But is it taxed in the foreign country? Why? No. But still you need to provide relief. What relief you will give? If at all it is taxed in country Y, what rate would have been applicable? 25%. That percentage will be given as relief. See, in country X, what is the tax rate, sir? 30. So 10 lakhs into 30%, na, tax is 3 lakhs. On that 3 lakhs, if at all that 10 lakhs is even taxed in country Y, it is not taxed in country Y, but if it is taxed in country Y, how much ever the tax they will be paying? 10 lakhs into 25%, 2 lakh 50. The deemed tax that would be given as relief. The balance 50,000 is the tax to be paid. The balance 50,000 is the tax to be paid. Then underlying tax credit method. Okay, sir, the underlying tax credit method, sir, it tries to mitigate what? Economic double taxation, where same income is taxed more than once in the hands of different persons. Then to eliminate, then to control this, underlying tax credit will be given. There are no questions on underlying tax credit, sir. So underlying tax credit is to what? To eliminate economic double taxation. Okay. The next one is like about unilateral relief. But before going into unilateral relief, once we'll finish off this theory question, then we'll go to the unilateral relief. What is this one? Sir, with every country, in most of the countries, India will be entering into DTAA, right? Double Taxation Avoidance Agreement. Do you think every time we'll sit and write each and every point of DTAA? No. We'll do copy paste only. Just like how we prepare financial statements for different companies in articleship, what we'll do? The only balance sheet P&L only will change. Other notes to accounts will do copy paste only. If any adjustments are there, na, we'll search for there and then only we'll change. Na. Rest all will remain same, right? Same way. DTA also, they'll not change everything. Okay, so there are certain model treaties. So based on that model treaties only, the DTAs will be entered. So country to country, if there are any changes to be made from the model treaty, that alone will be made. Rest all remains the same. So what are the model treaties that are available? There are 3 model treaties are available. What are those? First one is like OECD, Organization for Economic Cooperation and Development, their model of DTAA, OECD model. Then UN model, United Nations model, and the third one is like a US model. How many models are there? So now OECD model, we are having a UN model, and we are having even a US model. So total how many models? 3 models are there. See, sir, OECD models are actually, this is for developed countries. It suits well for developed countries. Why? Because OECD model, instead of a OECD model suggests like the tax should be going to the tax should be levied based on resident rule. Based on which rule? Resident rule. Whereas UN model, sir, it is beneficial to the developing countries because it is framed that the tax revenue should accrue to the based on source rule. Source rule. Okay, so India usually follows UN model only. The third ones are US model, which fits mostly for US. Okay, US enters into treaty by using their model only, US model. So UN model. Sir, why UN model is important? Why source based tax is only important? Sir, understand, in India what we are lacking is like capital. We have manpower, we have resources, but what we are lacking is capital. Okay, so now a foreigner or a non-resident came and invested in India. Okay, if all these multinational companies brought money from outside India and invested in India, if their businesses are taxed based on resident rule, means all of them will be paying taxes in US and all only. So they will be again exploiting us. They'll do production facilities here, they'll sell their products here, but based on resident rule, they'll be paying taxes only in foreign countries, which is not beneficial to India. So that's why source based rule. Why? Even though the investor is a foreigner, but since his business activities, everything is carrying out in India, the income would be taxed in India based on source rule. See, look at each and every point. That's why it would be beneficial for India to follow UN model only. See, the OECD model was traced back to, I mean, when it is introduced, sir, 1927, before independence only, 20 years before our independence. A fiscal committee na, a committee which involves people from different state, different countries have been there. So a fiscal committee of the League of Nations, okay, that time League of Nations, prepared the draft model applicable to all the countries. Okay, they have prepared a draft model way back in 1927. It has been revised several times and the latest version available is like related to what, 2017. Okay, it's essentially a model treaty between whom, sir? Developed nations. Why? Because it advocates, I mean, it encourages which principle? Residence principle. That means the taxes will be given to the resident state rather than that of the source state. So only for developed countries it would be beneficial. Okay. Then UN model. In UN model, sir, in 1968, United Nations set up an ad hoc group of experts from various developed and developing countries to prepare a draft model, okay, which will be conventing between developed and developing countries. Because this OECD model, sir, it is only beneficial to developed countries. That's why developing countries don't want OECD. So that's why another group is formed which will suggest another model. So in 1980, the group formed in 1968. Okay, the finalized the model when 1980 in the present form. Further revised several times and the recent one is being what, 2021. Okay, this UN model gives more weight to source principle, whereas OECD model gives more weight to residence principle. This will give more emphasis on source principle to encourage flow of investments from the developing countries to the developed countries to the developing countries. Or from other countries like US, China, Japan, those people will come and invest in India. Source rule na, even though they invest, if they are investing here na, income earning here. So on such income it is taxable in India only. If they follow resident rule na, it is not taxable in India, it is only taxable in their countries. Already they are developed. With tax revenues they will develop much more. Okay, that's why the residence rule model, OECD model is not suitable to India. We have chosen which model? UN model only. Most of India's tax treaties are based on UN model. US model. This US model, sir, it is first published in the year 1976 and has been revised for several times. Okay, this US model is issued by United States while entering into tax treaties. Okay, usually this is followed by US when they are entering into tax treaties with various other countries. Okay, then now we are again moving on to unilateral relief. When unilateral relief, sir, when there is no treaty between India and that foreign country, then we will go for unilateral relief. Sir, let me tell you once again the models which we have discussed. Sir, there is like bilateral relief. Okay, bilateral relief. Bilateral relief comes under which section, sir? Under section 90 and 90A. What are the methods available under bilateral relief, sir? First one, full exemption related. Full exemption. And the second one is like exemption with tax progression. Exemption with tax progression. Then we have discussed about the credit related methods. Okay, what are those? First one is like full credit method. The second one is about ordinary credit method. Okay, the third one is about tax sparing. And the fourth one is like here underlying credit method. Okay, all these are like when there is a bilateral relief, then these methods. But it's not like all these methods will be there. Depending on country to country, based on relations, they could choose any model. Okay, for certain incomes they could choose one model, for certain incomes they may choose other model. Okay, mostly like with one country they'll choose only one model. But what if there is no DTAA? No DTAA, then they will come under section 91, which would be given, sir, an unilateral relief will be given. Unilateral relief. So we'll look at those conditions, sir. Unilateral relief conditions. Unilateral relief. Section 91, double taxation relief if there is no DTAA. Okay, conditions. What are the conditions, sir? First one, SSE should be resident of India. To give relief here, SSE should be resident of India, and income derived from foreign country and income not and such income derived from foreign country is not deemed to be accrued in India or arisen in India. I mean, it shouldn't be taxable in India. Sorry, it's not a source from India. That should be a foreign source income only. When can we call it as foreign source? Where the income accrual also outside India and receipt also outside India only. And on such income, tax should have been paid or deducted in the foreign country, and there should be no DTAA with that country. There should be no DTAA with that country. Understand, sir? These four conditions. What are those four conditions, sir? Once again, SSE should be resident of India. Okay, RYNA not return of income, sir. SSE should be what? Resident of India. Then such income from foreign country, okay, not accrued or deemed to be accrued in India, and tax has been paid in foreign country, and there is no DTAA with that foreign country. If these four conditions are satisfied, then the relief can be availed under unilateral relief under section 91. So now we'll discuss like how the relief has to be calculated. The steps for computing the relief. See, what are the steps, sir? First one, calculate tax on total income including foreign source income. Calculate tax on total income including foreign source income. Second one, find out the rate at which tax paid or deducted in the foreign country. First, calculate tax on total income including foreign source income. So usually how we did in the like ordinary credit method, exemption with progression method, you include this foreign source income also and compute tax normally. Step 2, even find out what? Average tax rate also. Third, okay, then you even find out the rate at which tax paid in the foreign country. Find out average tax rate and even find out the tax rate at which the tax is paid or deducted in the foreign country. So you got two rates now. The foreign country tax rate on foreign source income and even the average tax rate also. Now, what is the relief, sir, out of those two tax rates? The foreign tax rate and the average tax rate calculated, you will find out whichever is lower. Such lower rate you need to apply on the double taxed foreign income. That lower of those two you need to apply on what? Double taxed foreign income. Then you will get the relief. Such relief you need to subtract from the final tax from the tax payable. You will get the final tax payable after relief. Okay. Okay, so now we'll solve the question number 5 from workbook, sir. Mr. Saha is a resident of India, has derived the following incomes for the previous year to the assessment year 25-26. What are those incomes, sir? He is having income from profession 3,74,000. Royalty on books from foreign country, out of them 3 lakh is eligible for deduction under 80 QQB. Tax paid in foreign country 20%, 5 lakhs. Compute Indian tax liability if he has opted for what regime, sir? Old regime. Opted for what? Old regime. Okay, sir. DTAA na? No DTAA na? No DTAA. Okay, if there is no DTAA na, what are the conditions? He should be resident of India, satisfied. No DTAA. Third one, there is a foreign source income, royalty on books from foreign country. This is not accrued or deemed to be accrued in India. Third point also satisfied. Fourth one, the tax paid in the foreign country also 20%. So all the conditions satisfied. So unilateral relief is available. So first, 3,74,000 plus this 5 lakhs. What is the total income, sir? 8,74,000. If 8,74,000 is the gross total income, then he has opted for old regime, sir. If he opted for old regime, then he is eligible for which reduction, sir? 80 QQB. Old regime. So eligible for 80 QQB. So 80 QQB, how much is the deduction, sir? 3 lakhs. Then what is the net total income? 5,74,000 is the net total income. So you should calculate and tell me tax plus cess. Tax plus cess. 28,392 is the tax plus cess. 28,392 is the tax plus cess. Okay, next we need to find out what average tax rate. What is the average tax rate? 28,392 divided by 5,74,000. 28,392 by 5,74,000. What is the average tax rate, sir? 4.95 percentage. Okay. So foreign tax rate is straight away given in the question 20, whereas average tax rate is 4.95. Out of these two, whichever is lower, na 4.95%. At 4.95% apply on foreign source income. Sir, out of foreign source income, whichever is double taxed only you should take. Sir, this 5 lakhs is foreign source income, but 5 lakhs is not double taxed. 5 lakhs taxed outside India. But in India, out of this 5 lakhs, we claim 3 lakhs deduction, na? So only 2 lakhs is being taxed. So 5 lakhs, here 2 lakhs. What is the common income? Double taxed, 2. That 2 lakhs into lowest of average tax rate or foreign source rate, foreign tax rate you should apply. So 4.95% into 2 lakhs if you apply, you'll get the relief 9,900. That you subtract from the tax payable calculated above 28,392, you'll get the tax payable as 18,490. You see in the notes also, sir, we have solved it in both the regimes. Okay, for headwise, first income from profession 3,74,000, 3,74,000, old new. Royalty from country by old regime 5 lakhs, new regime also 5 lakhs. In old regime, gross total incomes both the regimes 8,74,000. In old regime only 80 QQB deduction available, so 3 lakhs deduction claim. Whereas in new regime such deduction is not available. So the net total income change, sir. Old regime 5,74,000, new regime 8,74,000. Now old regime we already calculated tax 28,392, including cess. Including cess it is 28,392 only, yeah? Yes. And what is the tax rate, sir? 4.95%. Okay, average tax rate. Whichever is lower na 4.95, that only applied. Final tax payable 18,500 here. Then come to new default regime, sir. What is the tax here? 38,896. 38 by 896 by 8,74,000 na, then the average tax rate is like 4.45. Okay, here the double taxed income is 5 lakhs, sir, under new regime. Why? Foreign country also it is taxed 5 lakhs. In India also no 80 QQB deduction. Here also it is taxed 5 lakhs only. So 5 lakhs into 4.45% will get 22,250. Subtract them. The final tax payable is 18,500 and 16,650. Okay, then we'll solve question number 6 also, sir. So look at the question. What is the Arvind is a textile merchant and resident Indian is doing business in India. During the previous year 24-25, he discussed the following information. What is the following information he discussed? He is having income from business in India 27 lakhs. Income from business in country A with which India does not have a DTA for avoidance of double taxation 15 lakhs. So this is what Indian source income. This is foreign source. And the tax in foreign is like 5 lakhs. Loss from business in country B with which also India does not have avoidance for DTAA, foreign source only, this is also. Contribution to PPF, if at all they follow old regimes, are eligible for which deduction? 80C. Payment of life insurance premium on life of his father and mother. Sir, life insurance premium paid for life of father and mother parents is not available for deduction. 80D, medical insurance premium paid for parents is eligible, but life insurance premium paid for parents is not eligible for deduction, so 80C is not available. Now if you see, the business is how much, sir? 27 lakhs. Under that business only 15 lakhs foreign source income, total how much, sir? 42 lakhs. From there adjust 4 lakhs set off of loss, then the gross total income is how much? 38 lakhs. From the 38 lakhs, what is the deduction available, sir? Any other deduction in here? Okay, what is the deduction available, sir? Only this 1,50,000 is the deduction. So if you, okay, they mentioned as 115 BAC, yeah? Okay, they didn't mention anything. If they didn't mention anything, then obviously it is what? Default regime. So if default regime, na, this 1,50,000 also not available. So the net total income also will be what? 38 lakhs only. So what is the tax on 38 lakhs? First 15 lakhs, 1,40,000, subsequent 23 lakhs. Okay, so the tax is like 8,30,000 plus society rate of 4%, 33,200, total 8,63,200. Average tax rate also will do. 8,63,200 divided by 38 lakhs. 8,63,200 divided by 38 lakhs into 100, 22.72%. Now we should find out the foreign tax rate. What is the foreign tax rate, sir? Did they given foreign tax rate or no? They given 5 lakhs as tax and the foreign source income as 15. So 5 by 15. 5 by 15. Sir, you might say like, sir, this 4 lakhs set off we have did na. So then you can take it as 11 lakhs na. Sir, this 4 lakhs I'll consider it as being set off with Indian income, Indian business income, not with the country A income. So then country A income is fully taxed only. So 15 lakhs fully taxed na. So the tax is like how much? 5 by 15. It is like 100, 33.33%. So which is lower? Average tax rate only. So apply that average tax rate into double taxed income 15 lakhs. You will get 3,40,800 as the relief. Subtract that, you will get the tax payable. Okay. Then sir, there are questions, sir. We'll solve as many questions as possible because DTAA the questions will be of different models. So no worries, we'll discuss multiple questions here, no problem. But before that, we'll go and discuss one more theory question, sir. The theory question is about P. You see, this question we already discussed. Explain methods of bilateral relief in DTAA and briefly state how unilateral relief is provided. The theory first, the methods and all. Okay, if you go through ones also, you will understand this one. Then PE concept I will discuss now. We discussed already about different models of tax conventions. 3 models are there. What are those? OECD model, UN model, US model. Now we are going to discuss about what? PE. So permanent establishment. Even in NR taxation also, for 44DA we discussed PE. In 44DA we discussed about permanent establishment. Where it came? What is 44DA? Tell, what is 44DA? A person, non-resident or foreign company is having royalty or FTS income. Under 115A, it is taxable at a rate of 20%. Okay. However, if such royalty or fee for technical service is earned by a non-resident or foreign company because of a PE in India, such royalty or FTS is related to such PE or fixed place in India, then that is taxable under 44DA as per normal provisions only. Okay, you take the royalty FTS and the relevant expenses you can subtract, but you can't claim the expenses which were not related to the PE and amounts paid to head office, all those you cannot claim. Okay, so now see sir, PE, what is that PE? Sir, PE means a fixed establishment. Okay, something like a branch office they kept here, then it can be called as what? PE. It means a fixed place of business through which business of an enterprise is wholly or partly carried out. Okay, it's a fixed establishment in India. For a foreign company or for a foreign business, they are having a fixed place of business, place of business in India through which they will carry out the business either wholly or partly. So it could be a place of management. I mean the place where the board of directors will sit, like corporate office, head office, place of management. Or it could be a branch office where sales are happening, or it is an office, it is a factory, workshop, it could be a factory, a workshop, or a mine, oil, gas quarry, or any other place of extraction of natural resources. A mine, oil, gas quarry, or any other place of extraction of natural resources. Okay. So PE could be what? It's a place of management, it could be a branch, it could be an office, factory, workshop, and even if they are into mining activities or oil exploration, such site is also can be called as what? PE. And not only this sir, it also includes a building site or project site if such site or project activities last for more than 6 months. Sir, the foreign company is making a construction project here and the project will go on for 2 years, which is more than 6 months na. So that also has to be taken as what? PE only. It includes even consultancy service by an enterprise through employees or other personnel engaged by the enterprise if activities continues for a period or periods greater than 183 days in a fiscal year. Okay, PE even includes what sir? A consultancy service provided from India where the employees and personnel are engaged and they will continue for operating for a period more than 183 days, then also it is called as PE. Then exclusions to PE. Okay, it's not a PE merely by reason of using facilities solely for the purpose of storage or display of merchandise belonging to the enterprise. Sir, you are having a fixed establishment kind of here, go down kind of or something here, but there you will store your goods and merchandise and you just display. If someone comes, you will show, you will not sell anything, you will just keep there and you will display, then it is not a PEC. Use of facilities solely for the purpose of storage or display of merchandise belonging to the enterprise. Use of facilities solely for the purpose of storage and display. Then maintenance of stock of goods or merchandise belongings to the enterprise solely for the purpose of storage and display. Sir, you are maintaining them, I mean you are preserving them, you are packing them, but only for what reason? Just to store and display. Third one, maintenance of goods merchandise solely for the purpose of processing by another enterprise. Sir, you brought goods from your foreign country to India and you are keeping here. Why? Some other person in India will do some kind of activities, maybe polishing, maybe some other outsourced job will be done by a Indian entity on them. You are not going to sell anything. See, maintenance of goods merchandise solely for the purpose of processing by another enterprise. Then the last one, last but one, maintenance of a fixed place of business solely for the purpose of purchasing goods, merchandise or collecting information. Sir, the problem is only with what? Selling. They can keep goods here, they can display goods here, they can manage those goods for storage and all, and then they can even maintain them, they can even keep them for processing by a different person, they can purchase goods from here, they can collect information from here. Okay, and then maintenance of fixed place of business for the purpose of advertising. They are running fixed place for what? For doing advertisement. supply of information or for scientific research which has preparatory or auxiliary character. It's not the main character. Okay, it's like auxiliary or preparation for starting a new business, then it does not amounts to PE. Sir, again there is a difference in definition of PE in OECD model and UN model. What is the difference? As per OECD model, sir, PE does not include the use of facilities solely for the purpose of storage, display or delivery of merchandise belonging to other enterprise. As per OECD model, from a place you are just storing goods, not a PE. Displaying goods, not a PE. Even you are delivering goods, not a PE. Okay, the agreements and all will be made from foreign country only, but in from Indian place you will just deliver them. Okay, still it is not a PE as per OECD model, but as per India UN model, PE does not include use of facilities for the purpose of storage or display. There is no delivery of goods as per UN model included in PE. So as per UN model, from a place you deliver goods, then that is PE only. You just store and maintain goods, not a PE. As per OECD model, if you store the goods, deliver the goods also, it is not a PE. So this is about what? The permanent establishment concept. Then sir, these two theory part also. Section 90, section 90A. Okay, so this two parts, sir, we already discussed like what? Under 90A there will be relief, and even 91 also there will be relief. 91 when there is no DTAA with that country, unilateral relief. There are 4 conditions. First one, SC should be resident of India to get that relief. Second one, there is no DTAA with that country. Third one, that is a foreign source income only. It does not accrued in India or deemed to be accrued in India, such income. Fourth one, the tax is paid in the foreign country. Then unilateral relief is available. How to calculate unilateral relief? Find out, include foreign source income and calculate tax, find out average tax rate, then even foreign tax rate, compare those two, whichever is lower, multiply it with the double taxed foreign source income, you will get the relief. Okay, now this concept is about when the DTA will be entered under section 90 and when the DTA will be entered under section 90A. Agreement with foreign countries and specified territories. See, it allows, section 90 allows Indian government to enter into agreements with foreign countries or specified territories to provide relief or to prevent double taxation. As per section 90, Indian government itself can directly enter into an agreement with a foreign country or specified territories to provide relief on double taxation. Okay, what does this agreements or treaties aims for? They aim for avoiding double taxation by way of providing relief, and then without creating opportunities for tax evasion and tax avoidance. Sir, with the chance of or with the means to create tax relief, they cannot provide routes for tax evasion. Okay, so they'll avoid double taxation by providing relief. Same way they even mitigate the opportunities for tax evasion and avoidance also. Third one, they'll exchange information. Both the countries will share information like how much incomes he is having, how much incomes he is having from India. Both that information will be shared for prevention or avoidance of double taxation, and even recovery proceedings also. Let's say there's a person who has to pay tax in India, but that person is there in UK. That person is there in UK, is not paying taxes to India. Then India can coordinate with that country by using the principles under DTA, and that country will pressurize on that person to pay taxes in India. Recovery of income tax under this act or corresponding foreign country or specified territory. So what does the section 90 related DTA aim, sir? To provide a relief for double taxation without creating opportunities for tax evasion. The relief will be given without creating opportunities for tax evasion and tax avoidance. There will be exchange of information for prevention of avoidance of double taxation, and there will be recovery of income tax under this act or the corresponding foreign country or specified territory. Then 90A. 90A is what? Adoption of agreements by central government which were made by specified associations for double taxation relief. Sir, here The relief is not entered or the treaty is not entered by government. They were entered by specified associations. But the central government will adopt such treaty. See, any specified association of India entered into an agreement with specified association in the specified territory outside India. So not directly by government. Certain government bodies like CBDT and all, or maybe RBI, or maybe some bank representing India, like that. A specified association of India is entering into agreement with a specified association of foreign territory. Then central government by notification in the official gazette made such provisions for adopting and implementing such agreements that could be adopted by central government. Okay, what does it aims? It aims again on avoidance of double taxation for providing relief without creating an opportunity for tax evasion or tax avoidance, exchange of information for prevention and avoidance of law, and even for recovery of income tax as per IT Act, or even for foreign country or specified territory Act. Then SC, if he is a non-resident to whom DTAA is applicable. SC is a non-resident and for him also DTAA relief or benefit is available. Then he can claim that relief only if he has certificate of being resident in any country or specified territory outside. He should get a proof that he is resident in any other country. That itself is only called as tax residence certificate. When it is needed, sir, he is a non-resident, but still he wanted to claim the DTA benefit, some relief. Then he has to provide tax residence certificate, which is a certificate, residence certificate given in the foreign country stating that he is resident of that country. Okay. With this, sir, we have completed the theory part, sir. Okay. So there are certain questions to be solved. So now again we'll go into the questions. Amar, an individual, is resident of India, receives the following payments after TDS during the previous year 24-25. The professional fees on 17th August is like 2,40,000 and professional fees on 4th March is like 1,60,000. These are like after TDS and both the services were rendered in country X. Okay, so both are like foreign sources incomes only after TDS. So we want what? The gross amount after TDS, before TDS. So before TDS, TDS amount 80,000 if you add, it is like 4,80,000. Okay, and then he had incurred expenditure of 2,40,000 for earning these incomes. Okay, subtract that 2,40,000. Then you have PGBP income of how much? 2,40,000. Then he has income from other sources in India 5 lakhs. So add that IFOS income 5 lakhs. What is the gross total income? 7,40,000 is the gross total income. He has made payment of 70,000. He has made payment of 70,000 towards LIC. Compute tax liability of Amar and also the relief under 91. Sir, understand here. Will he get? He has made payment of 70,000. Will he get any relief here, ATC deduction here? No, because they didn't mention like he has opted for old regime. Okay, or opted out from default regime. So obviously it will be under what? Default regime only. It will be under default regime only. It will be under default regime. Okay, it will be under default regime. Okay, fine. So then no chapter 68. So that means net total income is also 7,40,000 and 7,40,000 in new regime, default regime. What is the tax payable? 3 to 7 lakhs, 5% is 20. On above 7, 40,000 into 10%, 4,000, 24,000 is the tax plus 4% cess. So tax is total 24,960. Okay, we need to find out what average tax rate. 24,960 by 7,40,000. How much? The average tax rate equals to 3.37%. And foreign tax rate. So how much is the tax paid in foreign country? The TDS deducted only 80. 80 by 4,80,000 because the foreign income is 4,80,000. On that the tax deducted is 80. So for equals to 80 by 480, which equals to 16.667%. So which is lower, sir? Average tax rate. So what is the total relief available? What is the double taxed income, sir? 4,80,000 is the first source income, but on that 2,40,000 expense is allowed, na? So the double tax income is only 2,40,000. So 2,40,000 into 3.337 percentage can be given as relief. 8,088 will be given as relief. The balance has to be paid as tax. Okay, 16,870 has to be paid as tax. Okay, done. Then question number 8. Miss Kavita, age 63 years, sir, senior citizen, is a resident individual and a classical dance performer. Okay, during the previous year, she earned income from India as well as from country X. India does not have a DTAA with country X. Her income and investments are as follows. Rental income from residential house property in country X is 28,000. Okay, from there we can subtract municipal taxes 250. How much, sir? It would be 27,750. Convert into Indian rupees by using 70 XED. Canadian 19,42,500. From there we can take 30% standard deduction. If you subtract that, how much will be the income from house property? 19,42,500 minus 30% standard deduction. If you do, net of standard deduction, tell straight away. 13,59,750. Okay, this is like income from house property. Okay, done. Professional income from concerts in India. Okay, now PGBP head, sir. Professional income from concerts, how much? 16 lakhs. Then professional income from concerts in country X, how much? 11,200. Okay, we should convert it into using 70. 11,200 into 70, how much? 7.84 lakhs. Okay, then any other PGBP income is there? No. So if you add together 16 lakhs plus 7.84, the total PGBP is how much, sir? 23,84,000 is the PGBP income. Okay, two things are there. Then IFOS. Under IFOS, how many incomes she is having? She is having interest income from FD 3,25,000, 3.25 lakhs, and savings bank account 18.269. Okay, 18,269. So total how much? 3,25,000 plus 18,269. 3,43,269. Okay, so then we have to get the gross total income. No other incomes, na? Gross total income. House property 13,59,750. PGBP 23,84,000 and IFOS 3,43,269. If you do, you will get the gross total income. 40 lakhs 87,019 is the gross total income. But if you look at the question, they clearly said like not opted for 115 BSc. I mean old regime. In old regime, deductions are available. Investment in PPF, first interest income related, since she is a senior citizen, 80 TTB deduction is available up to 50,000. It is available on both FD interest and savings bank, so you can take 50,000. Then investment in PPF, 80 C deduction. Then medical insurance premium paid for self. For self, sir, he is a senior citizen, and for spouse together, senior citizen, 50,000 is allowed. So overall total of the chapter 6A deductions are 80 TTB 50 and 80D 50, 1 lakh plus 80C 1 lakh 50, total 2 lakh 50,000 is the deductions available. If you subtract 2 lakh 50,000, what is the tax payable, sir? For net total income is how much? 38,37,019. So we need to find out the tax payable under the old regime. Old regime, first 10 lakhs, 1,12,500. On the balance 28,37,019, you should apply 30%. Okay. Okay, sorry. He is a senior citizen, sir. If he is a senior citizen, the tax payable is on first 10 lakhs is not 1,12,500. It is only 1,10,000. So 1,10,000 plus 28,37,019 into 30% tax plus cess 4%. How much, sir? 9,99,549. Okay. Okay. So rounding off it to 550. Okay, so this is the tax. Now we need to find out what average tax rate. Average tax rate, how we will calculate? Tax plus cess divided by net total income. What is the average tax rate, sir? So we will be calculating relief because the sets are already India does not have DTAA. So India does not have DTAA, na? Which relief? Unilateral relief. Relief under section 91. How to calculate? First we need to find out the average tax rate. How much is the average tax rate, sir? 9,99,550 by 38,37,019 into 100. What is the average tax rate? 26.05 percentage. Whereas foreign tax rate is only 20 percentage. So which is lower? Foreign tax rate 20 percentage is only lower. So that 20% we should apply on double taxed income. What is the double taxed income, sir? House property 13,59,000 is the double taxed income, and PGBP 7.84 lakhs. IFRS nothing is there. So if you add 13,59,750 plus 7.84 lakhs, 21,43,750 into 20 percentage is the relief. 4,28,750 is the relief. If you subtract that, the final tax payable will be 5,70,800 is the final tax payable. Okay, so the questions are as easy as that, sir. Just you should have the basic understanding of chapter 60 deductions and the heads where they will be coming, and those points you should remember. Okay, now we are moving on to question number 9. SSC Arnav is a resident and ordinary resident. His age is how much? 58 years. He has opted old regime. Arnav earns income from both India and foreign country during the previous year. He provides business income in India. How much? 4 lakhs. Business income in foreign country 9 lakhs. Okay, so total how much, sir? PGBP income itself is 13 lakhs. Okay. Then premium paid for medical insurance for his non-resident father. Sir, medical insurance premium paid for non-resident father is also eligible for deduction under 80D. But senior citizens na 50 na, that benefit is not available. Since he is a non-resident, only 25,000 can be claimed as deduction. Okay, no other income now, so that itself is the gross total income 13 lakhs. From there, if you take chapter 6A, 25,000, and the net total income is how much? 12,75,000. Okay, on 12,75,000, what is the tax, sir? Tax plus cess. First 10 lakhs, 1,12,500 plus 2,75,000 into 30 percentage plus cess at a rate of 4 percentage. How much? Including cess, sir? 2,02,800 is the tax plus cess. So we need to find out what average tax rate. What is the average tax rate, sir? 2,02,800 divided by 12,75,000. If you do, how much is that one? 15.90 percentage is the average tax rate. So the relief under section 91 equals to, what is the double taxed income, sir? 9 lakhs. So 9 lakhs into, what is the foreign tax rate? 22. Indian average tax rate is 15.9, which is lower? Indian tax rate. So 9 lakhs into 15.90 percentage is the relief. How much? 1,43,100. If you adjust it, then the final tax payable is like 59,700 is the final tax payable. They got 650. One lakh 43,153. It is like that 1,43,100. 9 lakhs into 15.90%. How much? Do it again. 9 lakhs into 15.9%. 1,43,000. Then they got 1,43,153. I mean, is it exactly 15.90 or something is that? 2,02,800 divided by 12,75,000. Okay, 15.905 percentage only take and apply on 9 lakhs into 15.905 percentage. and it's like 1,43,000. 9 lakhs into 15.905%. One lakh 43,145. If you subtract that, that would be 59,655, close to that. Okay, let me check here. 2,02,800 divided by 12,75,000 equals to 15.906%, not 5. Rounded off to. Okay, 9 lakhs into 15.906%, if you take, it will come to 1,43,154. Yes, correct only, sir. Okay, it's like the tax rounding off, sir. Sir, understand, average tax rate, you take it up to 3 decimals. Okay, you take up to here like 3 decimals. The third decimal also you should think of rounding off. So then we are continuing to the question number 10, sir, which is an important question. Question number 10. The SSC is a popular Kollywood star, Mr. Sohan Lal. He has business interest in few other nations as well. He is resident in India for the assessment year 25-26. Income earned in India by Mr. Sohan Lal during the year is like income from house property already computed 4.3, business income 12.4, acting in movies. Sir, both are business only. This is business, this is profession. So both will come under PGBP head only, business and acting in movies. Sohan has deposited 1.5 lakhs in PPF, life insurance premium 1 lakh. So we need to check which option or which regime he has opted. He has opted for 115 BAC only, so old regime, sorry, new regime, default regime. So in default regime, you will not get ADC deductions, so there is no need to worry about investment in PPF or insurance premium paid. The details of income earned by him in two countries outside India are like X and Y, with which India does not have a DTAA during the previous year 24-25. Okay, so what are the incomes? He is having loss from house property in country X 1.3. Business income, here it is like 7.2, in Y 2.9. Share of income from partnership firm not evidenced by an instrument in writing. Sir, one point which I need to clarify is like usually partnership firm, if it is having any profit, on that profit firm will pay tax. On this profit, tax paid to government. Then subsequently, one firm distributes share of profit to partner, when firm distributes share of profit to partner, this share of profit is exempt under income tax. This is exempt under section 10 when the firm is distributing share of profit. But the point to be remembered is like only if this firm is in India, distribute share of profit, that also by which firm? Indian partnership firm. Here in the question, the partnership firm is located in which country? In country X or country Y. So there is no exemption for this, no exemption. And they are having even agriculture income of 1.2. Agriculture income of how much, sir? 1.2. Okay. So then agriculture income, sir, usually agriculture income is exempted. But if agriculture income is from outside India, then it is what? Taxable. So that's why this 1.2 lakhs or 1.2 crores is also taxable. Okay. In country X, share of income is not exempt and loss from house property is not eligible for set off. Okay, in country Y also agriculture income is taxable. The taxes paid are like 2.16 crores and 80 lakhs on the total income earned by these two countries. See, sir, we'll take like head by head, headwise. So what is the income from house property given in the question, sir? The income from house property given in the question is like 4 crore 30 lakhs. Straight away they only given. Income from house property they only given straight away 4 crore 30 lakhs. Then we'll go to PGBP head. So in okay, so okay, fine. In country X there is loss from house property. So the loss from house property with other heads under new regime, the loss from house property cannot be set off with other heads. Okay, the loss from house property cannot be set off with other heads. But here the loss from house property same head na, so it is eligible for set off even though it is in a foreign country. How much sir loss from house property is like 1.3 crores, 1 crore 30 lakhs. If you set off, then it will come to total 3 crores is the net income from house property. Fine. The next one PGBP, profit and gains from business or profession. Profit and gain from business or profession. Profit and gain from business or profession. How much is there, sir? They are having business income 12.4 crores. Business income how much? 12.4 crores. And acting related how much is there? 9.415. Okay, so this is the PGBP in India. Then from there having country X also. Country X. How much is there from country X? 7.2 is the own and share of income 4.8. Own business income 7.2 and share from firm is also taxable 4.8. Then we are having even from country Y. How much is there from country Y? 2.9 is there. Okay, there is like 2.9 crores and agree also how much? 1.2. So agree can be even taken under IFOS. Okay, if it is the main business activity only, then they can take it under here also. So this 2.9 is what their own business income. So if you total all those, what is the total PGBP income, sir? 12.4, 9.415, 7.2, 4.8, 2.9, 1.2. 37 crores 91 lakh 50,000. That's what his total PGBP. Okay, so they're taking it under IFOS, sir. As I said already, agree income, it depends. It could be even taken under IFOS also. So what is the gross total income, sir? 40 crores 91 lakh 50,000 is the gross total income. From there we should subtract what? Chapter 6A. But new regime, sir, only under new regime, default regime, only 80 JJAA, 80M and then 80 CCD subsection 2, okay, 80 CCH subsection 2, only those deductions are available. Since these are not there, nothing to be claimed. So that itself is the net total income, gross total income, net total income. So tax, sir, okay, we need to calculate as per the normal slab rates only. How much? 12 crore 24 lakh 35,000. 12 crore 24 lakh 35,000 only tax plus surcharge, sir. What is the surcharge applicable to individuals, sir, under the default regime? Up to 50 lakhs nil, 50 lakhs to 1 crore 10 percentage, 1 crore to 2 crores 15 percentage, about 2 crores 25. There is no 37 percentage, sir. In old regime there is something called 37 percentage also. So surcharge we have to levy at a rate of 25 percentage. How much is the surcharge, sir? 25 percentage. If you levy, the surcharge would be 3 crore 6 lakh 8,000, 3 crore 6 lakh 8,750. Okay, plus on tax plus surcharge you need to levy cess also into 4% cess. Okay, how much is the cess, sir? We got 61 lakh 21,750. If you add all this, then you will get total of how much? 15 lakh 91,000 91 lakh 65,750. Oh, sorry, 500. Okay, this is what the total tax payable. Okay, then we need to find out what average tax rate. So tell me quickly, sir, what is the average tax rate? How much is there? 15.91655 divided by 40.9150 into 100. If you do 15.91655 divided by 40.950 into 100, what is the average tax? 38.901. So okay, afterwards one only na, so no problem, you can take 38.90%. Okay, then foreign tax rate. So okay, we need to find out the foreign tax rate. So first, country X. In country X, how much tax they paid, sir? In country X, they paid 2.16 as crore. Okay, 2.16 crores as the tax. But whereas the country X income is how much, sir? Country X income, sir. Sir, actually, if you see, there is like loss from house property 1.3, 7.2, 4.8, 12 minus 1.3. It is like 10 crore 70. But the problem is, like in the question, they clearly said, like in that country, loss from house property is not eligible for set off. So we should take what? 12 crores only. So country X, how much? It is like 12. It's like 12 crore, 2.16 divided by 12. So 12, that equals to how much? 18% is the country X tax rate. Then country Y. Country Y, what is the tax paid, sir? 80 lakhs. What is the income from country Y? 2.9 plus 1.2, it is like how much? 4.1. So 0.8 by 4.1. 0.8 by 4.1. It equals to. Okay, so in both the cases, foreign tax rates are only lower. So relief has to be given based on foreign tax rates only. So relief under section 91. So first, country X. Country X, what is the double taxed income, sir? 12 crores. 12 crores into 18 percentage. Country Y, what is the double taxed income? 4.1 crores into 19.512 percentage. You multiply this 12 crores into 18 percentage and 4.1 into 19.512 percentage. You will get the relief also. How much, sir? What? Okay. One second. The double taxed income, sir. Okay, understand the points, sir, here. The double taxed income, how much they have taken? Okay, 10 crore 70 only. Fine, it's correct only, sir. Why they have taken 10 crore 70 only, na? Because in India, the house property loss is eligible for set off, na? In India, we are setting off what? House property loss. That means house property loss is getting adjusted from 12 crores, right? See, in foreign country, why we are taking 12 crores as the here? If you see, while doing what I did, I took 2.616 by 12 crores. Why I did 2.16 by 12? Because in foreign, there is no set off eligible in country X. That's why we are taken total 12 crores, because in country X, 12 crores is taxable. But in India, 12 crores is not getting taxed. That house property loss is eligible for set off, na? So that benefit we are getting, that loss set off. That's why effectively it's not 12 crores, it's only 12 crores minus house property loss. So what is the double taxed income, sir? It's not 12 crores. So it's like only 10 crore 70 lakhs. Ten crore 70 lakhs into 18 percentage. So it's like 10.7. How much? 1 crore 92 lakh 60,000. And here the other one, it would be how much, sir? The other one would be 80 lakhs. So total the deduction available is how much? 2 crore 96 lakhs. Okay, so it's like not 2 crore 96, sir. It's a mistake. 2 crore 2 crore 72 lakh 60,000 is the total deduction available. Okay. One second, wait. Sir, calculate year rental 10 crore 70 lakhs into 18%. Okay, then do 80,000. It is how much? The same, right? 2 crore 72 lakh 60,000. Okay, fine. Then if you subtract 2 crore 72 lakh 60,000, we'll get how much? 12 crore 95 lakh. How much will be the net tax liability? 12 crore? 19 lakh 5,500. Okay, so where this multiple difference is coming, sir? Sir, one other view which could be taken is like, okay, the other view which could be taken is like, in here one view they are taking what? They are taking relief on 12 crores by taking double taxed income as 12 crores. That view also possible. If you take that view, then it would be 2 crore 16 lakhs plus 80, it would be 2 crore 96 lakhs is the relief. Understand? Then here also it would be 2 crore 96 lakhs only will be the relief. So why this dispute is coming? Sir, one view, sir, okay, my view, house property loss is being set off in India, the foreign country house property loss. But if at all there is only country X income, if at all there is, yes, set off is possible, but if at all there is only country X income in India, there is no other corresponding house property income in India, and only the foreign income if they are having, and if it is taxed in India, house property loss is not eligible for inter-head set off. Sir, simple point, sir, don't get confused. Here we are having foreign source incomes from country export, business income, firm income, loss from house property. Assume this fellow is having only these three incomes in India. Then the double tax income would be 12 crores only, because this house property loss is not eligible for inter-head set off. Then obviously 12 crores will be the double taxed income. That is one view. But here, even though, okay, in India there is having house property loss now, so with that this 1 crore 30 lakhs is being eligible for set off. So effectively the double tax income is only 10 crore 70 lakhs, not 12 crores. Okay, so any of the view can be taken, sir. Then we are moving on to question number 11, sir. Bist aged 58, a resident of India, has business activities in India as well as country, with which India does not have a DTAA. Okay, speculation business 9 crore 67 lakhs. Okay, sorry, 9 lakh 67,000. Speculation, the trading, sir. Rent received from let out property 6 lakhs. Sir, it is the gross rent, sir. We need to take standard deduction, and the property tax paid also we need to subtract. First property taxes. So first we will take what, sir, here? Income from house property. What is the income from house property, sir? Okay, rent 6 lakhs minus, we should subtract what? The municipal tax 72,000. What is the okay, gross GAV from the municipal taxes? If you subtract NAV, it is like 5 lakh 8,000. From there is no interest given, so 30% standard deduction if you subtract. Okay, so then what is the net income from house property? 3,69,600 is the net income from house property. Done. Then we'll go to next word, PGBP. Okay, so we'll be going to PGBP. So under PGBP head, what is having? Under PGBP head is having the loss. Okay, speculation business. How much is the business gain? 9 lakh 1,000. Gain it is. Okay, but there is a loss. Sir, someone will be having a question like, with speculation business loss can we adjust normal, with speculation business gain can we adjust normal business loss? Understand, sir? With speculation business profit you can adjust any business loss, but the speculation loss has to be adjusted only with speculation gains. So we can adjust here. So loss, how much is that, sir? 1,24,000 is there. Okay, then any other business incomes are there, sir? Nothing. Other IFOS incomes only, rest all. Like, then what is the net? 8 lakh 43,000 is the PGBP. Then we'll go to IFOS head. Under IFOS head, what are there? Interest from bonds and bank deposits, 6,74,000. This is also foreign source. And then nothing else is there, sir. So we'll take what? 6,74,000. If you total all these three, like house property, PGBP and all, you'll have gross total income. How much? 18 lakh 86,600 gross total income. On this gross total income, chapter 6, sir, he opted for which regime? Normal tax rate. He opted out from default rates. So opted out from default rates now is eligible for chapter 6A deductions. PPF 1,20,000 for handicapped brother dependent on him. Okay, for handicapped brother dependent on him. Okay, PPF contribution, sir, if you see, it can be made only for self, spouse and children. PPF contributions made with respect to self, spouse, but let me show you, sir. See, PPF contributions on the name of individual himself, spouse, child, if HUF na with respect to members is eligible for deduction. Okay, here what they did, they have contributed with respect to handicapped brother. Okay, handicapped brother only na, that's not eligible for deduction. So ATC is eligible for how much, sir? 1,20,000 ATC. Then what is the net total income, sir? The net total income will remain how much? 19 lakh 6,600 is the net total income. Then on this tax plus cess we need to calculate under which regime, sir? Old regime. So if you calculate that 3,56,179 is the tax plus cess. Without cess this is like, okay, plus cess. Then we need to find out relief. So for relief, first we need what? Average tax rate. Average tax rate is how much? 3,56,179 divided by 17,66,600. How much? 20.16% is the average tax rate. Then foreign tax rate, right away again 15%. So which is lower? Foreign tax rate. So we need to find out the double taxed income. Sir, the double taxed income is like, what is their business income, sir, from foreign country? We are having business income of like loss 1,24,000. Okay, that is also set off now. So take 1,24,000 negative. Then what else they are having? They are having interest from bonds and deposits 6,74,000. Then anything else they are having from country? Only these two. So they effectively, after setting off the loss, they are having only a tax of how much, sir? 5,50,000 is only the double taxed income into 15% if you do. What is the relief available? How much? 500. So this it is available for relief. The balance is the taxpayer. Okay, the balance 2,73,680. Then question number 12. Madhu, an Indian resident aged 34 years, is a trainer in marketing. He takes online classes for persons resident in country for the years ended 31st March 25. He gives the following details about his income. Okay, dividend from Indian companies he got how much? 2,87,500. Dividend from Indian companies. Interest on monies borrowed for interest in share investment in shares is how much? 90,000. Okay, sir, dividend from Indian companies. Sir, dividend, they didn't said like dividend received from Indian companies. If it is said like dividend received from Indian companies, then you will take the amount received as 90% net of TDS. But here they didn't said like received na, that's why we'll take it as like what? Gross amount only. Okay, gross amount. Okay, so with respect to dividends, sir, there is a deduction allowed under section 57 IFOS. What is that one? To earn the dividend or to invest in such shares, if any loan is taken, on that if interest is being paid, such expense can be taken as deduction from dividend. but that is restricted to 20% of the dividend received, 20% of the dividend income or actual expense, whichever is lower. Okay, so here dividends are 2,87,500 minus expense allowed is like 2,87,500 into 20% or 90,000, whichever is lower. Obviously 20% one is only lower, which is how much? 2,87,500 into 20%. Okay, this is allowed as deduction. So net after this it would be 30,000 is the dividend that is taxable under IFRS. Okay. Then amount received from online classes from countrywide residents is 45,000 per month. Tax rate on such income is 15%. So how much they got, sir? 45,000 into 12. How much he got? Like 5,40,000 is the foreign source income. Then he has long term capital gains on sale of listed shares of Indian company 26 lakhs. And 24 lakhs is computed with indexation. Sir, on listed shares indexation is not available, sir. So we forget about 24 lakhs. Capital gains was computed without considering the investment of 10 lakhs in capital gain bonds of REC within prescribed time. Sir, 54 REC bonds, it comes under 54 EC deduction. 54 EC exemption will come only when 54 EC exemption will come only when the capital asset, long term capital asset being transferred is immovable property. Here the asset transferred is listed shares. Since they are listed shares, you can't claim 54 EC exemption. If the capital asset transferred is a immovable property, what immovable property, then 54 EC exemption can be claimed. So here 54 EC exemption is not available. Only 26 lakhs is taxable. So if you take 5 lakh 40, then capital gain 54 is not available, 26 lakhs, then 2 crore 30. So the total income is what? 33 lakhs 70,000. On the tax on long term capital gain, sir, why it is taxed at 10%? Here they didn't given the date of long term capital gain. If you remember, sir, there is a rate change. Before 23rd July it is only 10% in excess of 1 lakh. Post 23rd July the tax rate is 12.5% in excess of 1.25 lakhs. So here we will be taking it as what? Okay, the before 23rd July. So 25 lakhs into 10%, 2 lakh 50. And on the rest of income, slab rate 66,500. So you will be getting the total tax payable as how much? 3 lakh 29,160 on that average tax rate. And then double taxed income is only the online classes income into foreign tax rate or Indian average tax rate, which is lower. Indian average tax rate. If you calculate, you will get the relief. Understand, sir? So how many questions are there till 13, 14, 15, 16? Okay, so let us go to straight away 18th question, sir, and then we'll go back. So this is June 25 MKP question. Mr. Arun is an Indian resident aged 49 years, is employed as supervisor at ADNOC in the country UAE, earning a monthly salary of AED 7,500. In order to look after his ailing mother in Mumbai, he shifted with his family on 1st July and started his consultancy business in India. Before shifting to India, he let out his house property in UAE. From the same month, he stayed in India. In last 7 years is 780 days and he was resident in 5 previous years. See first. Arun is an Indian resident. So here itself it is clearly said. No problem. Okay. He is employed as supervisor in the country UAE. Monthly salary 7,500. In order to look after his ailing mother, I mean she is having some health issue, he shifted to family on 1st July. That means for April, May, June he received salary per month 7,500 so he received how much salary? 7,500 into 3 months he received salary. Okay, so what is the conversion rate of the dollar, sir? Is it given? Yes, 25. 7,500 into 3 months into 25 is the salary he has received. Okay, from there you should even subtract standard deduction. Sir, he opted for old regime or new regime? Opted out from old regime. Oh, sorry, new regime, default regime. So what is the standard deduction? 50,000. Okay, so that is what we will do for salary head. 7,500 is the monthly salary. For 3 months he got till July into 25 minus standard deduction we should do. Then after standard deduction, 5,12,500 is the salary income. Fine, done. Next one, sir, is having, he let out his property there. What is the, from when? 1st July only, 9 months. Because once he shifted to India, he started letting out his property outside India. From there, how much rent he got from house property? 9 months, sir. 4,250 into 9 into 25. How much? From there, standard deduction 30% is available. After standard deduction, net amount you tell directly. Is the house property. So this is income from salary, this is like income from house property. Foreign source incomes only, both. Then the details of his income in India are like profit from consultancy business 8,35,000 PGBP, FD interest like IFOS, UAE, this is also a foreign source income, sir. Savings bank interest also IFOS, dividend income also IFOS. Okay, so if you take all these, okay, all these respective heads, you will be getting what? PGBP, house property, and even IFOS. Okay, now old regime, na he is eligible for any deduction, sir. First, he is not a senior citizen, so 80 TTA deduction is only available with respect to savings bank interest. 80 TTA, how much? 10,000 deduction is available. Then he has paid 56,000 as medical insurance premium to insure the health of his father, a non-resident, age 76. So it is only allowed up to 25,000. Whereas for himself he paid 45,000. Since he is also not a senior citizen, only 25,000. So total deductions available are like 60,000. If you subtract those 60,000, then the net total income is 20,25,375, rounded off to 380. Then computed tax on it using old rates, it came to 4,36,090. Okay, now relief. Sir, what is the double taxed income, sir? The double taxed income is like this house property 5,12,000, sorry, salary 5,12,500, house property 6,69,375, and then here there is UAE interest 45,500. These three are the double taxed incomes. On that you should apply either the average tax rate or the UAE rate 25%, whichever is lower. Here the average tax rate is what, sir? Average tax rate is 21.572, whereas the foreign tax rate is 25. So average tax rate is only lower, that itself is applied. You got 12 crore 27 lakh, sorry, you got how much? The relief as like 21.572 into 12 lakh 27,375, 2 crore 64 lakh 769 is the relief. Then you will get the net tax payable. Okay, then we'll move on to question number 70. Mr. Virat Pandey, aged 62 years, a resident individual, furnishes the following particulars of income earned by him in India and in Canada for the previous year. India does not have a DTAA with Canada. Gross salary in India 6,25,000. Professional income received in country Canada 4,80,000. Okay, sir, gross salary, this is like on 6,25,000. Standard deduction is available. They have opted for default regime, sir. Under default regime, the standard deduction currently available is how much? 75,000. So the net salary is how much, sir? Here 5,50,000 under that salaries. Okay, then they have PGBP income, sir. Okay, then they have house property income, sir, 1,80,000. But on this there is 30% standard deduction available. How much? 56,000. Okay, if you subtract that, what is the house property income? 1,80,000 minus 1,26,000. 1,26,000. This is a foreign source income, sir. This is foreign source. Okay. Then professional income received in country Canada 4,80,000 straight away, foreign source. Dividend income, foreign source, straight away taxable. Interest income, IFOS. Okay. Then he have paid interest on housing loan, sir. Old regime na eligible for ADC deduction. Now not eligible. PPF not eligible. Medical insurance premium not eligible. So what is the total, sir? Income from salary 5,50,000. House property he is having 1,26,000. Then he is having professional income 4,80,000. Then he is having IFOS, sir, 88,000 dividend, and then 62,000 interest. So total it is another 1,50,000. If you add all these, then you got the gross total income as like 13,06,000. 13,06,000. On that you calculate tax. How much, sir? Total income. On that, if you calculate tax using the new regime, what is the tax payable, sir? 1,05,248 deduction. For deduction, sir, for the relief under 91, we need to find out average tax rate. 1,05,248 divided by 13,06,000. The average tax rate is like 8.058 percentage. Whereas the Canada rate they given straight away, how much? 12 percentage. So which is lower? Average tax rate only. So double taxed income. Now we need to find out double taxed income. What is the double taxed income, sir? This gross salary, sorry, not salary, sir. This house property 1,26,000 is double taxed. And then foreign source income 4,80,000, professional income, dividend income 88,000. So these three are the double taxed incomes. If you add all these three, how much you got, sir? Double taxed income as like 6,94,000. 6,94,000 into 8.588 percentage. It's like 55,928 is the relief. From the tax payable, if you subtract relief, it is like 49,320 is the tax payable. Sir, question number 16, sir, there is nothing great. It's a simple sum only. Sir, one point is like a deduction related point, sir. Okay. So we'll take, sir, salary question now. What is the basic salary? 60,000 per month into 12 na 7,20,000. DA fully taxable, transport allowance fully taxable, medical allowance fully taxable. Okay, sir, none of these are eligible for exemption. So DA 12 percentage na 7,20,000 into 12%. How much? 86,400. Then transport allowance 1,20,000. Then medical allowance 60,000. If you do all this total, he'll get gross salary. How much is his gross salary, sir? Is his gross salary. From there, sir, he has opted out of default regime, so old regime. So standard deduction 50,000. So what is the net salary? 9,36,400. Then he contributed 18,000 to approved pension fund of LIC, eligible for ATC. He also paid 2 lakhs by cross check for medical insurance premium to ensure health of his mother aged 63 years. And it's a lump sum payment. When you paid 80D medical insurance premium in lump sum, you can take it over the tenure, 5 years na. So for a year 40,000. And she is senior citizen only na, so up to 50,000 allowed, so no problem. So total deductions are like how much, sir? He also delivered guest lectures in a reputed university in country A during the year. He has received 8 lakhs from such university. So what is the 8 lakhs is the IFOS income. So the total income is like how much? 17,36,400 from such university after deduction of tax. Okay. So that after deduction of tax, now this 8 lakhs is net of TDS. So we should want what? Gross amount. So 10 lakhs. So total gross total income is 19,36,400. From there, the deductions available are like 40,000 ATD and 18,000 ATC. So 58,000 if you subtract deductions, 18,78,400 is the net total income. Then after it is same. Okay. Question number 15, sir. Rahul is an Indian citizen aged 52 years, left India on 1st April 2021 to settle in country X. But owing to some personal unavoidable circumstances, he returned back to India permanently on 1st June 2024. Okay. So he came back when, sir? 1st June 2024. And he left only on 1st April 2021. Sir, in the year he came back on 1st June. So he is not there only April, May month. For the whole year he is there in India only except April, May. So his period of stay is greater than 180 days. Okay. Plus he left India only on 1st April 2021. Sir, for previous year 24-25, sir, basic condition, sir. Previous year his stay in India should be 182 days or more. Okay, it is 182 days. Okay, 182 days because it is more than 182. Then he need to satisfy both the additional conditions. What are both the additional conditions? In preceding 10 previous years, he should be resident for at least 2 years. Sir, till 1st April 2021 he is in India only, na? That means he will be resident for at least 2 years. And in past 10 years, preceding 7 previous years, his period of stay in India should be 730 days. That also he will satisfy, because till 1st April 2021 he is in India only. So is what? Ultimately is a resident and ordinary resident. So the first para, instead of saying resident directly, they are asking us to compute and decide whether he is a resident or not. So he is a resident and ordinary resident. Okay. Now he has a residential property in country Y, from where he got $25,000. Okay, and he is even eligible for a basic exemption limit of 8,000, and then he paid 20% tax in such country. So first we'll compute Indian income. So 25,000 here, 25,000 into, what is the dollar conversion rate, sir? Okay, so we'll take like what? Year end rate only, sir. What is the year end rate? 75. So 25,000 into 75. 25,000 into 75. Sir, in this question, we are converting using this exchange rates, right? For this, actually, there is a concept called Rule 115, where they suggest like which exchange rate has to be used to convert different types of incomes into Indian currency. Okay, Rule 115. So let me show you Rule 115, because there is a MQP question also. Model question paper 1 also there is a question which is linked with Rule 115. What is that one? Ankit is the CFO of, sorry, not the question, so this is the Rule 115. If at all you are having salary income, interest income, dividend income in foreign country, it is in foreign currency, then you need to convert into Indian currency. Which day or which exchange rate you should take? You should take TTBR, telegraphic transfer buying rate. That also on which day? Last day of preceding month. Last day of preceding month in which salary, interest or dividend has been paid. For salary, interest, dividend. The same thing even for short term capital gain also. If at all the transfer happens in this month, the preceding month's last day TTBR rate you should take. Okay, so here also see TTBR as on last day of preceding month. For salary, interest, dividend, capital gains, for all these four, you should take the TTBR as on the last day of preceding month. Whereas for the rest all, PGBP income, house property income, IFOS income, because salaries had covered, capital gains covered, PGBP, house property, IFOS. For interest and dividend, it is separately given. Okay, so what is the TTBR as on the last day of relevant previous year? Okay, so in simple, sir, restrict. For PGBP, house property, IFOS, the last day of relevant previous year TTBR rate will take. If it is like salary, interest, dividend, house property, so IFOS are other than interest and dividend there, last day rate. Okay, for salary, then interest, dividend and capital gains, you should take the preceding month's TTBR rate. In the month in which transfer is happened or dividend paid, that month preceding month's last day TTBR rate you should take. Okay. Here in our question, sir, we are talking about what? Yes, okay, he is having what? Residential house property income. So house property in a TTBR rate as on the last day of the relevant previous year. So 75 you should take. Okay, so if you start solving the questions, sir, then see first 25,000 into 75, how much? From there, like 30%. Okay, why 75, sir? Because the last day of the relevant previous year, the TTBR rate is like 75. From there, 30% standard deduction, how much? 18,75,000 into 30%. Okay, if you subtract this, then there is net income from house property is how much? Okay, it's like 13,12,500. Okay, till here it's done. That not no. Then PGBP. What is this income from PGBP, sir? He is having business income in India 5 lakhs for the year ended 31st March. He also received dividend amounting 1,25,000 from Indian company and interest 11,500. Sir, first PGBP income, how much he is having? 5 lakhs. So take it under PGBP, 5 lakhs, done. Then he is having IFOS incomes, dividend 1,25,000, interest 11,500. Together it is how much, sir? 1,36,500 is the, sorry sir, one point, this is only I am saying. Here they said like what, dividend received, when they given dividend received, this has to be taken as net of TDS, so 90%. You should gross it to 100%. Then it will come to 1,38,889 plus savings bank interest, total it is like 1,50,389. So total gross total income is 9,62,889. Then is he following old regime or new regime? Does not opt for provisions of section 115 BAC. That means, okay, he is under old regime only. So under old regime, sir, any deductions are there? Yes, he is having savings bank interest, so he can claim 80 TTA deduction to an extent of 10,000. Net total income is 9,52,889, rounded off to 890. Then tax payable, if you do old regime, on 19,52,890, on first 10 lakhs 1,12,500 plus 30% on it, plus cess. If you add cess at a rate of 4%, so the total it is like 4,14,302. Then relief. So relief will be providing on what? Double taxed income. What is the double taxed income, sir? Only house property income like 13,12,500 is the double taxed income. We calculated average tax rate. Average tax rate is what? 2,35,800 divided by, sorry, not 4,14,302 is the Indian tax, divided by, if you do, how much? 21.21%. Sir, did they given foreign tax rates, sir? No. So we need to calculate the foreign tax rate. How? Sir, they are having house property income there, how much? 25,000. And there is a basic exemption limit of 8,000. So that means the tax amount is like $25,000 minus $8,000. That means it is like $17,000 into 20%, which equals to how much? 1,400 is the tax. Sorry, 3,400 is the tax in foreign country. 3,400. So 3,400, if it is the tax, what is the total house property income, sir? 25,000. So 3,400 divided by 25,000, if you do 3,400 divided by 20, so the foreign tax rate is like 13.6%, which is lower foreign tax rate. So take the foreign tax rate into double taxed income, 13,12,500 into 13.6, you will get the relief as 1,78,500. Okay, similar model, sir, there is an MQP question also, recent December 25, that also will solve quickly. Set 1. Ankit age is the CFO of Bharat India. His income in India consists of salary 25 lakhs before standard deduction. Sir, did he opted for old regime? Pays tax under 115 BAC. So from this salary, how much is the standard deduction available, sir? From this salary, the standard deduction available is like 25.25 lakhs minus 75,000. So the net salary is like 24,50,000. Then interest in respect of self-occupied property is like how much? Interest in respect of self-occupied property 1,80,000. Okay, sir, but understand, sir, interest in respect of self-occupied property is not eligible for deduction under the new regime, so this ignore. FD you will take it under the IFOS side. Then he has the following incomes from the year ended 31st March. Income from business in country A, US dollars 25. House property 4,500, municipal taxes paid, and is having dividend US dollar 10,000, short term capital gain US dollar 5,000. Sir, here the main point is not about calculation, it's about which exchange rate you should take. I already said, okay, for house property, sir, what exchange rate? TTBR as on the last day of relevant previous year. Then business income, sir, same, TTBR as on last day of relevant previous year. Okay, sir. Dividend preceding month, okay, the preceding month last day TTBR, last day TTBR. Short term capital gain also same, preceding month last day TTBR. So here, sir, for first and 2 points, which exchange rate you will be taking? 31st March 2025. how much it is there? 72. Okay, for first two PGBP and house property, you will take 72 as the exchange rate. Then for dividend, sir, you will take which exchange rate, sir? March the dividend paid na preceding month na February last day is how much? 29th February 2025. So you will take here what? 70 as the exchange rate. Then for short term capital gain, it was in which month, sir? On shares, and proceeds were created in bank account in 28th March. That means the preceding month is what? February only. So last day you will take 70. Okay, so this exchange rate is only key. Rest also it will remain easy only because the rate of tax in foreign country given 20% straight away, whereas in India we need to calculate. Okay, see, first, sir, salary side income 24,50,000 after standard deduction. Then house property $4,500 from their municipal taxes subtracted, NAV from their standard deduction 2835, then converted by using 72, it is like how much? 2,04,120. Then they are having a self-occupied property in India. Okay, so from that self-occupied property, sir, the self-occupied property, okay, for self-occupied property we can't claim interest as deduction, so leave that one. So it is only 2,04,120. Okay, then income from business in country A. How much is the income from business in country A, sir? 25,000. So that 25,000 if you convert into by using 72, it is like how much? 18 lakhs. Done. Then they are having short term capital gains. How much is the short term capital gain they are having, sir? 5,000. And 5,000 we should convert it using what rate? 70. Then it will be what? 3,50,000. On sale of shares of company registered in country A, sir, not in India. Then income from other sources, they are having income from other sources, sir, what? Interest income 1,50,000, take straight away. Then they are having dividend $10,000 multiplied with what? 7 lakhs. So total is like how much? 8,50,000. The total gross total income is 56,54,120. No deductions are available, sir. Why? New resi. Then tax on 56,54,150 if you do, the tax on first 15 lakhs, it is like 1,40,000. And on the balance, if you apply 30%, the amount is like 13,86,236. Plus surcharge at a rate of 10%, 1,38,624. Plus cess at a rate of 4%. So overall, it come to 15,85,854. But in extra 50 lakh surcharge will be there at a rate of 10%. Okay. Then you need to find out the average tax rate, sir. How to find out average tax rate? 15,85,854 divided by what is the net total income, sir? 56,54,120. Do it and tell. 15,85,854. Here there is calculator. 85,854 divided by 56,54,120 into 100. Okay, 0.5%. Whereas the foreign tax rate they given in the question is how much, sir? 20%. So which is lower? The foreign tax rate is only lower. So we take what? 20%. But we need to find out what double taxed income. What are the double taxed income, sir? Like house property. House property, how much is the double tax? These are 2,04,120 from house property income. Then from foreign country they are having business income also. How much is the business income, sir, from foreign country? Like it is like 18 lakhs. That is also double taxed. Then they are having capital gain income. How much is the capital gain income that is double taxed, sir? 3,50,000. And then they are having dividend income also 7 lakhs. So if you do total, how much is the double taxed income, sir? Is the double taxed income. Sir, some people might be having a question. Sir, on short term capital gain on sale of shares, why I didn't have taken the special rate? Sir, these are not listed equity shares. If you see, on sale of shares of company registered in country A, these are not listed equity shares in India and STT paid in India. So 111A is not applicable. So 111 it comes. So 111 now these will come under the normal slab rates only. So no special rate. So what is the double taxed income, sir? 30,54,120. Okay. The 30,54,120 into, if you apply the 20%, what is the relief? 6,58,600. If you subtract, the final tax liability is 9,27,250. How much? 30,54,120. Sir, 1 second, sir. One point which we have missed in solving the question is, first thing, this is like India is DTA with country A, and the tax paid in country A is eligible for a tax credit in India. So it's like which method? They are referring to this as ordinary credit method. So under ordinary credit method, what happens? The tax paid in foreign country, okay, you will not multiply with the double taxed incomes and all. You will directly take how much is the tax paid in foreign country and all. So here the mistake which while solving it is like we need not to find out the double taxed income. Okay. So then what we need to do, sir? We need to find out the tax paid in foreign country. Okay, Indian tax paid. Okay, we need average tax rate and all. That's fine. This one, sir, if you look at here, what they did is correct only. 30,54,120 into 28.4. So as per India, this is the tax has to be paid. In ordinary credit method, what we will compare? The tax to be paid in India and the tax paid in foreign country. How much is the tax to be paid in foreign country, sir? See, 25,000 USD plus 4,500, 29,500 plus 10,000, 39,500 plus 5,000, 44,500. Okay, so if you see what is the total, 44,500. On the 20% is the tax they will be paying. 45,500 into 20%. How much? 8,900. This 8,900 is converted by using the preceding month last day exchange rate. How much, sir? It was paid in which month, sir? The tax is paid in the month of May. So preceding month means what? April. So April last day night is what? 74. So if you use 74 to convert, it will be 6,58,600, and then we'll be getting the tax as how much, sir? 9,27,250. Okay, so it's not. So it's what? Ordinary credit method, sir. Usually we'll do it under what? Unilateral review, but this is an ordinary credit method related question. Okay, I hope everybody is following this point. Then, sir, I'll discuss this June 2025 question and I'll close. Hari, aged 42 years, is a resident individual, furnished the following particulars of income earned by him. India does not have a DTA. He has a professional income in India, taxable. Agricultural income from country SA, 2,65,000. Country SA, which is like taxable. Dividend from company incorporated in country A, it's the gross, okay, taxable. Royalty income from country SA, taxable. Expenses incurred in earning royalty, 2,10,000. And business loss in country SA, 2,50,000. Assume that royalty outside India is also eligible for deduction. Okay. Income tax law permits set off of business loss against any other income, the other country also, and the rate of income tax in SA is like 15%. Compute total income and net tax liability. Okay. First, sir, what is this professional income, sir? 10,50,000. Then royalty income 8 lakhs. From there, if you subtract business loss, royalty income how much, sir? They are having 10 lakh 10,000, but the relevant expenses are adjusted. So it's like 8 lakh. Okay, fine. PGBP income total, sir. They are having a loss also, business loss, how much? 2 lakh 50,000. So 10 lakh 50, 8 lakhs minus 2 lakh 50, and the total PGBP income will be how much, sir? 16 lakhs. Then agriculture income 2 lakh 65 under IFOS. Then dividend also is there, how much, sir? 66,000. So if you take both of them under the IFOS head, it will come to 3 lakh 31,000. Then the gross total income is 19 lakh 31,000. Sir, he has opted for old regime or new regime? Opted out from default. So that means he is under the old regime. In old regime, for royalty, there is a deduction under 80 QQB up to 3 lakhs. So if you claim 3 lakhs, then the net total income is 16 lakh 31,000. Okay. So then you need to find out the tax liability and average tax rate. Average tax liability is like 3,13,872, sir. And then the average tax rate is how much? 19.24 percentage. How much? 19.24 percentage. Whereas the tax rate in foreign country is 15. So you will take what? Whichever is lower. 15 percentage. Into double taxed income. What is the double taxed income, sir? Double taxed income is like royalty. No. Royalty is not 5 lakhs. Royalty 8 lakhs. Loss also. Okay, we'll adjust. First royalty will take how much? 8 lakhs. Then anything else is there? Agriculture income 2 lakh 65,000. Total 10 lakh 65,000. From there you will adjust business loss 2 lakh 50,000. So effectively how much, sir? It is like 8 lakh 15,000 is the double taxed income. So that 8 lakh 15,000 is the double taxed income. Five lakh 81. How they got 5 lakh 81? Oh, okay. 8 lakh 15,000. From 8 lakh 15,000 they will be claiming even what, sir? 8 lakh 2 lakh 65, 10 lakh 60. First we will write down, sir, clearly what is the double taxed income. What is the double taxed income, sir? Here first agri income, how much? 2 lakh 65,000. Then they are having what? Royalty income 10 lakh 10. From their expenses adjusted. So royalty is how much? 8 lakhs. Then what else they are having? Nothing. So we can adjust business loss, how much? 2 lakh. And then there is 80 QQB deduction also, 3 lakhs. So if you subtract, what is the double taxed income? How much? 10 lakh 65,000 from there minus 5 lakh 50. It's like 5 lakh. Okay, 15. What they got? Five lakhs, 7 lakh 65,000. Dividend income. Sir, what is the dividend income given in the question? 66,000. So where is the dividend income? You are missing the dividend income, right? 66,000. If you add that one also, then how much it is? Like 5 lakh 81,000. So this is the double taxed income, 5 lakh 81,000. So multiply that 5 lakh 81,000 into 15 percentage, you will get 87,150 as the relief. Understand, sir? This is the June 2025 question also. So with this we have solved the whole DTAA, sir. Almost all the areas we have touched.